Welcome, everyone, to the Deep Dive. Today, we are embarking on a really important journey. We're going into the world of businesses, specifically how they are set up, how they're structured legally, and why all of this matters so much, especially if you're just starting out on your finance path. We have a good stack of materials here, notes drawn from, well, quite an important finance textbook to guide us through.
Hello, students. A very warm greeting to you all. Please don't worry. Understanding how businesses are organized might seem complex, but it's like learning the foundation of a building. Once you understand this base, everything else in finance becomes much clearer. We will break down all these terms, even the ones that sound complicated, into simple ideas. And we'll use everyday examples you might see around you, perhaps like your local shops or things you hear about in the news here in India. We'll go slowly, step by step, like good teachers should. No.
Exactly. So let's set the stage for our first lesson today. We'll be comparing the different ways businesses can be legally structured. And understanding this is really crucial because, well, it tells us how risks, how profits, and how responsibilities are shared within a business. It affects everything. So let's dive into these organizational forms. Let's start with the very, very basics, students. Imagine you want to open a business. Could be anything, a small shop, maybe a consulting service. The law gives your business different legal clothes it can wear, different forms it can take. Why do you think choosing the right legal form is so important? What's the big deal?
You see, my dears, that's a very central question. These forms, these legal clothes, as you put it, they differ in very fundamental ways. Like, who is legally responsible if something goes wrong? Who carries the burden? How do the owners and the managers, the people running the show day to day, relate to each other? How much money can the owners actually lose if the business fails? Is it just their investment or more? Also, how are the profits taxed? Does the business pay tax or do the owners pay tax? Or both? And very importantly for growth, how easy is it for the business to get money, to get financing, to expand? So today, we'll look closely at three main types: the sole proprietorship, the partnership, and the limited company, which you often hear called a corporation. Okay, let's pause for a moment, a little check-in. Can you think of just one reason, based on what we just said, why knowing these forms is important if you're looking at a business perhaps as an investor? Pause. It really comes down to understanding who is responsible for the business's problems, for its debts, isn't it? That's a big one.
Right. Who bears the risk? Okay, let's start with the simplest one then. You often see this with, say, your local Kirana shop, the small neighborhood store. What exactly is a sole proprietorship, and what makes it generally so easy to set up?
Exactly. The Kirana shop is a perfect example. A sole proprietorship is simply a business owned and controlled by just one single person. That owner puts in the money, the capital, they run everything, make all the decisions, and of course, they keep all the profits.
Hmm.
In many places, setting it up is incredibly straightforward. You might not even need any formal registration to just start. If
Mm.
you just begin selling goods or offering a service on your own, legally, you often are a sole proprietorship by default. But, and this is a very, very big point, children, please listen carefully. Unlimited liability. What does this mean? It means there's no legal difference between the owner and the business. They are one and the same in the eyes of the law. So if that Kirana shop racks up a lot of debt, maybe owes suppliers a lot of money, or faces a lawsuit, the owner's personal assets, things like their house, their car, their personal savings account, these can be taken to pay those business debts. There is absolutely no separation, no shield between the owner's personal wealth and the business's obligations. This also limits growth, you see, because the business can only grow based on what that one owner can personally invest or borrow against their own name.
Okay, that's a crucial point about unlimited liability. So let's check our understanding again. If a Kirana shop owner has this unlimited liability, what does that really mean for their personal savings beta? Pause. It means their personal wealth is completely tied to the business, isn't it? There's no safety net between the two. All right, now what if a Kirana shop owner wants to expand? Maybe bring in a friend or a family member to share the work, contribute more money, share the responsibility. What happens then? We move towards a partnership, I suppose.
Very good question. That's the natural progression often. When you want to pool resources with others, a partnership makes sense. It allows multiple owners to come together. And here, we have a few different types of partnerships to understand. First, there's the general partnership. Here, two or more individuals, we call them general partners, agree to share in the business. Think of maybe a small construction team run by two brothers, or a joint family business where everyone contributes. In a general partnership, typically all partners share in managing the business, and importantly, they all have unlimited liability. So, just like in the sole proprietorship, each partner is personally responsible for all the business's debts. And what's more, each partner can be held responsible for the full extent of the debts, even those created by another partner's actions. It's like in a family business, truly, everyone shares the burden, the risk, the relationship, how they share profits, duties. It's usually laid out in a partnership agreement, which acts like their business constitution, you could say. Now, because that unlimited liability is quite scary for many people, another form was created, the limited partnership, or LP. This structure was specifically designed to address the liability issue. In an LP, you must have at least one general partner, GP. This GP is the one who usually manages the business day to day, and crucially, this GP still has unlimited liability. But you also have limited partners, LPs, and here's the key difference. The liability of these limited partners is limited only to the amount of money they invested in the business. Imagine you are saving money for a big family wedding, putting money into a common wedding fund. If you are like a limited partner in this fund and somehow the wedding goes way over budget, you would only lose the money you put into that fund. You wouldn't lose your entire life savings, would you? LPs usually don't get involved in managing the business. They are more like passive investors.
Oh, that makes sense. So the LPs provide capital, but have less risk and less control.
Precisely. Then, in some places, especially for professional services, think of a group of doctors setting up a clinic together, or lawyers forming a firm. You have something called a limited liability partnership, or LLP. The big advantage here. In an LLP, typically all partners have limited liability. This means no single partner faces unlimited personal risk for the business's overall debts, or, importantly, for the malpractice or negligence of other partners. They are generally only liable for their own professional misconduct, and usually in an LLP, all partners can participate in the management of the firm.
Okay, so LLP offers protection to all partners, which sounds very attractive for professionals.
Yes, it is. Now, one more important point about partnerships taxation. Most partnerships, my students, are treated as pass-through entities for tax purposes. What does pass-through mean? It means that the business itself, the partnership entity, generally doesn't pay income tax on its profits. Instead, the profits or even the losses are passed through directly to the individual partners, and they then report their share of the income on their personal income tax returns and pay tax at their individual rates. It's a bit like a cricket scoreboard, you know? The runs scored are credited directly to the batsman who made them, not to the pitch itself where the game is played. The income goes straight to the partner.
That's a great analogy. Okay, quick check then. So if a limited partner in an LP invests, say, 1 lakh rupees, what is the absolute maximum amount they could possibly lose if the business fails completely? Pause. It would just be that 1 lakh rupees. No, their personal house, car, savings, those are safe. No.
Exactly right. Just the 1 lakh they invested, their personal assets are protected.
All right. So we've seen single owners, multiple owners with partnerships. But what about bigger businesses? Companies that want to grow really large, maybe raise a lot of money from many, many people, perhaps even list on a stock exchange like the BSE or NSE.
Yeah.
For these, the limited company form becomes much more attractive, I gather. What are its main advantages?
Ah, yes. Now we move to the structure that really enables large-scale business. The limited company, often just called a corporation. This offers very significant advantages indeed. The biggest draw, the number one reason, limited liability for all owners. This is absolutely key. Every single owner, and in a corporation we call the owners shareholders, has limited liability. Just like the limited partners we discussed, shareholders can only lose the money they invested to buy the shares. That's their maximum risk. Their personal assets are completely separate and safe from the business's debts or legal troubles. Think back to that wedding fund example. It's like now, everyone contributing to the wedding fund is a limited partner. They only risk their contribution if things go financially wrong with the wedding planning.
That's a huge protection, especially if you want to attract many investors who might not know each other.
Exactly. And that leads to the second major feature, separation of ownership and management. In most corporations, especially the larger ones, the owners, the shareholders don't run the company day to day. It's just not practical with potentially thousands or millions of owners. Instead, the shareholders elect a board of directors. This board acts on behalf of the shareholders, providing oversight and strategic direction. The board then appoints professional managers like the chief executive officer, CEO, and other top executives to handle the actual operations, the investing decisions, the financing activities. This allows the company to bring in specialized, expert management talent, and it also allows many people to invest their money and share in the profits without needing to be involved in the daily work or have specific industry expertise.
So ownership is separate from the actual running of the company.
Yes. And third, this structure leads to vastly improved access to financing. Because investors have limited liability and because ownership can be easily divided into small units called shares, corporations can raise huge amounts of capital. They can sell these shares to a very wide audience, individuals, investment funds, other companies. This ability to tap into broad capital markets is essential for funding big projects, research, global expansion.
Makes sense. More safety for investors means more willingness to invest.
Precisely. Also, generally, there are fewer restrictions on owners. Unlike some partnerships, public limited companies typically have no legal limit on the number of shareholders they can have. This allows for truly widespread ownership. Now, within limited companies, we broadly distinguish between two types: private limited companies and public limited companies. Private ones often have restrictions on who can own shares and how they can be transferred. They might not offer shares to the general public. In some places, they might get pass-through tax treatment, similar to partnerships. Public limited companies, on the other hand, are designed specifically to allow their shares to be bought and sold freely by the general public, usually on a stock exchange. This is the form most suitable for becoming publicly traded.
Okay, public means shares are available to anyone on an exchange.
Generally, yes. But there's a potential downside we touched on earlier for public limited companies: double taxation. This is a key point to grasp. In many countries, the profits of a public corporation are taxed twice. First, the corporation pays income tax on its profits at the corporate tax rate. Let's say the company earns a profit, it pays tax on that. Then, if the company decides to distribute some of its after-tax profits to its shareholders as dividends, those shareholders usually have to pay personal income tax on the dividends they receive. So the same pool of earnings gets taxed once at the company level and again when it reaches the shareholder. It's a bit like, imagine you pay tax on your salary. Then, if you give some of that already taxed money to someone as a gift, and they also have to pay tax on receiving it, that's the idea.
That sounds like a significant disadvantage.
It can be. However, this double taxation matters least if the company decides to reinvest all its profits back into the business for growth. If no dividends are paid out, then that second layer of tax doesn't happen at that time. So, for companies focused purely on expansion, it might be less of an immediate concern.
Right, deferring the second tax hit by reinvesting. Okay, another check-in for our students. What is one big benefit that a public limited company offers over, say, a general partnership, specifically for someone who just wants to invest a small amount of money? Pause. It's really the limited liability, protecting their personal assets, and also the ease of buying or selling those shares on an exchange, isn't it? Liquidity and safety.
Perfectly summarized.
So we've looked at the big three now: sole proprietorship, partnership, and the limited company or corporation. It feels like a spectrum, really.
Absolutely. You can think of it like climbing a ladder, my students. The sole proprietorship is at the bottom rung, simplest to start maybe, but unlimited liability and hardest to raise significant money. Partnerships are in the middle. You can pool resources, share work, but general partners still face that unlimited liability. Limited partnerships offer some protection but are more complex. And the public limited company, the corporation, is at the top. It offers the greatest potential to raise vast amounts of capital and provides that crucial limited liability shield for all its owners. Now, let's look at a really interesting, slightly complex, real-world example that mixes these forms. Simon Property Group. This is a huge American real estate company owning shopping malls, outlets, massive properties. Their structure is quite clever. It's in 2 layers. They use a limited partnership. It's actually called Simon Property Group LP, or Deed AG LP in some examples, to hold the actual properties, the assets. But the general partner of that partnership is not an individual, it's another company. Simon Property Group, Inc., which is a corporation, and its shares are publicly traded.
So a corporation is acting as the general partner of a limited partnership.
Exactly. Why do this? Well, the corporation, Simon Property Group, Inc., can easily raise money from the public by selling shares, giving it broad access to financing. And the shareholders of that corporation enjoy limited liability. Their personal assets are safe. Even though the corporation itself, acting as the general partner within the partnership, technically has unlimited liability for the partnership's debts. That liability stops at the corporation's assets. It doesn't flow through to the corporation's shareholders. It's a very sophisticated way to get the financing benefits of a corporation while potentially using the partnership structure for other reasons, maybe tax efficiency or operational control related to real estate assets.
That is clever, combining the best features.
Yes, you often see similar structures in large investment funds as well. They might be organized as corporations or limited partnerships, depending on their specific investment strategy and regulatory environment.
Okay, final check on this section. If someone came to you wanting to start a really big factory, maybe making cars or electronics, needing lots and lots of money from thousands of different investors. Which business form would you strongly suggest, and why? Pause. It would have to be a corporation, wouldn't it? Primarily for its unmatched ability to raise large amounts of capital from the public and to offer those investors the safety of limited liability.
Spot on. The corporate form is built for that scale.
Excellent. Now that we have a good grasp of the different forms, let's zoom in specifically on the corporate issuer, the corporation. This form is so common in the financial markets we study.
Indeed. Understanding corporations is absolutely crucial for financial analysts. Why? Because corporations raise more capital globally than any other type of entity, even more than governments. So really getting to grips with their unique features is paramount for anyone in finance.
Okay, let's start with a concept we touched upon. The corporation as a separate legal person. What does that really mean in practice, legally speaking?
Think of it this way, my dears. A corporation is created as a distinct legal entity. It's almost like it gets its own identity card, separate from the people who own it or started it. This legal personhood is established by filing specific documents, usually called articles of incorporation, with a government regulatory authority. Once formed, this separate legal entity can do many things in its own name. It can enter into contracts, hire employees, own property, patents, equipment. It can borrow money, lend money, invest in other ventures. It can sue other parties, and importantly, it can be sued. And it pays its own taxes. It exists independently of its founders or its shareholders. If the shareholders change, the corporation continues to exist. This gives it longevity and stability.
Right, so its existence isn't tied to the owners. Let's check this. If a big company, say an airline, gets into some serious legal trouble, maybe related to safety, can the corporation itself be sued in court, even if its main owner is a completely different person or entity? Pause.
Yes, absolutely. Because it's a separate legal entity, it stands on its own in legal matters? No. Precisely. The suit would be against Airline Corporation, not necessarily its individual shareholders.
Okay. Another key feature we mentioned is the owner-manager separation. Seems very important, especially in large companies. The people who own the company, the shareholders, often aren't the ones running it day to day. How does this work?
Yes, this separation is a defining characteristic of most corporations, particularly the publicly listed ones. The shareholders own the business, they have the ultimate claim on its value, but they are typically removed from the daily operational decisions. Instead, as we noted, they elect a board of directors. Think of the board as the shareholders' representatives. The board's job is oversight, setting the overall strategy, making major decisions like approving large investments or acquisitions, and crucially, hiring and monitoring the top management team. This team, led by the Chief Executive Officer, CEO, is then delegated the authority to make the operating, investing, and financing decisions needed to run the company effectively. This structure allows the company to attract a very broad range of investors, people who simply want to invest their capital and participate in the potential profits without needing the time or expertise to manage a complex business themselves.
And how do shareholders exercise their influence if they're not managing things directly?
Primarily through their voting rights. Shareholders typically get to vote on electing the members of the board of directors. They can vote to keep directors or to replace them. They also often vote on major corporate actions like mergers or changes to the company's charter. So their power lies in selecting and holding accountable the board, who in turn oversees management.
Okay, so the influence is indirect through electing the board. Let's check this. If you own shares in a very large company like, say, Reliance Industries or Tata Consultancy Services,
Yeah.
do you get to call up the CEO and tell them what marketing campaign to run? Or how do you have your, say, children pause? No, you don't call the CEO directly. You use your vote to elect the board of directors, and they are the ones who appoint and oversee the CEO. That's the chain of command.
Correct.
Now, just to hammer this point home because it's so fundamental, owner-shareholder liability. We keep coming back to it, but it's that important, isn't it?
Absolutely. It is perhaps the foundational benefit of the corporate form, the one that truly enabled modern capitalism to flourish. Let's state it clearly again. The maximum amount a shareholder can possibly lose is strictly limited to the price they paid to buy the shares, full stop. If the corporation goes bankrupt, piles up massive debts that cannot pay, the shareholders' shares might become worthless. Yes, they lose their investment. But the company's creditors, the banks, the suppliers, anyone the company owes money to, they cannot come after the shareholders' personal assets. Your house, your savings, your car are safe. Ownership is divided into these small, easily tradable units, the shares, making it very simple for investors to buy or sell small portions of large companies. It's like buying just one single packet of Maggi noodles from the shop. If something goes wrong with the Maggie company later, the most you lose is the cost of that one packet you bought. You don't risk your whole house.
That's a very clear analogy.
No.
Okay, another quick check, my dears. If a company takes on a huge amount of debt, maybe borrows heavily to build a new factory, and then business turns bad and it struggles to repay, will its shareholders be asked to dip into their personal bank accounts to help pay off that corporate debt? Pause. No, they won't. Because of that crucial shield of limited liability.
Exactly right. Their personal wealth is protected.
Okay, that protection clearly helps attract investors. But how exactly do corporations manage to raise such massive amounts of money compared to partnerships or sole proprietorships?
Yeah.
What are the main methods for external financing?
Corporations have two primary ways to finance their operations and growth, my students. Two main taps for money. First is equity financing. This means raising money by selling ownership shares to investors. As we discussed, when you buy a share, you become a part owner. Equity also includes the company reinvesting its own profits back into the business. These are called retained earnings. When profits are paid out to shareholders, remember those payments are called dividends. The second main way is debt financing. This is simply borrowing money. It could be through bank loans or very commonly for large corporations by issuing bonds. A bond is essentially a formal IOU. The company borrows money from investors, bondholders, and promises to pay it back by a specific date, the maturity date, usually making regular interest payments along the way.
So selling ownership versus borrowing money, equity versus debt.
Precisely. And the combination of the separation of ownership and management, along with that crucial limited liability, makes corporations incredibly attractive to a vast range of investors. We're talking individuals, mutual funds, huge pension funds, managing retirement savings for millions, insurance companies, even governments sometimes invest in corporations. This incredibly broad appeal allows corporations to access much, much larger pools of capital than a single owner or a small group of partners could ever dream of. That's why you see corporations with such enormous balance sheets, with billions or even trillions of dollars in assets, funded by a mix of both debt and equity. It fuels massive scale.
Understood. So the structure itself facilitates access to capital. A quick recall for our students. If a company decides to give out some of its profits to its shareholders, what are those payments usually called? Pause. Dividends. Very good. Now let's revisit that taxation issue, specifically the double taxation problem for corporations. We understand the concept taxed at the company level, then again at the shareholder level for dividends. Can you give us a clearer example, maybe with some numbers, to show why it's seen as a disadvantage?
Certainly. This is a crucial point to grasp because it affects the ultimate return to shareholders. In many countries, as we said, corporate profits face two layers of tax. First, the corporation pays income tax on its profits. Let's say the corporate tax rate is 25%. The company earns 100 crores, it pays 25 crores in tax. Now the company has 75 crores left, 100 minus 25. This is its after-tax profit. If the corporation decides to distribute this entire 75 crores to its shareholders as dividends, those shareholders then have to pay personal income tax on the dividends they receive. Let's say the dividend tax rate for shareholders is 20%. So on the 75 crores received, the shareholders collectively pay another 15 crores in tax, 75.0.2 dole. So look at the total tax paid on that original 100 crores profit. 25 crores paid by the company plus 15 crores paid by shareholders equals 40 crores in total tax. The overall effective tax rate on that profit is 40%. That's a double hit.
Wow. Okay, seeing the numbers makes the impact much clearer. 40% is significant.
It is. Now, let's consider the French retail giant Auchan Holding example from our notes. Let's say it earned $838 million before taxes. The corporate tax rate was about 31.5%, so it paid $264 million in corporate tax. That left $574 million after tax. Now, if Auchan distributed all of that $574 million as dividends, and if its shareholders faced, say, a 30% personal tax rate on those dividends, they would pay an additional $172.2 million in personal taxes, 574.030. So the total tax on the original $838 million profit would be $264 million corporate plus $172.2 million personal, equal $436.2 million. That's a total tax rate of over 52%. A very clear illustration of double taxation's potential impact.
That is a hefty tax bite indeed.
Yes. But remember, double taxation matters least when the company plans to reinvest all or most of its after-tax profits back into the business. If no dividends are paid, that second layer of tax on shareholders is deferred, perhaps indefinitely if the company keeps reinvesting for growth. Also, if the corporate tax rate itself is very low in a particular country, it might still be advantageous for owners to store profits within the corporation, even with the potential for later double taxation.
Right, so the decision to pay dividends versus reinvesting has significant tax implications. Let's check this with our students. If a company decides to use all its profits to build a brand new factory and doesn't pay out any dividends that year, will its shareholders face that second layer of taxation, the double taxation on that money right away? Or does it happen later, children? Pause. It happens later, right? Only if and when those profits, generated perhaps by the new factory, are eventually distributed as dividends, not immediately if reinvested.
Correct. The reinvestment defers the second tax.
Okay, this discussion of corporations naturally leads to another common distinction we hear: publicly versus privately owned corporate issuers. Now, this can be a bit confusing. Does public company mean it's owned by the government, like a public park or a public library?
That is an excellent point to clarify, my students, because the terminology is confusing. No, usually when we talk about a public company in finance, it does not mean government-owned. It means the company's shares are listed and traded on a public stock exchange, like the NYSE in America or the NSE here in India. This means the shares are available for purchase and sale by the general public, by any investor who wants to trade them. A private company, then, simply means its shares are not listed on a public exchange. They are held privately, often by founders, family, employees, or a smaller group of investors like venture capitalists or private equity firms.
Okay, so public relates to trading on an exchange, not government ownership, usually.
Exactly. Now, most publicly traded companies are legally structured as public limited companies, as we discussed earlier. That legal form allows them to list shares publicly. But it's important to remember that a company can be legally formed as a public limited company, but still choose not to list its shares on an exchange, remaining privately owned. The legal form enables public listing, but the act of listing is a separate strategic decision.
Got it. Legal form versus listing status.
So the key differences between public and private companies really boil down to a few things. How easily can owners sell or transfer their shares? That's ability to transfer ownership. How does the company raise new money by issuing more shares? That's the process of issuing new shares. And how much information do they have to share with the public and with government regulators? That's registration and disclosure requirements.
Okay, transferability, fundraising, and disclosure.
Yes. And related to public companies, you often hear the term free float. This refers to the proportion of a public company's shares that are actually available for trading by the general public on the stock exchange. It excludes shares held by insiders, like management or founding families, strategic long-term investors, like other corporations holding a large stake, or sometimes governments. Let's take L'Oreal, the famous French beauty company. It's a public company. Its shares trade on the exchange. However, the founding family, Bettencourt-Meyers, and another large corporation, Nestlé, own significant chunks of the shares, maybe around 50–55% combined. The remaining 45% or so, owned by many different institutional investors, like mutual funds, and individual retail investors, constitutes the free float. These are the shares actively traded day to day.
So free float is the portion readily available for trading by the public. Let's check this. If you want to buy shares of a very well-known, large company easily, maybe just using an app on your phone, is it most likely going to be a public company or a private company, my students? Pause. It has to be a public company, for sure, because its shares are listed and easily accessible on an exchange.
Exactly. That accessibility is key.
So why would a company want to go through the process and expense of listing its shares on an exchange? What are the main benefits of being public?
Great question. Listing on an exchange brings several major advantages. First and foremost is liquidity. We mentioned this. It makes ownership much, much easier to transfer. Investors holding shares in a public company can usually buy or sell them almost instantly during market hours through their brokerage account. This happens in the secondary market trading between investors. It's like being able to buy or sell tickets for a popular cricket match instantly outside the stadium. There's usually always a buyer or seller available at some price. This ease of converting shares to cash is highly valued by investors.
So easy entry and exit for investors.
Yes. Second is price transparency. The stock exchange provides a visible, constantly updated share price. This allows investors, the company itself, and the market generally to see the company's perceived value in real time. It helps in decision-making, performance tracking, and even using shares for things like employee compensation.
Okay, liquidity and a clear market price. What about private companies then?
Well, in contrast, Shares in private companies are generally not liquid at all. There's no public market, no constantly updated price ticker. If you own shares in a private company and want to sell, well, you have to find a buyer yourself. You then need to negotiate a price, which can be difficult without a public benchmark. And often, the company's own rules or shareholder agreements might restrict who you can sell to or even refuse the transfer. Your investment is often locked up for a long time, maybe until the entire company is sold or it decides to go public itself.
Sounds much harder to get your money out from a private company.
It generally is. However, being private isn't all bad. Private status offers its own benefits. Often, private companies have fewer shareholders, which can mean simpler governance and management being accountable to a smaller, potentially more aligned group. A huge benefit is less regulatory burden and fewer public disclosure requirements. This saves significant costs on compliance, legal fees, auditing. It also allows the company to keep its financial results and strategic plans confidential, away from the eyes of competitors. And for early investors, if a private company becomes very successful and eventually goes public or gets acquired, the potential returns can be extremely high, much higher than typical public market returns, reflecting the higher risk and lack of liquidity they endured.
All right, so trade-offs. Liquidity and transparency versus lower costs, privacy, and potentially higher returns if successful. Let's check this. If a private company doesn't have its share price displayed publicly every day, what problem does that create for an owner who wants to sell their shares quickly? Pause. It makes it very difficult to find a buyer easily, and even harder to agree on what a fair price should be. No, there's no market benchmark.
Correct. Valuation and finding a counterparty are major hurdles.
Okay, now let's talk about raising new money by issuing shares. Share issuance. Is the process different for public and private companies?
Yes, quite different indeed. When a public company needs more capital, say for a big expansion, it can conduct a secondary offering or follow-on offering. It issues new shares, and these can be bought by any investor in the public market and then easily traded. This gives them access to potentially billions of dollars from a vast pool of global investors. Their ability to raise large sums relatively quickly is a major advantage.
So they tap into the public markets again.
Yes. Private companies, on the other hand, typically raise smaller amounts of capital through private placements. This isn't an offer to the general public, it's a direct negotiated sale of shares, or sometimes debt, to a limited number of investors. These investors are often required to be accredited or sophisticated, meaning regulators deem them financially knowledgeable enough and wealthy enough to understand and bear the higher risks associated with private illiquid investments. The terms of the deal are outlined in a detailed legal document, like a private placement memorandum.
So public companies sell to the masses. Private companies sell to a select few sophisticated investors. Let's check. If a private company needs a very large injection of cash to fund extremely rapid growth, what kind of investors would it likely seek out? Investors who understand and can afford potentially higher risks. It would look for those accredited or sophisticated investors, perhaps venture capital firms or private equity funds, who participate in these private placements.
Exactly. They target investors equipped for that type of investment.
Now, a defining difference you mentioned is registration and disclosure requirements. Public companies are often praised, or sometimes criticized, for their high level of transparency. What does that actually involve?
This is perhaps the most significant operational difference. Public companies operate under a microscope, you could say. They must register with the relevant securities regulatory authorities like SEBI in India, the SEC in the US, and similar bodies worldwide. This registration triggers extensive and ongoing reporting requirements. They have to file detailed financial statements, balance sheet, income statement, cash flow statement that have been audited by independent accountants. This usually happens quarterly or semi-annually. They also have to file comprehensive annual reports, often running over 100 pages, discussing their business, strategy, risks, management compensation, governance practices, and much more. All these filings are publicly available for anyone to read. Furthermore, public companies must promptly disclose any material events, significant news that could reasonably affect their share price. This could be a major contract win or loss, an acquisition, a change in CEO, even large share purchases or sales by top executives, insiders.
That's a lot of information they have to put out there.
It is. It's designed to ensure investors have the information they need to make informed decisions and to maintain fair and orderly markets. Private companies generally face far fewer such requirements. They don't have to register their securities for public trading, nor do they have to make these extensive public filings. Of course, they still have to file tax returns with the government and comply with basic corporate laws and anti-fraud regulations. But their internal finances and strategies remain largely private. As we said, this lesser disclosure means lower compliance costs and potentially a competitive advantage, as they don't reveal sensitive information to rivals.
Okay, that makes the distinction very clear. So, for you as an investor, why would you generally like a public company to release all this detailed information so regularly, my dears? What's the benefit to you? Pause. It helps you understand the company much better, assess its health, its risks, its prospects, and ultimately make more informed investment decisions, right? Information is power for the investor.
Perfectly stated. It levels the playing field.
We've talked about being private and being public, but how does a company make that transition? How does it go from private to public? The story of companies like Tesla is quite fascinating here.
Indeed, my students. That transition is a major milestone. A private company can become public in a few main ways. The most common and well-known method is the initial public offering, IPO. This is when the company offers its shares for sale to the general public for the very first time. To manage this complex process, they hire investment banks, which act as underwriters. These banks help value the company, prepare the legal documents, like the prospectus, market the shares to institutional investors, and manage the sale process. Sometimes they even guarantee to buy unsold shares. The money raised from selling these new shares goes directly to the company's treasury, providing capital for growth. After the IPO, the shares start trading on a stock exchange. Tesla Motors is a great example. Its IPO back in 2010 raised about $226 million. That capital was absolutely critical for funding the development of its cars and building its factories, leading to its incredible growth.
So IPO raises new money for the company via underwriters.
Correct. A less common method, but one we hear more about sometimes, is a direct listing. In a direct listing, there's usually no underwriter involved in the same way, and crucially, the company does not issue new shares to raise capital. Instead, the company simply facilitates the listing of its existing shares, those held by early investors, founders, employees, directly onto the stock exchange. This allows those existing shareholders to start selling their shares to the public. Spotify, the music streaming service, famously used a direct listing in 2018. It's often seen as a quicker and potentially cheaper way to go public, but it's usually suitable only for companies that are already very well known and don't immediately need to raise fresh capital. They primarily want to provide liquidity for their existing shareholders.
Okay, direct listing is for liquidity, not new capital.
Generally, yes. Another way a private company can become public, albeit indirectly, is if it gets acquired by a public company. The private company essentially merges into the publicly traded acquirer. And finally, there's a more recent, quite interesting mechanism, the Special Purpose Acquisition Company, SPAC. A SPAC is sometimes called a blank check company. It's a company formed with no actual business operations. Its sole purpose is to raise money through its own IPO and then use that money to find and merge with an existing private company, usually within a set time frame like 2 years. Once the SPAC merges with the target private company, the target company effectively becomes publicly listed through the SPAC's existing listing. This became a very popular, often faster way for private companies to go public, especially in certain market conditions.
Ah, the SPAC route, buying a public shell company in a way. Okay, quick check. If a private company's main goal in going public is to raise a substantial amount of new money to fund its expansion plans, which method would it most likely choose, an IPO or direct listing? Pause. It would almost certainly choose an IPO, wouldn't it? Because the IPO is specifically designed to issue new shares and raise fresh capital for the company itself.
That's exactly right. The IPO is the capital raising route.
Now, can the reverse happen? We've gone from private to public. Can a company go from public to private?
Yes, it absolutely can, my friends. This process is often called a take private or go private transaction. What typically happens is that a group of investors, very often a private equity firm, makes an offer to buy all of the company's publicly traded shares. They usually have to offer a price that's significantly higher than the current market price, a premium, to convince all the public shareholders to sell. To finance this massive purchase, they often borrow a very large amount of money, using the target company's own assets or cash flows as collateral. This heavy use of debt is why it's frequently called a leveraged buyout, LBO. Once they acquire all the shares, they delist the company from the stock exchange and it becomes private again.
But why would they do that? Why take on so much debt to buy out all the shareholders?
The main motivation is usually a belief that they can make significant improvements to the company's operations or strategy once it's away from the pressures and scrutiny of the public markets, the need to report quarterly earnings, please diverse shareholders, etc. As a private company, they have more freedom to undertake major restructuring, maybe sell off underperforming divisions, change management, invest for the long term without worrying about short-term stock price reactions. They believe these changes will significantly increase the company's underlying value, hopefully enough to more than cover the premium they paid and the high financing costs. After making these changes over several years, the private equity firm might then aim to exit their investment, perhaps by selling the improved company to another corporation, or even by taking it public again through another IPO, hopefully at a much higher valuation.
I see. So take it private, fix it up, or restructure it away from public eyes, then sell it or take it public again for a profit.
That's the typical LBO model, yes. And it's interesting to note global trends here. In many emerging economies, like India perhaps, we are seeing a growth in the number of publicly listed companies. This is often driven by strong economic growth, companies needing expansion capital, and increasing interest from foreign investors. However, in many developed economies, like the US or parts of Europe, the number of public companies has actually been declining in recent years. This is partly due to more mergers and acquisitions, public companies buying each other, but also because there's now so much private capital available from venture capital, private equity, sovereign wealth funds. This abundance of private money allows promising companies to grow very large and stay private for much longer, avoiding the significant costs, disclosure requirements, and potential short-term pressures of being a public company.
That's a fascinating contrast between emerging and developed markets.
Yeah.
Okay, a final check on this. Why might some owners, perhaps private equity firm, prefer to take their company private, even if it means buying back all the shares at a high price? Students. Pause. It's often for greater control, right? To make significant changes without needing constant public approval and away from that intense public scrutiny.
Precisely. More control and strategic flexibility.
Okay, we understand public and private, but who actually owns these corporations? We mentioned shareholders, but what varieties of corporate owners exist? Is it just individuals like us and big investment funds?
Not at all. While individuals and institutional investors like pension funds, mutual funds, insurance companies are very common shareholders, corporations can have a surprisingly diverse range of owners. For instance, governments can create fully own or partially own corporations. These are often called state-owned enterprises, SOEs, or government-owned corporations. A familiar example might be the United States Postal Service, USPS, which is structured as a government-owned corporation. Why would governments do this? Sometimes it's to provide essential public goods or services, like building infrastructure, running utilities, or operating postal services where private companies might not find it profitable enough. Other times, it's to maintain control over strategically important industries, like energy or natural resources. We saw this very clearly with Saudi Aramco, the giant Saudi Arabian oil company. It was 100% owned by the Saudi government for decades. Then, a few years ago, the government sold a small percentage of shares to the public in a massive IPO, partly to raise funds and diversify the country's economy, but the government remains the overwhelmingly dominant shareholder. Similarly, in Greece, the Public Power Corporation, PPC, which handles electricity, was initially fully state-owned. Over time, the government gradually sold off shares to raise capital and modernize the company, reducing its ownership stake, but often retaining significant influence.
So governments can definitely be major corporate owners. What about nonprofits? Can charities own big companies?
Yes, surprisingly perhaps, even nonprofit organizations like charitable foundations or university endowments can be significant shareholders, sometimes even the controlling owners of large corporations. A great example is the Novo Nordisk Foundation in Denmark. This is a private foundation with philanthropic goals, yet it is the controlling shareholder of Novo Nordisk AS, one of the world's largest pharmaceutical companies, famous for its diabetes treatments. The foundation uses the dividends and wealth generated by the company to fund scientific research, healthcare initiatives, and humanitarian aid. So its ownership has both financial objectives, ensuring the company thrives, and social objectives.
That's a very interesting model, using corporate profits for charity.
And of course, as we've mentioned, other corporations frequently own shares in one another. One corporation can be a major shareholder in another. We saw the example of Nestlé owning a significant stake in L'Oreal. This happens all the time for strategic partnerships, supply chain relationships, or simply as investments.
Okay, so ownership is much more varied than just individuals and funds. Governments, nonprofits, other companies. Let's check this understanding. Could a government own, say, a big national oil company and then decide to sell some of its shares to the public on a stock exchange to raise money for building schools or roads? Beta. Pause.
Yes, absolutely. That's exactly the kind of partial privatization we saw with Saudi Aramco. No, using state assets to fund other projects.
Yeah, correct. It's a common strategy for governments globally.
All right, let's try to bring many of these concepts together with a slightly more complex practice problem application. Let's use that example from the notes involving Geej Inc. and DLP, which invest in timber and forest assets. Can we walk through how that structure works? Very good. Let's try to dissect this. It's a great example of sophisticated structuring. So we have DAG Inc. This is described as a publicly traded corporation. Its shares can be bought and sold on an exchange. We also have DAG LP. This is a limited partnership, and it's the entity that actually owns the timberlands, the assets. Now, here's the link. DAG Inc., the corporation, serves as the general partner, GP, of DAG LP, the limited partnership. We're also told the D family owns 30% of the shares in DAG Inc., the corporation. And DAG Inc., the corporation, owns an 80% interest in DAG LP, the partnership.
Okay, so multiple layers. How much of the actual timber assets does the D family effectively own?
Let's trace it. The D family owns 30% of DAG Inc. DAG Inc. owns 80% of DAG LP. DAG LP owns the assets, so the D family's effective ownership of the assets is 30% of 80%. That is 0.30 multiplied by 0.80, which equals 0.24, or 24%. So effectively, they own about a quarter of the underlying assets.
Only 24% ownership, but DAG Inc. is the general partner. What does that imply about control and liability?
Ugh, this is the fascinating part. As the general partner of DAG LP, DAG Inc., the corporation, has unlimited liability within the context of the partnership. If DAG LP incurs huge debts, DAG Inc. is liable for them. However, because DAG Inc. is itself a corporation, its own shareholders, including the D family who own 30% of its shares, still benefit from limited liability. The unlimited liability of the GP role stops at the corporate entity, DAG Inc. It does not pass through to the shareholders of DAG Inc. Their personal assets remain protected. So this structure allows the D family, through their 30% ownership and control of the corporate GP, the DAG Inc., to effectively control the management and strategy of the partnership's assets. Even though they only have a 24% effective economic ownership, and they achieve this control without exposing their personal wealth to the unlimited liability associated with being a direct general partner.
Wow. That is a very clever way to separate management control from personal financial risk using different legal structures.
Exactly. It highlights how these forms can be combined strategically to achieve specific financial and governance objectives. It's about smart organizational design.
Let's do a final check on that complex example.
Yeah.
Did you see how the D family, even with only 30% ownership in the public corporation DGA Inc., could effectively control a large pool of assets because that corporation acted as the general partner of the partnership holding the assets, my friends? Pause. It really demonstrates the power that comes from understanding and utilizing these different organizational structures, doesn't it?
It certainly does.
Wow. We have certainly covered a huge amount of ground today. We started with the idea of a simple kirana shop, a sole proprietorship, and journeyed all the way to complex multinational corporations with multi-layered ownership structures involving partnerships, public companies, even governments and nonprofits.
Indeed, my students. And understanding these foundational concepts is just so crucial. Things like legal identity, the differences in owner liability, how businesses are taxed, how they access financing. These are absolutely essential for anyone aspiring to work in finance. This knowledge helps you truly grasp how businesses operate in the real world, how they raise the money they need to grow, and how they manage the risks they face. Remember, the entire world of finance, from stock valuation to investment banking, is built upon these basic building blocks of business structure.
So thinking about our listeners, our students, as they continue on their CFA journey, what does mastering this material really mean for them?
Well, this raises a very important question for you all to consider. How will your understanding of these different business forms actually help you when you start analyzing investment opportunities in the future? When you look at any company now, you should know to ask, is it public or private? What kind of liability protection do its owners have? How does it fund itself? Debt, equity? How are its profits taxed? Knowing the structure provides vital context.
That's a great takeaway. The structure tells you a lot about the underlying risks and opportunities. Okay, as a final thought for everyone to mull over after we finish, think about it like this. Just like a cricket captain chooses different players for the team based on their specific strengths. Some are good batsmen, some bowlers, some fielders. Businesses choose their organizational form based on their goals. Goals related to growth, control, risk management, raising capital. Now, imagine a successful but maybe small family-run business here in India. Think about how such a business might dream of one day becoming a huge, publicly listed company, maybe like a Reliance or a Tata. What steps would that business need to take? What crucial organizational changes, perhaps moving from a partnership or private limited company to a public limited company, would be absolutely necessary to make such a massive transformation possible? Keep thinking about these fascinating connections between structure, strategy, and scale, children.
Thank you all so much for joining us on this deep dive today. Please keep learning, keep asking questions, and keep building your knowledge base, step by careful step. Remember, strong foundations are everything in finance. We are always here, happy to help you build those strong foundations.
Absolutely. Until next time, take care, students.
A very warm welcome to all our students joining us today. We are so glad you're here for another enlightening and deep dive session.
Yes, welcome everyone.
Today, we're going to embark on a really fundamental exploration in finance, something absolutely crucial for every aspiring CFA student to understand.
That's right.
Even if you are just beginning your journey, maybe with no prior background in finance or accounting at all.
Absolutely. This is really where the strong foundation of your financial knowledge will be laid.
Exactly.
Think of this as building the robust base for your finance house. If the foundation is weak, well, even the most beautifully designed building might wobble.
Face serious problems later on, isn't it?
Exactly. So today, our goal is to understand how companies secure the money they need, to run their daily business, to expand, to innovate.
And just as importantly, we'll delve into who gets to have a say in how that money is used.
Yes, and why their interests can sometimes align perfectly, and other times, well, they can diverge quite dramatically.
It's a fascinating interplay, really.
It is.
Our mission today is clear, but deeply profound. We want to help you clearly grasp the two primary ways companies get money.
Through what we call debt and through equity.
Yes. We'll compare these two financing pillars in detail. We'll look at how each affects a company's risk profile.
And its potential for financial returns.
Right. Then we'll broaden our perspective to look at all the different individuals and groups.
Often referred to as stakeholders.
Exactly. People who have a vital interest in a company's success and how it operates.
It's truly a rich tapestry of interconnected relationships that shapes the corporate world.
It really is.
And we will also spend significant time discussing some increasingly important factors, collectively known as ESG factors.
That's environmental, social, and governance.
Precisely. And these are becoming more and more crucial, for both investors and companies in today's dynamic global landscape.
And to make sure these concepts really stick.
Yes. We will make sure to use simple, relatable examples, things drawn from our daily lives here in India.
So these complex ideas become very easy to grasp and connect with your own experiences.
Hopefully. So are you ready to learn? Let's unpack this together step by step.
Let's dive in.
So let's begin with the very basics. Imagine a big, bustling factory in your town.
Okay.
Maybe one that produces textiles or car parts, or even think of a large, expanding school.
Right.
Now, this entity, this factory or school, it needs a substantial amount of money.
To build things, buy machines.
Exactly. Build its premises, acquire new machinery, pay its dedicated staff, manage its daily operations smoothly. Where, fundamentally, does all this essential money come from?
Good question.
Well, companies, at their core, primarily secure funds in two fundamental ways.
Okay, two ways.
By taking on debt or by issuing equity.
Debt and equity.
Think of it like a family preparing for a big, important event, maybe a grand wedding.
Ah, okay, a wedding. That's relatable.
They have a couple of primary options for financing it, right? They might decide to take a loan from a bank or perhaps borrow from a close relative.
Promising to pay the money back over time.
Yes, exactly. Usually with a small additional charge.
Yeah.
This, my dear students, is very much like a company taking on debt.
Okay, that's debt.
Alternatively, they could ask their close family members or friends to contribute money.
To chip in.
Yes, chip in. And in return, those contributors become part owners of the wedding expenses.
Right.
They share in the joy, the responsibilities.
And maybe even have a say in some decisions, like the menu.
Ah,
Perhaps. The second option is quite similar to a company raising equity.
okay. Debt is like borrowing. Equity is like bringing in partners.
You got it.
So let's start by delving deeper into the concept of debt. When a company takes on debt, it's essentially borrowing money.
Simple as that.
This money can come from various places. It might be a direct loan from a bank or a financial institution.
What we often call a term loan or a credit facility.
Right. Or it could come from many individual investors and institutions who buy bonds issued by the company in the public market.
But the critical aspect here is that when a company takes on debt, it enters into a formal, legally binding promise
It's a very serious promise,
to pay this borrowed money back, and not just the original amount.
which we call the principal,
Yes, the principal,
Yeah.
but also an additional cost for using that money.
which is the interest.
Exactly. And this repayment happens over a fixed, pre-agreed period. It's a very clear contractual obligation, much like a promise you must keep.
Yes, precisely. So if our factory needs to buy a new advanced machine costing, let's say, 1 crore rupees,
Okay, a big investment.
and it takes a loan for it,
Hmm.
the company promises to pay back that original amount of 1 crore rupees, the principal,
Right.
along with a small fee, the interest. These payments are typically made at regular intervals.
Like every month or every quarter.
Yes, perhaps every month or every quarter, until the entire loan is fully repaid. And this loan has a specific fixed time period.
We call that the tenor or maturity.
Exactly. It could be a short-term loan, maybe 1 or 2 years, or a long-term loan, spanning 5 years, 10 years, even longer.
But it's definitely not forever.
No, there is always a clear end date. That's key for debt.
Okay.
Now, to make this idea of a fixed obligation super clear, let's use a very common example from our daily lives in India.
Okay, good idea.
Think about your electricity bill at home. Every single month, you must pay it, right?
Yes, absolutely. It's a fixed obligation. It arrives, you pay.
It's non-negotiable. If for some reason you don't pay it, what happens?
Well, the consequences are immediate. Your electricity supply might get disconnected.
Which is certainly a big problem. Similarly, for a company, its debt payments, both the interest due and the principal repayments, are a fixed promised obligation.
They are not optional.
Not at all. If the company fails to pay, the lenders have strong legal recourse. They can take legal action to get their money back.
Or even take control of the company's assets.
Yes. That makes debt a very serious and binding commitment for the company.
And this next point is incredibly important for you to understand. Debt holders, or lenders, have what we call a priority claim over shareholders.
Priority claim. That sounds important.
It is. This means that if a company unfortunately runs into severe financial trouble, maybe even has to close down and sell off all its assets.
A worst-case scenario.
Right. The lenders get their money back first, before almost anyone else.
Before suppliers. Before employees.
They are prioritized usually even before suppliers, and certainly long before any money goes to the shareholders. It's like a queue, you know?
And debt holders are right at the front.
Exactly. So imagine a cricket match. Before the batsman can even score runs and celebrate.
The bowler must deliver the ball, isn't it?
Precisely. The debt holder is like that bowler who gets his payment guaranteed first, or at least has the first right to it before the game can proceed for others.
That priority makes debt a safer investment from the lender's perspective then.
It certainly does.
That's a wonderful way to put it. And another key characteristic of debt holders. Generally, they don't have a direct say in how the company is run day to day.
Or in its big strategic decisions.
Not usually.
Mm.
Their primary concern, as we discussed, is simply getting their money back.
The principal and the interest?
Yes. Now, they might include certain rules or covenants in the loan agreement to protect their investment.
Oh, okay. What kind of rules?
Things like limits on how much more debt the company can take on, or maybe requirements to maintain certain financial ratios.
To make sure the company stays healthy financially.
Exactly. But they don't typically vote on big company decisions, unlike shareholders. These covenants are their way of indirectly influencing the company to ensure their money is safe.
Got it. And one more thing, students, which is a significant advantage for companies that take on debt.
Oh, what's that?
Interest payments on debt are usually tax deductible for the company.
Ah, the tax shield.
Exactly. This means that the interest expense reduces the company's taxable income. So the company ends up paying less in corporate taxes.
It's like a small discount or a subsidy from the government for choosing debt financing.
Precisely. This makes debt a more attractive option from a tax efficiency perspective compared to equity.
Where dividends are typically paid out of after-tax profits.
Right. This tax shield is a major reason why companies consider using debt.
So, my dear students, just to check your understanding on this, if a company takes a loan to build a new factory, does it promise to pay back the original amount and interest forever? Or for a fixed, specific time period? Think carefully about what we just discussed.
What do you think? Excellent. You got it. It's for a fixed time. That fixed commitment is absolutely key for debt.
Right.
Now, let's shift our focus to the other side of the financing coin, Equity.
Okay, equity.
When a company issues equity, it's like it's selling small pieces of its ownership to investors.
Little slices of the company pie.
Exactly. These investors, in turn, become shareholders. They literally own a part of the company. It's like buying a slice of a very large and hopefully delicious cake.
Yes, and this is what we refer to as permanent financing. This is a huge fundamental difference from debt.
Permanent, unlike debt, which has an end date.
Right. Unlike debt, the company doesn't promise to pay back the money to these shareholders on a specific date. In fact, there's no maturity date at all.
Okay.
And crucially, there are no promised regular payments, like the fixed interest payments of debt.
So how do shareholders get returns then?
Shareholders are paid dividends, which are essentially a share of the company's profits. But, and this is important, these dividends are not fixed.
Ah, not guaranteed like interest payments?
Not at all.
Oh.
The company's board of directors decides whether to pay them or not and how much. It depends on the company's performance, its cash flow, its future investment plans.
So it's completely discretionary.
Completely. If the company has a challenging year, they might decide not to pay dividends at all or to reduce them significantly.
Yeah.
That's a big difference from debt obligations.
That flexibility must be good for the company.
It is. Now, to illustrate this permanent nature of equity, let's think of a very familiar example from our daily lives.
Okay.
Imagine a Kirana shop, a local grocery shop in your neighborhood. It's doing quite well, and the owner wants to expand.
Maybe add a fresh vegetable section or more stock.
Exactly. The owner approaches you and asks you to put in some money to help with this expansion.
Okay.
In return, you won't get your original money back on a specific date. The shop owner doesn't promise to buy back your investment after 5 years, for instance.
So no fixed repayment date.
Right. But you'll get a percentage of the shop's future profits. And importantly, you might have a say in how the shop is run.
Like advising the owner or being consulted on big decisions.
Perhaps.
Yep.
That, my dear students, is exactly like being an equity investor. You don't get your original money back on a specific fixed date, but you share in the shop's success.
Or unfortunately, it's failure too.
Yes. You become a part owner, sharing in the entire journey and its outcomes.
Okay, that makes sense. And because shareholders essentially get a piece of the profit that's left over after everyone else has been paid.
We say they have a residual claim.
Residual claim, meaning what's left over.
Exactly. They get whatever is left over after all other expenses have been settled.
And that includes payments to suppliers, salaries to employees, taxes to the government.
And most importantly, all the debt payments, both interest and principal that we just discussed, they are last in line.
Ah, okay. So if the company is very successful and there's a lot of profit left over,
Shareholders can earn a lot. There's theoretically no upper limit to their gains. Their upside is potentially unlimited.
but if the company struggles, if there's little or nothing left,
Then they might get nothing at all, or even lose their entire initial investment. This residual claim also means they bear the highest risk.
highest risk, but potentially highest reward.
Precisely. And this is where equity investors gain a powerful position that debt holders typically don't have. Unlike debt holders, who generally don't have a say in daily management, equity investors have what we call voting rights.
Voting rights. This is a very significant difference, isn't it?
It is. These rights allow them to vote on important company matters, like choosing the members of the board of directors.
And the board then appoints and oversees the top management, like the CEO.
Exactly. So shareholders, through their voting rights, effectively have a voice in how the company is steered and who manages it. This direct influence is a key benefit of equity ownership.
Right. And one very good thing for shareholders, a great protection for them, is limited liability.
Ah, yes, limited liability. Very important concept.
It means the most they can lose is the money they initially invested to buy the shares.
So their personal assets are safe.
Exactly. If the company goes bankrupt and owes a lot of money to its lenders or other creditors, shareholders won't have to pay extra money from their personal savings or sell their homes or other personal assets to cover the company's debts.
Only the money they put into the company itself is at risk.
Right. This protects individual investors from catastrophic personal financial ruin if a company fails.
A crucial protection.
So, my bright students, given what we've just discussed about the claims on a company's earnings, can you tell me, who has the first claim on a company's cash flow? Is it the debt holders or is it the shareholders? Who gets paid first?
Think back to that queue analogy.
Yeah.
Absolutely right. The debt holders are always first in line. That priority is fundamental.
Okay, great.
Now that we understand what debt and equity are individually, let's take a deeper look at them from two very important angles.
Two perspectives.
Yes, first, from the perspective of the company itself, which is the issuer of the debt or equity.
Okay, the company's view.
And second, from your perspective as an investor who is considering putting your hard-earned money into the company.
Our view as investors.
Exactly. These two perspectives are often quite different, and understanding the difference is crucial for any financial analyst.
Let's first consider this from the company's or the issuer's perspective. For the company itself, debt is actually riskier than equity.
Riskier for the company. Why is that?
It's because the company must make those promised interest and principal payments, come what may, regardless of whether they have a good year or a bad year financially.
Those fixed, non-negotiable commitments we talked about.
Exactly. If they don't meet these obligations, the consequences can be severe. Defaulting on the loan, being dragged to court.
Or even facing bankruptcy, where lenders can take over the company's assets.
Right. It's a very rigid financial commitment that can put a lot of pressure on a company's cash flows.
That makes sense.
To make this truly relatable for you, imagine you took a loan for a brand new car.
Okay.
Every single month, you have to pay the EMI, right? The equated monthly installment.
Yes, that payment is fixed.
Now, if your income suddenly reduces due to some unforeseen circumstance, maybe a job change or a business slowdown.
Paying that fixed EMI becomes a very risky and challenging burden for you personally. You'd feel that pressure, wouldn't you?
Definitely. That's exactly how it is for a company with debt. That fixed commitment is a significant source of operational and financial risk for them.
That's a perfect illustration of the issuer's risk indeed. Equity, on the other hand, well, it doesn't carry such fixed commitments for the company.
Right. We said dividends are discretionary.
Exactly. As we discussed earlier, the company isn't forced by a contract to pay dividends to its shareholders. If profits are low, or if the company needs to retain cash for growth,
Or just to survive a difficult period.
it can simply decide not to pay dividends that year or to reduce them. So, from the company's side, equity is a much less risky source of funding.
Because it offers far greater flexibility in managing its finances.
Yes, it doesn't create those rigid, obligatory outflows of cash.
But now, here's where it gets really interesting, students. Because for you as an investor, the person putting your money in, it's actually the complete opposite.
Oh, how so?
Equity, or buying shares of a company, is generally riskier than debt, or buying bonds issued by that same company.
Wait, if it's less risky for the company, why is it more risky for me as an investor? That seems counterintuitive.
It does seem that way at first. Let's explore why this inverse relationship exists.
Okay, please do.
Remember what we said. Shareholders have a residual claim.
Right, they only get whatever is left over after everyone else, including debt holders, has been paid.
Exactly. This means that if the company performs incredibly well, their potential earnings are unlimited.
No cap on how much they can make. They participate in all the extraordinary upside.
Right. But, and this is the crucial part, if the company performs poorly or even goes bankrupt.
They may lose their entire initial investment.
Yes. Bondholders, however, have their returns capped at the promised interest and principal payments.
So they don't participate in the huge upside.
But they have a much lower risk of losing their initial investment because they are paid first before shareholders in case of financial distress.
Ah, I see. So it's a trade-off. Less upside potential for debt holders, but generally more certainty and lower risk for their invested capital.
Exactly. Risk and return are usually linked. Now, let's make this concept of risk and return, and particularly the idea of financial leverage, which is simply using debt to finance assets, even clearer with a numerical example.
Okay, numbers usually help.
This will demonstrate both its power and its potential danger. Imagine two identical companies, both starting with 100 units of assets, just for simplicity.
All right, Company A and Company B assets equals 100.
Company A is 100% financed by equity, so it has 100 units of equity and 0 debt.
Simple structure.
Company B, on the other hand, is financed with 75% debt, so 75 units of debt, and only 25% equity, just 25 units of equity.
Okay, Company B uses leverage.
Both companies operate identically. They generate the same revenue of 100 units and incur operating expenses of 70 units for a given period.
Same operations, different financing.
Now, because Company B has debt, it also incurs an interest expense. Let's say this interest expense is 15 units.
Okay, 15 units interest cost for Company B, which means a 20% interest rate on its 75 debt, if anyone's calculating.
good point. Let's now compare their net income and their return on equity, or ROE.
ROE, return on equity. That's net income divided by shareholders' equity, right? A key profitability measure.
Absolutely. It tells us how much profit a company generates for each rupee of shareholders' equity invested.
Got it.
For company A, the calculation is straightforward. Revenue of 100 minus operating expenses of 70.
That gives a profit before interest and tax of 30.
Right. And since there's no interest, net income is 30. Its total equity is 100. So its ROE is 30 divided by 100.
Which is 30%.
Yeah.
Simple enough.
Okay.
Now let's look at company B, the one using debt. It also starts with revenue of 100 and subtracts operating expenses of 70. Same 30 profit before interest.
But then it also has to subtract its interest expense of 15.
Right. So 100 minus 70 minus 15 leaves a net income of just 15. Lower net income than company A.
Yes, lower net income. However, remember, company B only has 25 units of equity.
The denominator is much smaller.
Exactly. So its return on equity is 15 divided by 25.
Which gives us,
Yeah.
wow, 60%.
60%. See, company B, by strategically using debt, has a much higher ROE, 60%, than company A, 30%, even though its net income is lower.
And that's because the interest cost on its debt, 20%, is lower than the return the company is generating on its overall assets, which we saw was 30% for company A.
Precisely. This beneficial effect of using debt to boost equity returns is exactly what we call financial leverage.
It's like using a small lever to lift a very heavy weight, amplifying the return on equity.
That's impressive, isn't it? But here's the critical question. What happens if revenue changes? This is where the downside.
The double-edged sword of leverage.
Exactly, where that becomes apparent. Let's say, for instance, that revenue increases by 20% to 120 units, maybe a booming economy or a hit product.
Okay, good times. What happens now?
For company A, net income is now 120 minus 70, which is 50. So its ROE increases to 50 divided by 100, or 50%.
A good, healthy increase from 30% to 50%.
Right, but for company B, net income is 120 minus 70 minus the fixed 15 interest expense.
Which results in 35.
And its ROE jumps to 35 divided by 25.
Let me calculate. That's 140%.
140%. Look at that. Much higher upside potential for the leveraged company.
Wow, leverage really magnified the gain.
Yep.
But now, what if revenue decreases?
Ah, the risky part.
What if revenue decreases by 20% to 80 units? Maybe a market downturn or increased competition.
Okay, tough times. For company A, net income would be 80 minus 70, which is 10.
Still profitable, though lower.
Yes. Its ROE falls to 10 divided by 100, or 10%, lower than before, but still positive. The company is still making money for shareholders.
Okay, but for company B?
Net income is 80 minus 70 minus the fixed 15 interest expense.
80 minus 70 is 10.
Yeah.
Minus 15. Oh, that results in get a 5. A loss.
Yes, a loss. So its ROE is natted a 5 divided by 25.
Which is natted 20%, a significant loss. The company is now losing money for its shareholders.
See how much more volatile company B's ROE is compared to company A's.
Much more swingy. Higher potential return in good times, yes.
But also much, much higher risk and potentially significant losses in bad times. This example clearly shows that debt amplifies both the gains and the losses for shareholders.
It's a powerful tool, but one that must be wielded with caution and precision. It creates financial risk for the equity holders.
Definitely.
Let's consider another practical scenario, one that highlights how financing choices impact shareholder returns.
Okay.
Imagine a company with initial assets of 100 units. Let's say its assets are broken down like this: cash of 30, other current assets of 20, and long-term assets of 50.
Okay, assets total 100.
And this company is entirely financed by equity of 100 units. No debt initially.
Got it.
Now, this company wants to invest an additional 20 units in long-term assets, maybe to expand its factory or buy new equipment to grow.
Okay, needs 20 more for investment.
The question is, how does it finance this new investment? And what are the implications for its existing shareholders?
Right, there are choices, aren't there?
Right.
The company essentially has 3 main choices to finance this new 20-unit investment.
What are they?
First choice, issue new shares, equity. If the company decides to issue new shares to raise these 20 units of capital.
So, selling more ownership pieces.
Yes. Its total equity will now become 120 units, the initial 100 plus the new 20. Now, if we assume this new investment generates a return that keeps the overall return on equity, ROE, at, say, 30%.
Oh.
An important consequence here for existing shareholders is what we call dilution.
Dilution. What does that mean exactly?
It means because new shares have been issued, the existing shareholders now own a smaller percentage of a larger company. Even if the total pie is bigger, their individual slice of that pie has become proportionally smaller. Their ownership stake is diluted.
Ah, okay, so they own less of the company than before. What's the second choice?
Second choice, borrow debt. Alternatively, the company could take on 20 units of new debt.
Using leverage again.
Right. Let's assume this debt comes with a 20% interest rate, just for example. So the annual interest expense on this new debt would be 4 units.
Okay, 4 units of interest cost.
In this case, the existing equity remains 100 units because no new shares are issued.
Right, no dilution here.
If the new investment helps generate a certain net income, the ROE might then become, let's say, 32%.
Higher than the 30% in the equity scenario.
Yes. This is often a better outcome for existing shareholders than issuing new shares, primarily because there's no dilution of their ownership. And if the return generated on the new investment is higher than the interest cost of the debt,
Which it seems to be here.
it creates positive leverage for them.
Okay, debt looks better than equity issuance in this case. What's the third choice?
And the third choice, often the most appealing, if it's feasible, use cash on hand.
Ah, use the company's own savings.
Exactly. If the company has enough existing cash reserves, remember it started with 30 cash. It can simply use 20 units from its cash balance for the investment.
Okay, so cash goes down from 30 to 10.
Right. In this scenario, no new shares are issued and no new debt is taken. Equity remains 100 units.
No dilution, no interest cost.
Correct. And under certain assumptions about the returns, the ROE could become an impressive 36%.
Wow, that's the highest ROE yet.
Yes. This is often the best outcome for existing shareholders in this particular scenario, as it avoids both the dilution of their ownership and the additional interest costs associated with new debt. It effectively leverages existing idle capital.
So it clearly shows that the fundamental choice of financing, whether a company decides to use equity, debt, or its existing cash, significantly impacts the returns available to its shareholders.
Absolutely. Each method has its own distinct set of trade-offs affecting risk, control, and ultimately shareholder wealth.
Companies constantly weigh these choices based on their current financial health, market conditions, and strategic goals.
It's a critical decision. Now let's talk about something called payoff asymmetry for shareholders and debt holders.
Payoff asymmetry. Sounds complex.
It just refers to the fundamentally different ways their returns are shaped by the company's performance, especially when considering the firm's overall value. For shareholders, as we mentioned, there is theoretically an unlimited upside potential. If the firm's total value, let's call it V,
V for value.
grows to be significantly greater than the value of its outstanding debt, let's call that D,
D for debt.
then the shareholders get the entire difference. They get V minus D.
All the value remaining after debt is paid.
Right. The sky is truly the limit for their potential gains. But, and this is the significant downside,
That asymmetry part.
yes, if the firm's value, V, falls below the value of its debt, D, meaning the company becomes insolvent and can't cover its debt obligations.
Then shareholders typically lose their entire initial investment. They usually get nothing.
Exactly. Wiped out.
In stark contrast, for debt holders, their payoff is inherently capped.
Capped, meaning limited.
Yes, they receive their promised interest payments and the repayment of principal as long as the firm is solvent and meets its obligations. That's it. Regardless of how extraordinarily successful the company becomes or how much its value rises.
They don't participate in those extraordinary gains beyond their fixed interest.
Correct. However, if the firm value V falls below the value of its debt D, well, they can lose up to their initial investment.
So they can lose money, too.
Yes, but they do have that priority claim we talked about. The key difference is that if the firm becomes insolvent, debt holders typically take control of the remaining assets to try and recover what they can.
While shareholders, as we said, often end up with nothing.
Precisely. This is the fundamental asymmetry that drives many of the conflicts we will discuss next.
Okay, let's summarize the key differences in perspective between equity investors and debt investors. We can use some important attributes that financial analysts always consider.
Good idea. A quick summary.
First, tenor or duration. For equity, the investment is indefinite, meaning it's permanent financing with no maturity date.
While debt always has a specific term, like 3 months or 10 years.
Second, return potential. Equity offers unlimited potential for returns, no cap.
While debt is capped at the promised interest and principal payments.
Third, maximum loss. Interestingly, for both equity and debt holders, the maximum loss is typically limited to their initial investment.
That's similar for both.
Yes, thanks to limited liability for shareholders and the structure of debt contracts for debt holders, you generally don't lose more than you put in.
Good to know.
Fourth, Investment risk. Equity is generally considered higher risk because of its residual claim and the potential to lose everything.
While debt is lower risk due to its priority claim and more certain, though fixed, returns.
And fifth, desired outcome. Equity investors fundamentally want to maximize the firm's overall value, hoping for share price appreciation.
While debt investors primarily want the timely and certain repayment of their principal and interest. Safety first.
Exactly.
So my intelligence students, given these summarized points, what is the one thing that is similar for both equity holders and debt holders when it comes to the absolute maximum amount they can lose from their investment? Think carefully.
What did we just say was the same for both? You're absolutely right. Both face a maximum loss limited to their initial investment. This limited downside is a significant protection.
Great.
Now, you might be thinking, okay, both debt holders and shareholders want the company to do well, right? So what's the problem? Why would there be any conflict or disagreement?
But their interests, as we've seen, are not always perfectly aligned, my friend.
Exactly. Because their risk and return profiles are so fundamentally different, conflicts of interest can frequently arise.
Leading to fascinating dynamics within a company. Let's explore those conflicts now. #tag3. Conflicts of interest among lenders and shareholders. That's a very keen observation, and it leads us into a critical area of finance. These potential conflicts stem directly from the differing payoff structures we just discussed.
Right. Shareholders, by their very nature and the structure of their claims, want to maximize their residual cash flows.
Whatever is left over after everyone else is paid.
Precisely. Since their upside is theoretically unlimited, they are often incentivized to prefer the company to take greater risks.
On projects that have potentially higher returns.
Yes. Even if it means using more debt or leverage to fund those projects, they are chasing that amplified return we saw in the example.
They might also pressure the company to pay out higher dividends.
Exactly, which again uses up cash that could otherwise be used to pay down debt or for safer, more conservative investments. Their primary motivation is often aggressive growth and maximizing high returns for themselves.
Okay, so shareholders might like risk.
To put this in an Indian context, imagine a small sweet shop owner. He's built a loyal customer base, business is good, and now he dreams of becoming a big chain across the city.
Maybe even a national brand. Ambition.
Right. He might be very ambitious and aggressive, maybe borrowing heavily from banks or private lenders to open many new branches very quickly.
Hoping for huge exponential profits and rapid expansion.
Exactly. He thinks if this works, I'll be incredibly rich. He's willing to take that higher risk for the potential of higher, faster rewards.
That's very much the shareholders' motivation, isn't it? Betting on the big success.
It is. They embrace the risk for the potential reward.
On the other hand, debt holders like banks or bond investors, what do they care about most?
Getting their promised interest and principal payments on time every single time without fail.
Right. They don't really benefit from the company taking huge risky bets because their return is fixed and capped anyway.
They only get back what was promised, nothing more, even if the company triples its profits.
Exactly. In fact, more risk for the company actually means more risk for them that they won't get paid back.
So they prefer less risk.
Generally, yes. They prefer that management invests in less risky, more stable projects that increase the certainty and predictability of cash flow, ensuring their repayment.
Their primary motivation is the safety and security of their investment and its timely repayment rather than exponential growth.
Precisely. Now think about the bank that lent money to that ambitious sweet shop owner for his rapid expansion.
Okay, the lender's perspective.
What do they want from this venture? They just want their fixed EMI payment every month, like clockwork.
They don't want the owner to take too much risk.
Exactly. Because if the shop fails due to those overly risky ventures, the bank might not get its money back.
So how do they protect themselves?
To protect themselves, they might put very specific conditions or covenants in the loan agreement.
We mentioned covenants before, like what?
Clauses like, don't borrow from anyone else without our permission, or maybe maintain a certain minimum level of profit margin or cash balance.
Rules designed to keep the company financially stable enough to repay its debt.
Exactly, to protect the bank's money.
And since debt holders typically don't have direct voting rights to influence company decisions like shareholders do.
They rely on these contracts.
Yes, they protect themselves primarily through these contractual restrictions or covenants embedded within the debt agreements.
Things like limits on future debt or requirements to maintain certain financial ratios.
Correct. Like a minimum level of cash or a certain profit level relative to its debt. These rules are put in place to prevent the company from doing things that might primarily benefit shareholders, like taking on excessive risk for high returns.
But could, at the same time, make it harder for the company to repay its debt obligations in the future.
Exactly. It's all about protecting the debt holder's investment.
So tell me, dear students, considering these differing motivations and claims, why would a debt holder generally prefer a company to invest in less risky, more predictable projects?
Well, a shareholder might very well desire more risky ones. What's at the core of that fundamental difference in their outlook?
Think about their payoffs.
Yes.
You've absolutely captured the essence. It's all about their different payoff structures and risk tolerance.
The debt holder has a capped upside and prioritizes certainty, while the shareholder has unlimited upside and is willing to embrace more risk for greater potential rewards.
Perfectly summarized.
All right, let's broaden our view now. We've talked a lot about lenders and owners, but a company doesn't just operate for their benefit, does it?
No, not at all. It's actually part of a much bigger ecosystem in society.
And many other groups have a significant vested interest in its success, its operations, and its stability.
We call these groups stakeholders. Hashtag what's of meaty. Corporate stakeholders and governance.
Stakeholders, that's a key term.
Yes. A stakeholder is simply any individual or group that has a direct or indirect interest in a company.
And whose actions or well-being are affected by the company, or who can affect the company.
Exactly. Both ways. Think about it. A company's success or failure has ripple effects across a wide range of people and entities, not just those who put money into it.
So, as financial analysts, why do we need to understand these groups?
It's absolutely crucial because their actions, their demands, their overall well-being can significantly impact a company's performance, its reputation, and ultimately its long-term value.
Neglecting any key stakeholder can lead to unforeseen challenges and costs down the line. Let's list some of the main stakeholder groups that are typically involved with a corporation, building upon our understanding so far.
Okay, let's name them.
First, of course, are the debt and equity investors, whom we've just discussed at length.
They provide the vital financial capital,
Then there's the board of directors, a crucial group.
elected by shareholders to supervise the company's activities.
Right. Ensure it's run in the best interests of its owners while also considering other stakeholders.
Then the managers, led by the CEO.
They execute the board's strategic vision and run the daily operations.
Employees are indispensable. They provide the human skills, labor, innovation.
A human capital that keeps the company running.
Customers. The very reason a business exists. They buy the products or services.
No customers, no revenue.
Exactly. Suppliers provide raw materials, components, other goods and services needed.
Vital partners in the supply chain.
Governments are important too. They set the rules, collect taxes.
And provide public goods and services that companies benefit from, like roads and infrastructure.
And finally, don't forget, society in general and the environment.
These are deeply affected by the company's products, its operations, its pollution, its overall impact.
It's a wide net of interests.
It really is. Let's use a very common and relatable Indian example to illustrate how all these diverse groups come together around a single entity.
Okay, Indian example.
Think of a big textile factory located in a village or a semi-urban area. We see these often,
I
right?
have pictures.
Especially in states like Gujarat or Tamil Nadu.
Yes, very common sight.
Okay, so the people who bought shares in this textile company,
They are the shareholders. They own a piece of it.
the large bank that gave a substantial loan to build the factory or buy its modern weaving machines,
They are the debt holder.
the thousands of workers, from the shop floor laborers to the admin staff,
Those are the employees.
the wholesalers and retail shops that buy the cloth and garments produced,
Yeah, they're the customer.
the cotton farmers supplying the raw material, the companies supplying dyes and machinery,
Those are the suppliers.
the village panchayat, the local governing body, and the state government ensuring compliance.
They represent the governments.
And the local community living nearby may be using the river water affected by factory waste or benefiting from jobs.
That represents society and the environment.
See, all of these are vital stakeholders, and their interests are deeply interconnected with the factory's existence and operations.
A problem for one can quickly become a problem for all.
Exactly.
Now, historically, the main idea guiding corporate decision-making was what we call the shareholder theory of corporate governance.
Shareholder theory, what does that mean?
This theory, famously championed by economist Milton Friedman, basically states that the company's board and management should primarily focus on one main objective: increasing the wealth of the shareholders.
just the shareholders. What about the others?
The interests of other groups like employees, customers, or the community were considered only if doing so would eventually help increase shareholder value.
So it was a very narrow, profit-centric focus.
Yes. All decisions ultimately flowed back to maximizing returns for the owners.
But there's another, broader idea that has gained significant traction, especially in recent decades.
Called the stakeholder theory of corporate governance.
Right. What does that theory suggest?
This suggests that corporate decisions should actively consider and balance the interests of all stakeholders, not just shareholders.
So explicitly considering environmental impact or employee well-being or community contribution as core goals.
Exactly. Not just as a means to an end for shareholders, but as important goals in themselves. It's a much more holistic and inclusive view of corporate responsibility.
That sounds more complex, though. Balancing so many different interests must be challenging.
It is indeed a bit more complex, isn't it? Because balancing so many interests, some of which might even conflict in the short term, can be quite challenging for management.
But are these theories always opposed?
Not necessarily. It's important to note they aren't always at odds. Sometimes they actually align beautifully. For example, treating employees well, which is a core stakeholder interest, right?
Yes.
That can lead to higher productivity, lower employee turnover, a more positive work environment, which ultimately boosts profits and shareholder value in the long run.
Ah, I see. So a well-executed stakeholder approach can indirectly but powerfully serve shareholder interests, too.
By creating a more sustainable and resilient business, it's about long-term value creation, not just short-term profit.
Let's look at a fascinating real-world example of a strong stakeholder approach in action, involving a globally famous German car company, Volkswagen AG.
Ah, VW. What's special about them?
Well, in Germany, there's a distinct corporate governance model. The German state of Lower Saxony, where VW has its largest factories and is a major employer,
Okay.
obviously holds a significant 20% of the voting rights in the company.
The government holds shares.
Yes. And there's even a special Volkswagen law enacted decades ago. It requires over 80% of votes for major decisions to pass.
80%. That's a high bar.
It effectively gives the state veto power on critical strategic matters, like plant closures or major asset sales.
Wow, so the local government has a huge say.
They do. And what's truly remarkable is VW's supervisory board. Remember, Germany has that two-tier board system.
Yes, a supervisory board overseeing the management.
Right. VW's supervisory board is equally divided between labor employee representatives and shareholder representatives, 50-50.
Employees have half the seats on the supervisory board.
Yes. So in practice, the government, representing the state's interest, and labor representatives often work closely together to protect local employees and communities.
So they can block decisions that might hurt workers.
They can, and they have. They've vetoed things like plant closures or significant cost reductions that might adversely affect workers, even if those decisions might seem to immediately benefit shareholders.
That clearly demonstrates a very strong stakeholder approach. The interests of employees and the local community have real legal weight.
It's a different model from pure shareholder primacy, definitely.
It really is.
So, my dear students, if a company, maybe driven by its commitment to employee welfare and community relations, decides to build a brand new, state-of-the-art school for the children of its employees right next to its factory,
A very nice gesture.
is it acting purely according to the traditional shareholder theory or more towards the stakeholder theory of corporate governance? What do you think?
What's the primary driver there? Precisely. While there might be long-term indirect benefits to shareholders from improved employee morale and retention.
The direct motivation aligns strongly with the stakeholder theory, considering employee and community well-being directly.
Excellent. Now, let's take a deeper dive into some specific stakeholder groups we listed earlier, understand their unique interests, and influence more intimately.
Okay, let's zoom in.
When we speak about investors, we can distinguish between private debt holders and public debt holders, bond holders.
Right, we touched on this. Private debt holders, like banks giving direct loans.
Yes, commercial banks or other private financial institutions. They often hold a debt investment until its maturity. A key characteristic is that they typically have direct, often privileged, access to company management.
And access to non-public, sensitive financial information.
Often, yes. This direct access significantly lowers what we call information asymmetry and gives them a lot of influence over the company.
especially for smaller companies relying on one bank.
Exactly. They can impose detailed covenants and closely monitor the company's performance. They might even specialize in lending to companies that are in distress, providing crucial capital, but with very strict terms.
Okay. What about public debt holders or bond holders?
These are usually large institutional investors, pension funds, mutual funds, asset managers who buy bonds issued by companies in the public market.
And they rely more on publicly available information.
Primarily, yes. Financial statements, credit rating reports, public disclosures, they use that to make their investment decisions.
So they have less direct influence over daily operations.
Much less. They rely more on the terms of the bond indenture. That's the detailed legal contract negotiated when the bond was issued.
But what if the company gets into trouble?
Then it changes. If a company is in serious financial trouble and needs to restructure its outstanding public debt, these bondholders, acting collectively, can become very influential.
How so?
They often negotiate for things like equity stakes in the restructured company or greater control in exchange for agreeing to reduce the debt burden. So their influence can become significant in distressed situations.
Okay. Now, the board of directors. We said they're elected by shareholders.
Yes, and their primary role is to oversee management, set strategic direction, and ensure the company is run ethically and in the best interests of shareholders.
While also considering other stakeholders.
Right. They make critical decisions like hiring and firing the CEO and monitoring the overall performance of the company and its senior management.
Then boards include different types of directors.
Yes, inside directors, people who are part of management like the CEO or CFO, and independent directors.
Independent, meaning no material relationship with the company, no employment, family ties, big business dealings.
Exactly. These independent directors are vital for representing minority shareholders and providing unbiased oversight. They act as a crucial check on management power.
And good corporate governance standards often require a certain number of independent directors, right?
Yes, increasingly so. Standards set by stock exchanges or regulators often mandate a significant number of independent directors.
To ensure accountability and transparency.
Precisely. These standards also typically require diversity on the board in background, expertise, competencies to ensure a wider range of perspectives.
And we mentioned the two-tier board structure in some countries like Germany with VW.
Yes, where a separate supervisory board oversees the main management board. That supervisory board often includes diverse stakeholders, like employees or unions, providing an extra layer of oversight incorporating broader views.
Okay, one more thing about boards that affects corporate control. Staggered boards, what are those?
Staggered boards. In some companies, directors are elected in groups in different years, not all at once.
So maybe only 1/3 of the board is up for election each year.
Exactly. This means it takes several years to replace the entire board.
Which can make it harder for shareholders to quickly change management or take control.
Yes, can make it significantly harder to effect a major shift through a proxy fight. However, proponents argue it provides continuity, prevents short-term thinking, and shields the company from hostile takeovers.
Interesting trade-off. Okay, moving on to managers, led by the CEO.
These are the individuals responsible for determining and implementing the company's strategy, under the board's oversight and handling daily operations.
And their compensation often includes more than just salary.
Yes, often annual bonuses tied to short-term performance and multi-year stock-based incentives like stock options or restricted stock.
Why these stock-based incentives?
They're carefully designed to align the manager's financial interests with those of the shareholders. The idea is, if the company performs well and share value increases long-term, the managers benefit directly.
Theoretically motivating them to maximize shareholder wealth.
Theoretically, yes.
Yeah.
Though sometimes these incentives can also lead to agency problems, where managers might prioritize their own short-term gains over the company's long-term health.
A potential conflict there, too. Okay, employees, the human capital.
Absolutely essential. A company runs on the skills, knowledge, and labor employees provide.
And in return, they seek fair pay, benefits like health insurance and retirement plans.
But also opportunities for professional development, job security, and a safe, healthy work environment.
Some employees might form unions or even own shares.
Yes, unions negotiate collectively. And increasingly, companies offer employee stock ownership plans, giving employees a direct stake in the company's success.
Aligning interests again.
Yes. Next, customers. Absolutely vital, as we said.
They expect quality products or services at a reasonable price, good service.
Right. Their satisfaction directly impacts sales and profits. and large customers can exert significant influence.
And nowadays, customers care about more than just the product.
Increasingly, yes. They care about a company's environmental and social impact. They might choose to support companies with strong ESG practices
And social media means bad practices can quickly hurt sales.
very quickly. Boycotts can have a real impact.
Okay. Suppliers, they provide materials and services.
Yes. And they're often short-term creditors themselves, delivering goods and expecting payment within, say, 30 or 60 days.
So their primary interest is timely payment.
Primarily, yes. But they also often have a long-term interest in the company's stability and success, especially if they've invested heavily in integrating their systems with the company.
A mutual dependency. If the company struggles, the supplier might struggle too.
Exactly. Finally, governments. They play a crucial, multifaceted role,
Setting rules, collecting taxes.
ensuring compliance with laws on labor, environment, competition, consumer protection, and advancing the broader interests of citizens and the economy.
Corporations are a major source of tax revenue too.
Yes, funding public services. And governments can also be major customers themselves.
It's a complex web of stakeholders.
It really is. So, my bright students, thinking back to the different types of debt holders we discussed, which type is more likely to have direct, ongoing access to a company's non-public sensitive information?
Would it be a private lender like a bank or a public bondholder? What do you think?
Absolutely correct. Private lenders usually have that direct, continuous line to information, giving them unique insights and influence.
Excellent recall.
Finally, let's talk about something that's becoming incredibly important and increasingly central in finance, investment, and corporate strategy: ESG factors.
ESG. Environmental, social, and governance.
Yes. These are non-financial factors that investors are increasingly looking at, moving beyond just the traditional financial numbers.
To gain a more holistic understanding of a company's broader impact on the world around it and its long-term sustainability and resilience. Hashtag V, corporate ESG considerations.
Okay, ESG. Let's break down those three pillars. Let's start with environmental E factors. These are all about how a company impacts and is impacted by the natural world and planetary systems.
So things like climate change.
Yes, definitely. Does the company contribute to greenhouse gas emissions? What's it doing to reduce them? Is it affected by the physical risks of climate change, like rising sea levels or extreme weather disrupting its supply chains?
What else falls under E?
Things like pollution air and water pollution, which can lead to fines, cleanup costs, reputational damage.
Waste management, too.
Absolutely. Waste management. How responsibly does it handle waste? Is it minimizing, recycling, adopting circular economy ideas?
Yeah.
Or just dumping unsustainably?
Energy use.
Yes. Energy efficiency and the transition to renewable energy like solar or wind. Other important E factors include biodiversity loss, deforestation, water scarcity, all vital for the planet, and resource availability.
Okay, that's environmental. What about social S factors?
These relate to how a company treats people within its organization and in the broader community and manages its relationships.
So things like customer relations.
Yes, customer satisfaction and, crucially these days, data privacy. How a company protects sensitive customer data is paramount. Breaches lead to massive fines and loss of trust.
What about employees?
Key social factors include gender diversity and fair treatment of employees. Are there equitable opportunities? Is there discrimination?
And general working conditions.
Yes. Employee engagement and labor standards, fair wages, safe conditions, not just directly, but throughout the supply chain, ensuring no forced labor or child labor.
Human rights, more broadly.
Yes. Human rights in its footprint and supply chain. And also community relations. How does it interact with and contribute positively to local communities? Responsible CSR initiatives fall here.
Got it. And the last one, governance G factors.
Yes. These are all about how a company is led, run, and managed at the highest levels, ensuring accountability, transparency, ethical conduct.
So this covers the board of directors again.
Definitely. Board composition and effectiveness. Who's on the board? Are they independent? Do they have diverse, relevant skills? How well do they oversee management?
What else? Executive pay.
Yes. Executive compensation. Is CEO pay fair? Is it linked to long-term performance and sustainability or just short-term gains?
Corruption.
A big one. Bribery and corruption. Does the company have strong anti-corruption policies, internal controls, ethical guidelines? Transparency is key.
Shareholder rights.
Yes. Shareholder voting rights and how the company handles shareholder activism. Are shareholders given a real voice?
And ways for people to report problems.
Crucial. Whistleblower schemes. Secure, effective mechanisms for employees and others to report unethical or illegal behavior safely without fear of retaliation. Ensures internal checks.
Okay, E, S, and G. Now, historically, you said governance factors were easier for analysts to evaluate.
Generally, yes. The information was often clearer, more quantitative, legally mandated in public reports, and the consequences of poor governance, like fraud, were well understood.
But incorporating environmental and social factors was slower.
It evolved more slowly, partly because they were harder to measure and quantify. Consistent data was scarce,
But that's changing now.
rapidly. New reporting frameworks, better data availability. These E&S factors are becoming much more transparent and actionable for investors.
So why are ESG factors becoming so profoundly important now for both companies and investors?
There are three big interconnected reasons, students.
Okay, reason one.
Material financial impact.
Hmm.
In the past, some might have thought ESG issues were just nice-to-haves, purely ethical. But we've seen countless examples where companies and investors suffered huge financial losses.
Due to environmental disasters like oil spills.
Yes, or social controversies like massive data breaches, product safety issues, labor abuses.
Or governance failures like bribery or fraud.
Exactly. These issues now have a very real, tangible financial cost. They impact the bottom line, profitability, share price, valuation. Investors see these as significant financial risks.
Okay, material financial impact. Reason two.
Investor demand. There's a growing, strong demand from investors, especially younger generations, inheriting wealth or investing pensions,
What are they demanding?
that their investments not only earn returns but also align with their values, contribute positively to society and the environment. They want their money to do good, avoid supporting companies that cause harm.
So capital is shifting towards more responsible companies.
Significantly. And reason three,
Reason three.
government regulations. Governments globally are creating more stringent rules related to climate change, environmental protection, labor rights, social policies.
Forcing companies to adapt their practices?
Yes, forcing them to meet stricter ESG criteria. This turns what were once negative externalities costs borne by society.
Into internal business expenses that companies must account for and manage.
Exactly. Non-compliance can lead to massive fines and legal penalties.
You mentioned negative externalities. Can you explain that a bit more?
Sure. In the past, things like releasing pollution into a river or excessive water usage by a factory, these were often seen as costs effectively borne by society or the environment.
They didn't show up directly on the company's financial statements.
Right. But now, with increased stakeholder awareness, stronger regulations, better analytical tools, companies are increasingly forced to internalize these costs.
Meaning they have to account for them financially.
Yes. Either explicitly through fines, cleanup costs, higher operational expenses, or implicitly, maybe through reduced revenue if consumers boycott, or a higher cost of capital if they're seen as irresponsible or risky.
The costs are coming back to the company.
Precisely. Let's look at some powerful real-world examples that highlight the massive, often devastating financial impact of ESG issues.
Okay, real examples are always impactful.
For environmental risk, consider the tragic Vale Dam disaster in Brazil. Remember that, January 2019.
Yes, I remember hearing about it. A mining waste dam collapsed.
Yes. Owned by the multinational mining company Vale in Brumadinho. Millions of tons of mud spilled. Tragically, 270 lives were lost.
Terrible. And the environmental damage.
Severe contamination of the nearby Parapiba River with toxic mining waste. Vale was later accused of systematically hiding information about the dam's instability for years.
Just to protect its reputation and avoid disruptions.
Allegedly, yes. The consequences were immense.
Yeah.
Huge fines from the Brazilian government, removal from several ESG indices,
And payments to victims.
had to agree to pay USD $7 billion to victims' families and for extensive environmental repair. This shows the massive financial and devastating human cost of environmental mismanagement.
A stark example of e-risk. Okay, what about social risk? You mentioned data privacy.
Yes, it's a huge and growing social concern globally. When companies don't adequately protect sensitive customer data, the cost can be enormous.
Like the Equifax case.
Exactly. Equifax, a major U.S. credit reporting agency. In 2017, a massive data breach, identity and financial data of over 140 million U.S. citizens stolen.
Due to inadequate cybersecurity.
Yes. Equifax incurred hundreds of millions of dollars in expenses directly from the breach, legal fees, investigations, settlements, a direct financial hit from a social lapse.
Any other big examples?
Another very prominent one, Facebook. now Meta Platforms, the Cambridge Analytica scandal.
Ah, yes. Sharing user data without consent.
Yes, personal data of over 80 million users shared with a third-party consultancy without consent, allegedly used to influence voters.
And the consequences for Facebook.
A staggering USD 5 billion fine from the U.S. Federal Trade Commission, one of the largest ever, plus a significant loss of public trust and brand image.
Some say that even contributed to their rebranding to Meta Platforms.
Some analysts believe so. It truly highlights the massive impact of social issues like data privacy on a company's finances and long-term viability.
Okay, so risk is clear. What about governance risk?
Let's look at the infamous Siemens bribery scandal. In 2006, German police raided the headquarters of Siemens AG.
A very large, respected German industrial firm.
Yes, they uncovered one of the largest corporate corruption cases in history. Investigations revealed that paying bribes to foreign government officials to secure contracts was a standard operating procedure for decades.
Wow. How much money are we talking about?
Total bribery payments exceeded EUR 1 billion across various regions.
And the consequences for Siemens?
Incredibly severe. Hundreds of employees dismissed. Over EUR 3 billion in fines, disgorgement of profits, related costs from global authorities.
A massive financial hit.
And a complete overhaul of its leadership. Both the supervisory and managing board chairman resigned. For the first time in its 160-year history, Siemens hired an outsider CEO to lead its transformation.
That massive shakeup clearly demonstrates how crucial robust ethical governance practices are.
To a company's integrity, financial stability, long-term viability, poor governance can truly undermine an entire organization.
So how do financial analysts actually evaluate these ESG risks and opportunities in practice? You said it's getting easier?
Yes. Analysts now actively try to quantify the financial impact of ESG factors, even though it's still challenging sometimes.
They look at how these E, S, and G factors might affect future cash flows, cost of capital, operational efficiency.
Exactly. And consequently, the company's overall valuation. It's not just about compliance anymore, but about financial materiality. How does this ESG factor actually affect the numbers?
Can you give an example of how an analyst might do that?
Sure. Let's say an analyst observes that a hotel company has consistently high employee turnover. That's a social factor, right? Low employee satisfaction.
Okay.
The analyst might forecast higher operating costs for that company. Why? Because high turnover means lost productivity, maybe lower service quality impacting customers.
And increased expenses for recruiting new employees, temporary workers, training programs.
Exactly. Those directly hit the bottom line.
Okay, that's a negative impact. What about a positive one?
Conversely, if a food company announces it's switching to a more sustainable source for a key ingredient, maybe organic cotton, or sustainably sourced palm oil, that's an environmental factor.
Right.
And analysts might consider this a strong positive. They might even lower the discount rate used to value the company.
Why lower the discount rate?
Because the company might gain a competitive advantage, appeal to growing numbers of environmentally conscious consumers, strengthen its brand reputation.
And be seen as less risky in the long term.
Precisely, making it a more attractive investment. So the analyst adjusts their valuation model to reflect this lower risk or higher potential growth.
I see. Connecting ESG factors directly to financial forecasts and valuation.
That's the goal. So, my dear students, let's think about this. Can you think of why a big oil and gas company, one relying heavily on fossil fuels, why might it face something called a transition risk? That's an environmental factor. What could cause this specific type of risk for them beyond just immediate pollution?
What might happen as the world transitions away from fossil fuels? That's a very insightful answer. Recognizing the dynamic and evolving nature of these risks is key. The concept of stranded assets oil reserves that can't be profitably extracted or sold due to regulations or change in demand is certainly a powerful one for companies in fossil fuel industries.
Absolutely. It highlights future risks.
Yeah. So there you have it, our wonderful students. We've taken a comprehensive deep dive today into the fascinating and increasingly vital world of corporate finance and its many stakeholders.
We covered a lot of ground.
We explored the two fundamental ways companies secure money through debt and equity. We thoroughly examined how they differ, their risks and rewards for both companies and for you, the potential investor.
We also explored the potential conflicts of interest that can arise between lenders, the debt holders, and the owners, the shareholders.
Saw how their differing motivations, driven by unique risk-return profiles, can create friction and shape corporate decisions.
And Very importantly, we understood the broader ecosystem of corporate stakeholders and the growing significance of environmental, social, and governance factors.
ESG is truly transforming how companies are valued, managed, and perceived in the world today.
It really is.
Remember, understanding these foundational concepts is truly like learning the basic grammar of finance.
A very good analogy.
It will equip you to read, analyze, and understand the big financial stories unfolding around us every day. Whether it's news about a company taking a loan, issuing shares, or facing an environmental challenge.
This knowledge is your key to making sense of it all. It will be invaluable as you continue your journey in finance.
Absolutely.
Keep practicing, keep asking questions, and keep building your knowledge step by step. Just like in cricket, every run counts.
Yes, every concept you master adds to your score and brings you closer to your goals.
The world of finance is dynamic, but with these strong foundations, you are well prepared.
Thank you so much for joining us on this deep dive. We truly hope you found it insightful, enjoyable, and helpful for your studies.
Yes, thank you for listening.
Until next time, keep learning and stay curious.
All the very best for your studies, students. Namaste.
Namaste, and a very warm welcome to the deep dive. I am Jennifer, and I'm so pleased to be your guide today, along with my dear colleague. Imagine, if you will, that we are all sitting comfortably together in a friendly, quiet classroom, ready to explore a truly foundational subject. Today, we are embarking on a very important deep dive, especially for those of you who are just starting your journey in finance, perhaps as aspiring CFA students. Our chosen topic, our focus for today, is corporate governance. Now, this might sound like a rather big, formal, perhaps even a bit intimidating phrase, but please rest assured, by the end of our session together, you will feel completely comfortable and confident with this essential concept.
Namaste, my dear students. It truly is a great pleasure to have you join us today. Yes, corporate governance, that name, can sometimes make people feel a little nervous, as you mentioned. But I promise you, there is absolutely no need to worry. Our mission today, our shared goal, is to break this concept down for you, step by gentle step, into simple, easy-to-understand parts. Think of it, if you will, like building a very strong and stable house. We will lay each brick carefully, one by one, ensuring that you have a truly solid foundation upon which to build your future financial knowledge. And to make sure that every single concept we discuss is crystal clear as a calm morning, we are going to use many, many everyday Indian examples. Our deepest wish is to make finance truly accessible and understandable for each and every one of you.
That's precisely our intention. So what exactly will we be uncovering in this deep dive of ours? First, we will begin with the absolute basics, helping you understand the fundamental relationships that exist within any large business, any corporation. Then we will gently delve into the areas where conflicts of interest can quite naturally pop up. Just like how misunderstandings or differing opinions can sometimes arise, even within our own families or close communities, isn't it? After that, we will patiently explore the various clever mechanisms and smart ways that companies use to manage these relationships effectively and to lessen any potential risks. And finally, we'll discuss the very real-world impact, the serious risks that unfortunately come with poor governance, and on the beautiful flip side, the immense measurable benefits of truly strong and effective governance.
Yes, that is our roadmap for today. Our goal, my dear students, is to simplify, to demystify, and to make finance truly accessible and engaging for each one of you. So I wholeheartedly encourage all of you to listen closely with an open mind. Please do not hesitate to mentally ask questions as we proceed through our lesson. Imagine yourselves grasping each concept firmly. Let us now begin this wonderful journey of knowledge together, shall we?
All right, my dear students, let's begin our first section and gently unpack the very basics of corporate governance. We will start with a fundamental question. What exactly is a corporation and who are its stakeholders? When we use the term corporation, we are not merely talking about a small local shop or a single individual owner with just a few employees. No, we are speaking about a legal entity. This means it exists as a separate person in the eyes of the law, distinct from its owners. Think of it as a very large, highly organized business with a life of its own, you could say. Because it is so large and often so complex, many individuals and groups have a connection to it, far beyond just the people who initially started it or who own a part of it.
Very well explained. And this naturally brings us to a very important and often misunderstood term, stakeholders. Now, who exactly are these stakeholders, you might ask? Well, my dear students, they are any individuals, any groups, or even other entities that have an interest in or are in some way affected by the company's actions, its decisions, or its overall performance. It's not limited only to the owners or the people working directly inside the company. It is, in fact, a much, much broader group. To make this clear, let us use a familiar Indian example. Imagine, if you will, a grand cricket match, perhaps a thrilling test match that unfolds over several days. Who are all the different people who have a stake in that match? Of course, you have the players themselves on the field giving their best. Then there are the coaches guiding their teams and the umpires ensuring fair play. But beyond them, think of the millions of passionate spectators who buy tickets, who watch eagerly on their televisions, who are emotionally invested in every ball bowled. Then there are the TV channels that broadcast the match, the big sponsors whose names are proudly displayed on the players' jerseys and along the boundary ropes. And let us not forget the hardworking ground staff who tirelessly prepare the pitch and keep the stadium clean and ready. All these people, you see, have a stake in the match, do they not? They're all affected by its outcome and by how it is managed. Similarly, a company also has many, many stakeholders. The owners, of course, but also the employees who dedicate their time and talent, the customers who purchase its products or services, the suppliers who provide essential raw materials, the banks and bondholders who graciously lend it money, and even the government, which collects taxes and sets important regulations. All these diverse groups are deeply connected to the company.
That's such a wonderfully clear analogy. It truly brings the concept to life. Now, for you, our diligent students, here's a little question to ponder. Can you think of just one stakeholder in your local Kirana shop, apart from the shop owner himself and the customers who buy things? Take a moment, think carefully about who else might have an interest.
All right, my dear students, let us now move on to another fundamental concept in corporate governance. This one is called the principal-agent relationship. This is a truly core idea, so please pay close attention. Simply put, this relationship is formed when one party, whom we call the principal, hires or asks another party, the agent, to perform a specific task or a service on their behalf. The most crucial aspect here, Pataji, is that the agent is expected, and indeed morally obligated, to act entirely in the principal's best interest. This relationship, surprisingly, can even exist without a very formal written contract. Sometimes it is simply based on trust and clear expectations. To illustrate this, let us use another everyday example that I am sure you can easily relate to. Imagine for a moment that you are diligently planning your dear sister's wedding, a truly grand and important event for your family. In this scenario, you are the principal. You then decide to hire a professional wedding planner to manage all the intricate arrangements, from the venue bookings to the catering and beautiful decorations. That wedding planner is your agent. Now, what do you, as the principal, expect from this wedding planner? You naturally expect them to make decisions that are truly the best for your sister's wedding, do you not? You would not want them to choose vendors simply because they receive a secret, bigger commission for themselves, or to cut corners that would unfairly affect the quality and beauty of the celebration, would you? No. You expect them to prioritize the success and the splendor of the wedding, which is your ultimate interest, over their own unnecessary personal benefit. That, my dear students, is the very essence of a principal-agent relationship.
That's a perfect illustration. It makes the concept so relatable. Now, let's apply this vital understanding to the world of a corporation. Here's where it truly gets interesting. In a corporation, the shareholders, these are the individuals or entities who own a part of the company, are considered the primary principals. They are the ultimate owners. However, imagine trying to run a very large company, perhaps one with thousands or even millions of shareholders. If each of them tried to manage it day to day, it would be impossible, wouldn't it?
Yeah.
So what do the shareholders do? They wisely elect a board of directors to oversee the company's strategic direction and management. This board of directors acts as their first set of agents. Then this board, in turn, appoints the managers. This includes the CEO, the CFO, and all the other executives who actually run the business on a daily basis, making countless operational decisions. These managers are another set of crucial agents. So you see, it's like a well-structured chain of command, a careful delegation of responsibility. And the ultimate goal for all these agents, both the board of directors and the managers, is to work diligently towards maximizing the value for the shareholders because, let us remember, the shareholders are the owners, the principals.
Excellent, excellent explanation. Now, just to ensure that this concept is truly settled well in your minds, a quick question for you, my bright students. If you were to ask your younger brother or sister to go to the electricity board office and get the electricity bill paid at the counter, who would be the principal and who would be the agent in that specific task? Take a moment to think carefully about it.
Okay, my dear students, let us now delve into some of the inherent challenges that can arise within these principal-agent relationships. One of the biggest and most common challenges is something we call information asymmetry. Now, this might sound like a rather technical term, but its meaning is quite simple. It means that one party in a relationship possesses more, or perhaps better, information than the other party. It's a bit like when you are playing a game and one person, unknown to the other, knows a secret rule that gives them an advantage. Think about it this way. When you visit a doctor, for instance, the doctor has spent many, many years studying medicine. They have access to your detailed medical history, and they understand complex diagnoses and treatments far more deeply than you, the patient, do. The doctor you see has a lot more information about your health and medical conditions than you do, isn't that right? This is a classic everyday example of information asymmetry. Similarly, in a large corporation, the managers who are involved in the day-to-day running often possess far more detailed and real-time information about the company's operations, its true financial health, its hidden risks, and its emerging opportunities than the distant shareholders ever could.
Precisely. And it is this very information asymmetry, this imbalance of knowledge, where the conflicts often begin to arise. Bataji. Because when the interests of the principal and the agent are not perfectly aligned, or when their goals diverge, meaning they begin to go in different directions, that is when you start to observe problems. These conflicts, which very often stem from that underlying information imbalance, ultimately lead to what we call agency costs. Let us take another simple, relatable example from our daily lives. Imagine you hire a driver for your family car. You are the principal, and the driver is your agent. Now, what if you start to suspect that he is taking longer routes than absolutely necessary, perhaps to burn more fuel, and then charging you extra for it? That, you see, is a clear conflict of interest, isn't it? His interest, perhaps making a little extra money on fuel or time, is diverging from your interest, which is to save money on fuel and travel time. The time, the effort, and the money you then spend to monitor his routes. Perhaps you decide to install a GPS in the car, or you begin checking the odometer readings more frequently. All those efforts and expenses you incur to try and ensure he acts purely in your best interest. Those are what we refer to as agency costs. Now, my dear students, these agency costs can broadly be categorized into two main types. Firstly, we have direct agency costs. These are the measurable, the tangible costs that you can literally put a number on. For example, the shareholders of a public company, who are the principals, might choose to pay for an independent auditor who is actually another agent, mind you, to come in and thoroughly check the company's financial statements and its internal control systems. Why do they do this? To ensure that the managers, who are their primary agents, are not misstating financial reports or engaging in any fraudulent activities. The fees, the amount of money paid to this independent auditor, are a direct agency cost, borne by the shareholders but deemed necessary to protect their investment. Then secondly, we have indirect agency costs. These are much harder to measure in terms of actual money spent, but they're still very, very significant. They include things like valuable business opportunities that are missed or profits that are foregone because of the agent's actions not being entirely in the principal's best interest. Perhaps the manager, being overly cautious, avoids a potentially great but slightly risky project, leading to lost future profits for the shareholders. That, my dear students, is an indirect agency cost.
That's absolutely fascinating. The distinction between direct and indirect costs is very important. So, just to help you recap this crucial part, my bright students, what precisely is information asymmetry, and why can this phenomenon sometimes lead to problems between a principal and an agent in their relationship? Take a moment now to recall our discussion and formulate your answer. Pause.
All right, my dear students, now that we have a clear understanding of the basics of the principal-agent relationship and the subtle yet powerful role of information asymmetry, let us delve deeper into precisely where these conflicts tend to arise within a large corporation. What is truly fascinating here, and quite a challenge, is that while directors and managers are morally and legally supposed to act solely in the shareholders' best interest, they consistently possess more inside information about the company's true performance, its potential hidden risks, and its emerging investment opportunities than outside shareholders or lenders ever will. This inherent information asymmetry makes it quite challenging, does it not, for shareholders to fully assess how well their agent, that is, the directors and managers, are actually performing. And quite frankly, it makes it even harder for shareholders to identify and perhaps remove poor performers. This information gap becomes even more pronounced in very complex companies, those operating across many different markets or selling very intricate products, and especially in companies where there isn't a lot of institutional ownership, meaning fewer large professional investors keeping a close, watchful eye.
That is indeed a critical point. And what makes this even more interesting is that while compensation, meaning what managers are paid for their efforts, is typically the primary tool companies use to try and align these diverse interests, it can, perhaps ironically, also become a major source of conflict itself. Let us now look at some common ways the interests of managers and shareholders can diverge, or as we say, go in different directions. Firstly, my dear students, we often observe insufficient effort. Imagine your local sweet shop, that famous one, known throughout the town for its absolutely delicious, crispy jalabis. What if their star sweet maker, who used to work tirelessly from dawn till dusk, now starts spending more and more time simply scrolling through social media reels and chatting with friends on his phone, rather than focusing diligently on preparing those perfect, golden, crispy sweets? This, you see, is a classic example of insufficient effort directed towards the shop's core goals. Similarly, in a corporate setting, managers might not work hard enough. They might avoid taking tough, unpopular decisions, such as closing down unprofitable business lines that are draining resources. Or they might become overly involved in outside activities, perhaps political work or charitable efforts, or even serving on multiple other company boards, thereby allocating too little of their valuable time and focus to their main role, which regrettably dilutes their effort for your company. Secondly, we encounter inappropriate risk appetite. This is quite a nuanced point, so please listen carefully. If managers receive a significant portion of their pay in stock grants and options, meaning they stand to profit a great deal when the company's share price goes up significantly, but they do not lose much if it goes down, they might be incentivized to take excessive risks. They might perhaps engage in highly speculative projects because they are truly chasing that big upside potential. They want to hit a financial home run, so to speak. But on the other hand, if these very same managers receive very little stock-based pay and mostly cash, they might then become too risk-averse. They might completely avoid good, potentially highly profitable projects just because those projects involve some degree of risk, preferring to protect their steady cash income. This, you see, can be directly at odds with what shareholders often desire, especially since shareholders themselves can easily diversify their own investments across many different companies and might prefer that this particular company takes on higher risk, higher reward ventures to maximize its potential.
Yes, and another very common divergence we observe is what we call empire building. My dear students, managers' pay and their professional status are quite often directly linked to the sheer size of the company they manage, for example, based on its total sales figures or the overall number of employees it has. This can give them a very strong incentive to pursue growth for growth's sake, even if that growth does not actually increase the company's value for the shareholders. They might, for instance, go after large, perhaps even unnecessary acquisitions that simply make the company bigger, but not necessarily more profitable. Think of a branch manager of a very large bank. Her bonus, you see, might be directly tied to the total number of branches under her management. So she might keep opening new, perhaps even unprofitable branches, just so she can proudly say, "My region has the most branches," even if it ultimately drains the company's overall resources and does not make good financial sense for the shareholders. That, my dear students, is a classic example of empire building. Closely related to this, my students, is the concept of entrenchment. Directors and managers, being human beings, quite naturally want to keep their jobs, especially if those jobs are comfortable and well-paying. So they might consciously or unconsciously adopt tactics to stay put. This could include avoiding controversial but absolutely necessary decisions that might upset some stakeholders, or simply copying what competitors are doing rather than truly innovating, or getting involved in excessively complicated transactions that only they truly understand, thereby making themselves seem indispensable to the company. Sometimes the independent directors on the board might even avoid speaking out strongly against management, even when it is clearly in the company's absolute best interest to do so, just to maintain harmony or protect their own comfortable position on the board. And finally, we have what is known as self-dealing. This occurs when managers exploit company resources purely for their personal gain. This can manifest in various ways, ranging from excessive perks, such as using the company's private airplane for personal family trips, or enjoying extravagant club memberships, or even outright misusing company assets for their own private benefit. The unfortunate truth is, my students, the smaller their personal ownership stake in the company, meaning the less they own of the company themselves, the less they personally feel the pinch of these costs. If a manager owns very little of the company, the cost of that private jet ride for personal use is spread out among all the thousands of shareholders, so they do not feel the full financial burden directly. This, tragically, reduces their motivation to truly maximize the firm's value for everyone else.
Those are very clear examples of potential conflicts. So, to ensure you've understood, my dear students, if a company's CEO decides to invest in a very risky project primarily because his personal bonus is directly tied to achieving massive growth, what kind of conflict of interest might this particular situation represent? Take a moment now to think carefully about the motivations we just discussed. Pause. That was a very thorough and important explanation of how the interests of managers and shareholders can sometimes clash. Now, let's consider another vital dynamic: the potential for conflicts between different types of shareholders themselves. It is crucial to understand, my dear students, that shareholders are not always a single unified group, all wanting the exact same thing from the company. Share ownership can be dispersed, which means there are many, many shareholders and none of them hold a dominant amount of control over the company. Or it can be concentrated, where one individual or a specific group, such as a founding family or another large company or even a government entity, holds a very significant controlling stake in the business.
Yes, you are absolutely right. Even among shareholders, interests can indeed differ quite significantly. Bataji. For instance, a founding family, which perhaps built the company from scratch, might have a very large portion of their personal wealth directly tied up in that company's stock. Because of this, they might prioritize the company's long-term stability and perhaps desire that management diversifies the company's business activities to reduce risk for their own concentrated wealth. But this desire might be completely at odds with what minority shareholders, these are the smaller individual investors, truly want. These minority shareholders might already have diversified portfolios across many different companies and would simply prefer that management focuses its efforts laser-like on maximizing this specific company's value, rather than diversifying its business, because they can achieve diversification for their own investments much more cheaply and efficiently elsewhere. Conversely, a controlling shareholder might have a very long-term perspective, perhaps looking multi-year or even multi-decade into the future, while some minority shareholders might be looking for quicker profits from strategies like aggressive cost-cutting, selling off company assets, or immediate share repurchases.
Here's where it truly gets interesting, and indeed can lead to very significant issues: the concept of dual-class share structures. This, my dear students, is very, very important to understand clearly. In this particular setup, a company issues two distinct types of shares. You might have Class A shares, which typically carry one vote per share, and these are usually the shares that are publicly traded on the stock exchange, readily available for anyone to buy. But then there are Class B shares, which might carry many, many votes per share, sometimes 10 votes, sometimes 100, or even an astonishing 500 votes per share. And these powerful Class B shares are typically held by company insiders like the founders or the founding family. What the structure does, you see, is allow the founders or insiders to maintain significant control over the company, even if they own a relatively smaller percentage of the total number of shares in terms of economic value. They can effectively control board elections, major strategic decisions, and other big corporate matters. Crucially, they can also avoid diluting their voting power if the company needs to issue new shares to the public to raise capital. Let's look at a very relatable, real-world example to make this concept concrete. Think of a large, traditional Indian family business that has been successful for many generations. Now, the family decides that they want to take the company public to raise more money for expansion from outside investors, but they absolutely do not want to lose control of the beloved business that their ancestors built. So what might they cleverly do? They could decide to issue public shares, Class A shares that everyone buys, with just one vote per share. But the founding family would then keep special family shares, these powerful Class B shares that carry, say, 100 votes each. Even if the family ends up owning, for example, only 30% of the company's total economic value through these shares, they could still control the majority of the voting rights and thus control the company, all its strategic decisions and board appointments. This ensures their legacy and influence remain strong. A well-known global example of this is Magna International Inc., a very large Canadian auto parts company. Its founder, Frank Stronach, created a dual-class structure where Class A shares had one vote, but Class B shares had an incredible 500 votes each. Can you imagine that power difference? Stronach and his family only owned about 3% of the total shares, but because they held these immensely powerful Class B shares, they controlled an astounding 75% of the voting rights. Now imagine you are a regular investor holding Class A shares. You see the founder and his family receiving millions of dollars in consulting fees, salaries, and bonuses, even when the company's stock price wasn't performing particularly well. Shareholders became very, very frustrated by this disproportionate power and the high personal fees being paid to the founder. Eventually, through a significant shareholder push, they actually managed to force a change to a single-class share structure, thereby equalizing voting rights. The CFA Institute has long advocated against such dual-class structures precisely because they give such disproportionate power to one group of shareholders, potentially allowing them to override the will of the majority for their own personal interests, which is not good governance.
It truly highlights the potential for a severe power imbalance, doesn't it? Now, for your understanding, my dear students, what is the main problem that a dual-class share structure can create for minority shareholders, those who own the shares with less voting power? Take a moment now to think deeply about this. Pause. Very good. Now, let us gently shift our focus to another significant area where interests can diverge quite sharply: the relationship between the shareholders and the creditors. Creditors, if you recall from our earlier lessons, are individuals or entities who lend money to the company, like banks or bondholders, and they naturally expect to be paid back with interest. While both shareholders and creditors have valid claims on the company's cash flows, their interests can quite significantly clash because of the fundamental difference in the nature of their claims. Think about it this way, my dear students. Creditors, those who lend money and have a fixed claim, almost like a loan you yourself need to repay, are generally quite risk-averse. They want their money back safely and precisely on time with the agreed-upon interest. So they naturally prefer that the company takes actions that will ensure it can always reliably repay its debt. This often means they prefer the company to raise more equity, which is money from the owners or shareholders, and to limit shareholder distributions, such as dividends, which take money out of the company and reduce its cash reserves. On the other hand, shareholders, who are the owners and only get what is left after all creditors are paid, tend to prefer greater leverage, meaning taking on more debt. This is because debt, if used wisely, can sometimes boost returns on equity if the company performs well. And of course, they generally prefer larger shareholder distributions in the form of dividends rather than issuing new equity, which would dilute their existing ownership percentage and potentially reduce the share price. You can clearly see the natural conflict of interest here, can you not?
It's just like a family saving diligently for a grand wedding, my dear students. The family, which represents the shareholders, might want to spend very generously on a lavish celebration, perhaps even taking a substantial loan to ensure the wedding is truly spectacular. But if they've taken a significant loan from a bank, which is the creditor in this case, the bank will quite naturally prefer that the family saves money, perhaps by cutting back on some of the extravagant fireworks or the super fancy food, and ensures the timely repayment of the loan first rather than spending it all on luxuries. That perfectly illustrates the difference in priorities, doesn't it? And this potential conflict, by the way, is even greater when we talk about long-term debt, because over a long period, the company's business conditions, its overall strategy, and even the management team can change significantly, thereby exposing the debt holders to more risk. This is precisely why long-term creditors often cleverly put contractual limits on how much debt a company can take on and how much it can distribute to shareholders through something very important called covenants in the loan agreements. Let's consider a practical example, my students, to illustrate this further. Imagine a company called KLD Marine Ltd. KLD is a small, debt-free company that manufactures beautifully welded metal boats. It happens to be the primary employer in a small, remote town, with about half of its 50 employees being highly specialized aluminum welders. KLD sells its boats through a network of independent dealers, and its main supplier is a large, multinational aluminum company. Now, KLD has never paid dividends to its shareholders, instead wisely keeping its earnings within the company to finance its growth. However, just recently, KLD made a surprising decision. It decided to borrow heavily from a bank to pay a very large one-time dividend to its shareholders. Now, I want you to think carefully. Which of the following stakeholder groups do you think would be most negatively affected by this sudden and significant increase in debt? Would it be the specialized welders employed by the company's dealers, or the large multinational supplier of aluminum to the business? If you thought about the welders, my dear students, you are absolutely spot on. They would indeed be the most negatively affected. Why? Because if the company were to get into severe financial distress due to this heavy debt, they could very easily lose their jobs. And since their skills are very specialized and they live in a small, remote town, it would probably be very, very difficult for them to find another local job. Their livelihood, their very future, is directly tied to the company's financial stability. The dealers, on the other hand, might suffer some lost sales if KLD were to fail, but they can likely switch to selling another boat brand fairly easily, as there are other manufacturers. and the aluminum supplier. They would probably suffer the least impact because they are a large multinational company, and KLD is likely a very small customer for them, so losing KLD wouldn't be a huge blow to their overall business. You see, the impact of a company's financial decisions, especially regarding debt, can ripple through different stakeholder groups in very different and unequal ways.
Very insightful. Such a clear example. Now, to quickly check your grasp on this important point, my dear students, why do debt holders, those who lend money to a company, generally prefer that a company raises more equity, meaning money from its owners, rather than taking on more debt? Take a moment to think about this fundamental preference. Pause.
Wonderful. So we have carefully explored the various stakeholders and the potential conflicts that can unfortunately arise between them. Given this complex web of relationships and sometimes diverging interests, having a truly sound corporate governance structure is absolutely crucial for any company to thrive and sustain itself. It is, in essence, about striking a delicate balance among all these different interests while still ensuring the company effectively achieves its primary business objectives. You can think of it like a skilled tightrope walker, gracefully balancing many poles to stay steady and reach the other side.
Precisely. A good governance structure ensures that the company not only adheres to all the rules and regulations imposed by outside authorities, like the government and various regulatory bodies, but also that it thoughtfully meets the unique needs and expectations of its internal stakeholders. You can truly think of it like having a well-organized and harmonious family, my dear students. In a good family, everyone has clear roles, clear responsibilities, and there are agreed-upon rules and shared values that everyone follows respectfully. This brings harmony, reduces friction, and helps the family achieve its collective goals effectively. A sound corporate governance structure does precisely the same for a company. It provides the framework for efficient operations and sustainable growth. Now, my dear students, let us talk about some of the specific mechanisms that companies intelligently use to manage these intricate relationships and to mitigate various risks. One of the most fundamental of these mechanisms, indeed, is corporate reporting and transparency. This is truly foundational to good governance, like the very ground you stand on. Without clear, consistent, and reliable information being openly shared, how can external stakeholders like shareholders, potential investors, or even discerning customers truly understand the company's performance, its risks, and its overall financial position? Their ability to advocate for their interests or to make informed, wise decisions would be very weak, would it not?
Absolutely. It would be almost impossible for them to make wise decisions without proper information. And because it is so incredibly important, this reporting is often mandated and regulated by specific laws and by the strict requirements for listing on stock exchanges. So for public companies, those whose shares are actively traded openly on a stock exchange, investors have access to truly extensive information. This information comes through carefully prepared annual reports, special proxy statements, official company disclosures, and dedicated investor relations departments. This treasure trove of information includes detailed insights about the company's operations, its strategic objectives, meticulously audited financial statements, its governance structure, who owns what, how management is compensated, any transactions with related parties, and all the key risk factors that could affect the business. In most countries and on most reputable stock exchanges, it is actually a legal requirement that a listed company's annual financial statements are rigorously audited by independent third-party auditors. This adds a crucial layer of credibility and trustworthiness to the numbers. Now, for private companies, those that are not publicly traded, they typically disclose much less information publicly, mostly to their own private investors. The specific content and form of that information are directly negotiated between the company and those investors, so it's not standardized like public company reporting. Also, formal audits are not always strictly required for private companies, though getting one can definitely improve their terms when they are seeking new investment or loans.
You see, my dear students, investors rely very heavily on these corporate reports and the information they contain for several critical reasons. Firstly, they use this information to carefully assess the company's performance and, crucially, the performance of its directors and managers. Are they truly doing a good job? Secondly, this vital information helps them make informed valuation and investment decisions. Should I buy, should I sell, or should I hold shares in this company? Thirdly, it enables them to thoughtfully vote on key corporate matters or propose changes at company meetings, exercising their ownership rights. And fourthly, it helps them ensure that the company is fully complying with its legal commitments outlined in debt contracts. For bondholders, who are often many and spread out across the world, it's impractical for each individual bondholder to track all these requirements. So a financial intermediary called a trustee is often hired to report on and manage payment administration for bondholders, ensuring their interests are diligently protected.
That's a very comprehensive overview. So, a simple question for you, my bright students. Why is it considered so important for public companies to disclose so much detailed information to the public, sometimes even about their internal policies and operations? Think about the fundamental reasons we have just discussed. Pause. Now, my dear students, let's talk about the specific shareholder mechanisms. As the residual owners of the company, meaning they get what is left over, the residual, after all other claims have been paid, shareholders possess various control mechanisms to diligently protect their ownership claims and interests. These important rights and mechanisms are often formally established and strongly protected by national laws. Firstly, we have shareholder meetings. The most common and widely known is the annual general meeting, or AGM. This is typically held once a year, often at a fixed time. At the AGM, shareholders gather to discuss and vote on important matters that are not delegated to the board of directors for day-to-day decisions. Common topics for a shareholder vote at an AGM include electing new members to the board of directors, formally appointing the independent auditor for the company for the coming year, approving the annual financial statements which detail the company's performance, deciding on dividends to be paid, approving the compensation for directors and auditors, and sometimes even a non-binding say-on-pay vote, where shareholders express their collective views on executive compensation plans, providing important feedback to the board. Beyond the AGM, there are extraordinary general meetings, or EGMs. These special meetings are called when other urgent resolutions need immediate shareholder approval, or if a specific minimum number of shareholders formally request such a meeting, as detailed in the company's bylaws. The topics at an EGM are idiosyncratic, meaning they are specific to that urgent situation, but they often include things like special elections for board members, amendments to the company's bylaws, major mergers and acquisitions, significant capital increases, or even the serious decision to liquidate the company. Now, for shareholders who are unable to attend these meetings in person, they can still participate very effectively through proxy voting. This is where they formally authorize another party, known as a proxy, to vote on their behalf, often by submitting a ballot electronically or through the mail. This proxy voting is, in fact, the most common way investors participate in these general meetings, especially for large dispersed shareholder bases.
That's very true. And speaking of shareholder participation, another increasingly powerful mechanism, my dear students, is shareholder activism. This is when investors, particularly large and influential ones, actively try to compel a company to act in a desired manner. While the primary motivation of these shareholder activists is usually to increase shareholder value relatively quickly, they want to see the stock price go up significantly. Sometimes their activism also involves social, political, or environmental considerations. Hedge funds are among the most prominent shareholder activists, Bataji. Why? Because their fees are largely tied to the returns they generate, giving them a significant financial stake in the success of their campaigns. They can also take very large positions using borrowed funds, which isn't always possible for other types of institutional investors. These activists employ various tactics, such as initiating proxy fights, where they try to persuade other shareholders to vote for their chosen board members to gain control proposing shareholder resolutions at meetings, and very often publicizing issues of contention to put direct pressure on management through public opinion.
And sometimes this activism can unfortunately escalate to shareholder litigation, which simply means legal lawsuits. One prominent type is a shareholder derivative lawsuit. This isn't about financial derivatives, but rather a legal proceeding initiated by a shareholder who believes they are acting on behalf of the company itself, because the existing board or management has failed to act adequately for the company's benefit. For instance, if management wastes valuable company assets through negligence, a shareholder might sue them on behalf of the company to recover the losses. However, it's important to note that laws in many countries restrict such lawsuits, sometimes by imposing minimum shareholder interest thresholds for filing, or even prohibiting them altogether to prevent frivolous cases.
Then, my dear students, we have corporate takeovers, which are essentially significant changes in corporate control. These can be pursued in several strategic ways. One is the proxy contest, or proxy fight, which you mentioned earlier. This is when a group actively tries to persuade existing shareholders to vote for their nominees to gain control of the board of directors. Another method is a tender offer, which is an invitation extended directly to shareholders to sell their shares at a specific price to a group that is trying to gain control of the company. And finally, there are hostile takeovers, which are attempts to acquire a company without the consent or cooperation of its current management. Now, to protect themselves from unwanted takeovers, companies often wisely adopt what we call anti-takeover measures. One very common one is staggered board elections. This means that instead of electing the entire board of directors every single year, only a portion of the board, perhaps say 25% or one-third, is elected each year. This effectively dilutes shareholder voting rights in the short term because it takes several years to completely replace the entire board, making it much harder for activist investors to gain control quickly. Another powerful anti-takeover measure is called a shareholder rights plan, more commonly and vividly known as a poison pill. This plan allows existing shareholders to buy additional shares at a significant discount if another shareholder acquires a certain percentage of the company's shares. This makes takeover much more expensive and thus unattractive for the potential bidder, deterring unwanted acquisitions.
Phew, that's a lot of important mechanisms for shareholders. So, to check your understanding, my dear students, what is the main purpose of an annual general meeting, AGM, for shareholders? Take a moment to recall the key activities that take place there. Pause. Now, my dear students, just as shareholders have various mechanisms to protect their interests, so do creditors like banks and bondholders. Their rights and protections are firmly established by national laws and, very crucially, by the specific contracts they have entered into with the company. One very important mechanism, especially for bondholders, is the bond indenture. This is not just a simple document. It is a meticulously prepared legal contract that comprehensively describes the entire structure of the bond, the company's detailed obligations, such as how and when it will repay the loan, and the interest payments, and very importantly, the specific rights of the bondholders. This indenture often includes specific covenants, which are legally binding terms and conditions that either require the company to do certain things, for example, maintain a certain financial ratio, like not letting its debt-to-equity ratio get too high, or prohibit it from doing other things, like taking on too much new debt without approval, or paying out too much in dividends that could jeopardize repayment. Sometimes, specific assets of the company might even be pledged as security, meaning if the company defaults on its loan, those specific assets can be claimed by the bondholders. Think of it just like your home loan agreement, my dear students. It specifies exactly how much you borrowed, the interest rate, your monthly payments, and what happens if you don't pay. For example, the bank can take possession of your house. That is very, very similar to a bond indenture. It precisely lays out all the rules and conditions for the loan, protecting the lender.
Absolutely. And sometimes, my dear students, when a company faces significant financial difficulties, creditor committees can be formed to protect their interests. In some countries, official creditor committees are established, especially for unsecured bondholders, once a company formally files for bankruptcy. These committees are expected to rigorously represent the bondholders during the bankruptcy proceedings and work tirelessly to protect their interests during the complex restructuring or liquidation process. Separately, when a company is simply struggling to meet its debt obligations under an indenture, a group of bondholders might spontaneously form what is called an ad hoc committee. Ad hoc is a Latin phrase meaning for a specific purpose. This committee then approaches the struggling company with potential options to restructure their bonds, trying to find a mutually beneficial solution that works for both sides, avoiding outright default. So, my dear students, quick question for you. If a company wants to borrow money by issuing bonds, what is the bond indenture, and why is it considered so important for the bondholders, those who are lending their money? Think about the protections it offers. Pause. All right, my dear students, let us now move on to what we can truly call the very heart of corporate governance, the board and management mechanisms. The board of directors is absolutely central. It is the cornerstone of a company's entire governance structure. They are fundamentally responsible for overseeing the company's strategic direction and diligently ensuring that management acts solely in the best interest of the shareholders. Now, boards, being comprised of busy individuals, are often very large and have many responsibilities, so they routinely delegate specific functions to specialized committees. These committees are made up of a carefully selected subset of board members, and they thoroughly consider, review, monitor, and diligently follow up on matters that fall within their specific mandates, which often require unique expertise or a greater degree of independence.
Exactly. These committees are truly vital, and there are 3 core board committees that are widely recommended by most corporate governance codes around the world, and sometimes even legally required by stock exchanges for listed companies. Understanding these committees is incredibly important for grasping good governance. First, we have the Audit Committee. This is, without a doubt, the most widely required and firmly established board committee. Best practices universally dictate that it should be composed solely of independent board members, meaning absolutely no one from the company's management should be on it, and at least one director should possess deep accounting or financial management expertise. What exactly do? They diligently monitor the company's financial reporting process, including making sure the correct accounting policies are chosen and implemented properly, all to ensure the absolute integrity of the financial statements. They are, in essence, the vigilant guardians of the company's numbers. They also carefully supervise the internal audit function and ensure it remains independent and highly competent. They are responsible for recommending the appointment and determining the pay of the independent external auditor, and they meet with them regularly and privately. They meticulously receive reports from both internal and external auditors, propose concrete remedial actions for any issues that are highlighted, and diligently follow up on them to ensure resolution. Sometimes they even oversee critical areas like IT security and data privacy. Imagine your housing society's managing committee, my dear students. The audit committee is very much like the few truly independent members who ensure all the society's accounts are transparent, proper, and audited regularly, checking meticulously that the treasurer is managing funds correctly and honestly. Next, my dear students, there's the Nominating or Governance Committee. This committee is also typically composed entirely of independent members. Their crucial job is to carefully appraise director and manager candidates, diligently oversee the entire board election process, and meticulously set the nomination procedures and criteria for board directorships, actively searching for highly qualified candidates who bring diverse skills and perspectives. They ensure the board structure is well balanced and aligns perfectly with good governance principles. Crucially, they also oversee the establishment and diligent enforcement of core corporate policies, such as the company's overall corporate governance code, the board charter, which defines its purpose, the company's code of ethics, and robust conflict of interest policies. They periodically review these policies and ensure strict compliance with all relevant laws, taking swift action if any violations are found. For instance, conflict of interest policies strictly require directors and managers to fully disclose any personal interests that might potentially affect the company's decisions, thereby ensuring fairness and impartiality. And finally, my dear students, we have the Compensation or Remuneration Committee. This very important committee develops and proposes the pay policies for directors and all key executives. They carefully set performance criteria and then diligently evaluate how well managers are performing against those criteria. Executive compensation attracts very significant investor attention, as this committee's primary focus is to thoughtfully align the manager's interests with the shareholders' interests to ensure everyone is pulling in the same direction. It is absolutely vital that all members of this committee are independent directors. Management should never be assessing its own performance, right? Compensation plans often wisely include a variable component, like profit sharing, company stock, or stock options, which are directly tied to performance. Companies are increasingly designing these plans to actively discourage short-termism or excessive risk-taking, for example, by granting shares, not just options, that only vest, meaning they become fully owned by the executive over several years or even until retirement, often with additional holding restrictions. Also, the say on pay votes, though non-binding, allow shareholders to express their collective views on executive pay, which helps limit how much discretion directors have in granting what might be considered excessive pay.
You have outlined those core committees perfectly, truly explaining their essence. It's also worth a quick mention, my dear students, that larger companies can have additional committees depending on their specific industry and needs. For example, risk committees are very common, and in some jurisdictions even legally required, especially in the financial services industry, like banks and insurance companies. These committees determine the company's overall risk profile and appetite, and ensure there's a proper system in place to identify, assess, mitigate, and manage risks appropriately across the organization. Insurance companies, for instance, often have dedicated investment committees to ensure they adopt prudent investment and capital management policies, as they're managing large pools of public money.
Great point. So for you, our diligent students, why is it considered so important that the members of a company's compensation committee are always independent directors and not part of the management they are assessing and setting salaries for? Take a moment to think about the principles of fairness and objectivity. Pause. Beyond the board and management, my dear students, managing employee relationships, sometimes thoughtfully called human capital management, is also incredibly vital for strong corporate governance. Companies need to truly respect employee rights and foster a positive working environment to avoid legal issues, damaging lawsuits, or severe damage to their hard-earned reputation. More positively, good employee management helps companies attract and retain top talent, ensures employee well-being, and very importantly, motivates employees to act diligently in the company's best interest. After all, a happy, respected, and motivated workforce is almost always a productive and innovative one.
Indeed, that is absolutely true. Employee rights are primarily protected by comprehensive labor laws, which define important standards for work hours, fair wages, benefits, and fair treatment in the workplace. In some countries, labor unions play a very strong role in advocating collectively for employees' rights and welfare. And what's truly fascinating, my dear students, is that in certain countries, like Germany, employees can actually be represented directly on the board of directors or on a supervisory board, which gives them a direct and powerful voice in the company's strategic governance. At an individual level, employment contracts clearly specify the rights and responsibilities of both the employer and the employee. And one very effective mechanism that companies use to retain valuable employees and to align their interests more closely with the company's long-term success is an employee stock ownership plan, or ESOP. In an ESOP, a company sets up a special fund with its own shares or cash, which are then granted to employees based on their dedicated service or their individual performance, often with vesting periods. This means they only get full ownership of the shares after working for a certain specified period, like 3 or 5 years, thereby encouraging them to stay with the company for the long term and feel like true partners in its success. Let us think of a successful family-run textile business, a very common and beloved scenario in India. To truly reward its loyal, long-serving employees and make them feel like genuine owners, like family members, the business might offer them a small percentage of the company's shares after they complete, say, 5 years of dedicated and honest service. These shares might even come with the condition that they can only be fully sold after another few years, encouraging even longer commitment and loyalty. That's very similar, my dear students, to how an ESOP works, making employees partners in the company's growth and success.
That's a wonderful and very clear example. So, besides just a regular salary, my dear students, how else can a company try to make its employees feel more deeply connected to its overall success and encourage them to stay with the company for a long, long time? Think about the different ways we've discussed. Pause.
All right, my dear students, let us also carefully consider the important relationships companies have with their customers and suppliers. Both of these crucial groups enter into formal contractual agreements with the company. These contracts specify everything in detail: the precise products or services being provided, the agreed-upon prices or fees, the payment terms, the rights and responsibilities of each party involved, what happens after the sale, any guarantees, and most crucially, what actions can be taken or what recourse is available if either party, unfortunately, breaches the terms of the contract. It's all clearly laid out, ensuring fairness and legal recourse.
And what's truly fascinating here is the rapidly growing influence of social media. In today's interconnected world, customers, owners, and other stakeholders can now very easily and instantly voice their interests or grievances. They can broadcast information, whether positive or negative, at a very low cost and with minimal effort to a massive audience. This means they can strongly influence public sentiment, often competing directly with the company's own management in shaping its public image and reputation. A single negative post, a viral video, or a widely shared customer complaint can have a massive, almost overnight impact on a company's reputation, perhaps even leading to boycotts or significant loss of trust. This empowers consumers and suppliers in ways they never were before, making companies even more accountable.
It's an absolute game changer, isn't it? The speed of information is incredible. So a quick question for you, my dear students. How has social media, in your opinion, powerfully empowered customers to influence a company's reputation, both positively and negatively? Take a moment to consider the immediate and widespread impact it can have.
Last but certainly not least, my dear students, let's talk about government mechanisms. Governments and various regulatory authorities play a very significant and overarching role in corporate governance. They diligently develop the laws that companies must follow, and they actively monitor companies' compliance with these laws. These laws protect and strictly enforce fundamental property rights and contract rights, but they also protect the rights of specific groups, such as consumers, or address broader societal concerns like environmental protection and public safety. Industries that significantly affect the public, like financial services, healthcare, or even defense industries, are typically subjected to much more stringent regulation because their operations have a much wider and deeper impact on society as a whole.
That's absolutely right. And within this essential governmental oversight, many regulatory authorities globally have adopted what are called corporate governance codes. These codes consist of guiding principles, almost like a set of recommended best practices for publicly traded companies. They often wisely use a comply or explain approach. This means that companies either fully adopt the recommended practices in the code, or they must publicly and clearly explain why they haven't adopted them. This approach encourages transparency and accountability, as companies cannot simply ignore the recommendations without public justification. For example, in our own country, India, for listed companies, SEBI, the Securities and Exchange Board of India, and the stock exchanges have very specific listing requirements that serve a similar purpose to these corporate governance codes, ensuring good practices are followed. In Japan, for instance, companies without outside directors must publicly explain why they don't have them. In the USA, there isn't one single national corporate governance code, but they achieve similar objectives through national securities laws, like the famous Sarbanes-Oxley Act. State corporate laws, many companies are incorporated in Delaware, which has very strong corporate laws, and strict stock exchange listing requirements, which, for instance, often require a majority of a board to be composed of independent directors.
So, to ensure you've truly grasped this important point, my dear students, what exactly does comply or explain mean in the context of corporate governance codes? Think about how it gives companies a degree of flexibility but still strongly demands transparency and justification. Pause.
All right, my dear students, we have now diligently covered all the major players and the crucial mechanisms. Now, let us bring all this knowledge together and discuss the very real-world impact, the potential risks of poor governance, and, on the beautiful flip side, the immense benefits of good governance. Corporate governance is truly critical, indeed foundational, for a company's success or even, sadly, its failure. Weak governance, where conflicts of interest are left unmanaged or stakeholder management is inadequate, can put a company at a huge competitive disadvantage compared to its industry peers, almost like a handicap. When there are poor control systems in place, ineffective decision-making processes, or simply inefficient monitoring, you very often see adverse operational results and ultimately a significant reduction in company value. When managers have superior information and oversight is poor or absent, they can very easily make decisions solely for their own personal benefit, often tragically at the expense of others, including the very shareholders they are supposed to serve. Let's now look at a very powerful and indeed unfortunate real-world case. The astonishing rise and tragic fall of Theranos Inc. This, my dear students, is a stark and chilling example of inadequate corporate governance. Theranos was founded in 2003 and quickly rose to prominence, raising over $700 million from investors and being valued at an astonishing $10 billion in 2014. Its founder and CEO, Elizabeth Holmes, boldly claimed to have developed revolutionary blood testing technology that could identify numerous medical conditions using just a single drop of blood, a truly groundbreaking, almost miraculous claim. The company's board even included famous, highly influential people, including former U.S. Secretaries of State and other distinguished figures. However, by 2015, serious questions began to surface publicly about the technology itself. Brave whistleblowers came forward, revealing that the technology was fundamentally flawed and that crucial blood test results had been falsified. In 2018, the company Elizabeth Holmes and her COO Ramesh Balwani were charged with massive fraud by the U.S. Securities and Exchange Commission, and soon after the company ceased operations entirely, resulting in a total and devastating loss for its shareholders and other stakeholders. Elizabeth Holmes was later found guilty of fraud in 2022. Now, what were the key governance failures here, my dear students? Firstly, while the board had very accomplished, well-known individuals, most had little to no knowledge of medical technology or scientific validation. They simply weren't equipped with the right expertise to critically question the core revolutionary claims of the company. Secondly, given this glaring lack of expertise, the board utterly failed to hire an independent expert to validate Theranos' innovative technology, which is an absolutely massive oversight in a high-stakes medical field. An independent expert would have immediately pointed out the complete lack of peer-reviewed scientific publications by Theranos, which is highly irregular and suspicious in the medical technology industry. Thirdly, the board regrettably ignored a clear and glaring conflict of interest arising from CEO Holmes' romantic relationship with COO Ramesh Balwani, who also shockingly lacked relevant industry experience. They did not question his role despite his evident lack of qualifications. Fourthly, the board dismissed serious fraud allegations raised by courageous whistleblowers, and worse, remained completely silent even after these whistleblowers were fired soon after making their allegations. And finally, Theranos operated for a significant period without filling critical key management roles, such as a chief financial officer, CFO, or global compliance officer, leaving huge gaping holes in oversight and accountability. The tragic result, as you can imagine, was a complete loss for all shareholders and other stakeholders, a devastating downfall caused by a cascade of egregious governance failures.
That is a truly sobering and important example, a real cautionary tale, isn't it? But let's now contrast this with the profound benefits. Strong governance practices, my dear students, mean proper scrutiny and robust control at all levels of the corporation. This significantly helps to mitigate risk factors like fraud, or at the very least, identify and control them early before they spiral catastrophically out of control. An effective, truly independent audit committee, as we discussed earlier, enhances these critical controls. Having formal, well-defined procedures for dealing with conflicts of interest ensures fair dealing and avoids those hidden costs associated with preferential treatment for related parties. Effective governance also clearly defines who is responsible for what and how reporting lines work across the company, which greatly improves decision-making processes and overall operational efficiency. Furthermore, internal audit and compliance departments are like the company's internal police, constantly monitoring for potential misconduct and ensuring smooth operations and adherence to rules. So you see, my dear students, good governance isn't a burden. It's truly a shield that protects the company and a powerful engine that drives its sustainable success.
So, my dear students, thinking deeply about the Theranos case we just discussed, what was one major failure of its board of directors that contributed so heavily to the company's downfall? Think about what they fundamentally didn't do, which was their duty.
Let's move to another critical area, my dear students: legal, regulatory, and reputational risks and benefits. Compliance weaknesses or poor reporting practices really expose a company to severe legal, regulatory, or significant reputational risks. This can unfortunately lead to serious investigations by government authorities, costly lawsuits from shareholders, employees, or creditors for breaching contracts or violating rights. Reputational harm can be incredibly costly and long-lasting, especially for public companies under constant public scrutiny. Once a company's reputation is severely tarnished, it is very, very hard, almost impossible, to fully recover it. A perfect and indeed very famous example of this is the Volkswagen AG Dieselgate scandal. In 2014, an independent study revealed that certain Volkswagen diesel cars had abnormally high emissions, far exceeding legal limits. For a whole year, VW initially insisted these were just minor technical issues. But then in 2015, they had to admit to the U.S. Environmental Protection Agency that they had deliberately used illegal software, what became infamously known as defeat devices, to manipulate emission test results during official government tests. This fraudulent software, can you believe it, was installed in as many as 11 million Volkswagen and Audi vehicles worldwide. Legal action was swiftly taken by governments in the USA, the European Union, and many other places, leading to severe consequences. The impact on Volkswagen was truly catastrophic, my dear students. VW's share price immediately fell by over a third in the days following the announcement, wiping out billions in shareholder wealth. The CEO at the time, Martin Winterkorn, resigned in 2015 and was later criminally indicted in both the USA and Germany on serious fraud and conspiracy charges. Volkswagen AG has incurred over EUR 32 billion, that's a staggering USD 37.7 billion in vehicle recalls, massive fines, and extensive legal costs. And ongoing shareholder lawsuits are still seeking settlements for billions more in damages years later. This scandal raised very serious concerns about board independence, the lack of sufficient oversight of employees who installed the illegal software, and a blatant, deliberate violation of air quality standards in communities worldwide. It was a severe blow to public trust in the company's integrity.
This example truly emphasizes that a company's reputation, which is meticulously built on strong governance and its unwavering ability to protect stakeholder interests, is absolutely crucial for its long-term success. Companies that have a well-deserved reputation for respecting the rights of customers, employees, suppliers, and government authorities can attract the best talent, secure capital more easily at favorable terms, improve sales because customers trust them, and even get better terms from their suppliers. Ethics education and continuous training for all key stakeholders also play a huge, often underestimated role in supporting strong governance practices throughout the organization. Ultimately, effective governance enables a company to significantly mitigate risks like these, prevent underlying conflicts of interest and agency problems from spiraling, and maintain stable, successful, and profitable operations. It's not just about avoiding bad things. It's profoundly about enabling good things and fostering sustainable growth.
So, my dear students, thinking about the Volkswagen Dieselgate scandal, besides the massive financial penalties and legal costs, what was another major negative consequence for the company, especially concerning how the public perceived them after that? Think about the impact on their brand. Pause.
Excellent points. And this brings us to the crucial financial risks and benefits of corporate governance. Poor corporate governance, especially when it comes to managing creditor interests effectively, can severely affect a company's financial position and, most critically, its ability to reliably repay its debt obligations. A rise in the default possibility, that is, the increasing risk of not being able to pay back loans, has wide-ranging and devastating consequences for everyone involved, from the employees who might tragically lose their jobs, to the suppliers who won't get paid for their goods, and even to society and the environment if the company collapses, leading to chaos.
Conversely, good governance arrangements are like a strong, well-built dam holding back a potential flood. They actively manage creditor conflicts and significantly reduce that dreaded default risk. How do they achieve this? Through well-functioning audit systems, transparent financial reporting, and by diligently reducing that information asymmetry we talked about earlier between the company and its lenders. This makes lenders feel much more secure and confident in the company's ability to repay. And the most wonderful result: lower default risks consistently lead to a lower cost of debt for the company. Creditors will demand a lower return, meaning the interest rate on the loans will be lower when their funds are more secure and their rights are clearly protected. This, my dear students, saves the company a huge amount of money over time, directly boosting its profitability. But it's not just about debt, my dear students. Good governance practices, whether it's at shareholder meetings where voices are heard, or through internal mechanisms like a strong independent board and its diligently working committees, give investors much greater assurance that their valuable capital is being well managed and protected. They feel confident that their rights to participate in discussions, to vote on important matters, and to receive fair and equal treatment are fully protected. The company's credibility and investor confidence in the marketplace are significantly enhanced by the timely and appropriate disclosure of all material information about its operations, its financial performance, and its governance activities. This improved transparency, the integrity of financial reporting processes, and having an independent audit all powerfully promote the trust of shareholders and market participants in both the quality of the firm's reported earnings and the fair representation of its financial position. And what does all this wonderful work do? It consistently reduces investors' risk perception of well-governed firms. When investors perceive lower risk, they in turn demand a lower required return on equity. This means a lower cost of equity for the company, making it much more attractive to investors, thereby improving its valuations and ultimately leading to better stock performance and higher share prices. It's a truly virtuous cycle, a win-win for everyone involved.
What's truly fascinating here, my dear students, is that studies have consistently shown clear, measurable evidence of these benefits. For example, extensive research indicates that improvements in corporate governance practices significantly increase the likelihood of a credit rating upgrade for a company, say, moving from a speculative grade to a more desirable investment grade, which, as we discussed, further reduces the company's cost of debt. Other studies have found that listed companies with experienced audit committees, particularly those with strong financial expertise, tend to perform much better and exhibit greater resilience during economic crises. And, very interestingly, board diversity and independence appear to be key factors strongly correlated with a company's higher valuation in the market. These are not just theoretical benefits, my students. They are tangible, measurable financial advantages for well-governed companies. So when professional analysts are carefully evaluating a company's corporate governance, they ask some very important and probing questions, my dear students. They diligently look at the company's ownership and voting structure. Is it dispersed among many or highly concentrated? Do the board members' skills and experience truly match the current and future strategic needs of the company? How closely does the management team's compensation and incentive structure align with factors expected to drive overall company results? Are they truly incentivized for the right things, for long-term value creation? Who are the significant investors in the company? Are there, perhaps, any activist shareholders who might push for change? How strong are the company's shareholder rights compared to its industry peers? And finally, how effective has management been in taking a long-term perspective on risks and sustainability? Is it thinking only about today's profits or responsibly about tomorrow's challenges? These insightful questions provide very deep understanding into the quality of management and potential sources of both risk and opportunity.
Let's quickly look at another powerful example, my dear students, one that sadly illustrates the consequences of governance failures. Kobe Steel Ltd. This was a major Japanese steel manufacturer that, in March 2018, issued a public report deeply apologizing for falsifying data on the strength and durability of its aluminum, copper, and steel products. This was a grave breach of trust. Following the scandal, its stock price sank dramatically to a 5-year low, and its cost of debt literally jumped to record levels as lenders lost confidence. An independent investigation found that the misconduct resulted from a management style that unfortunately overemphasized profitability amidst inadequate corporate governance, along with reduced quality awareness among employees and insufficient quality control procedures. The report bluntly stated that the company had a culture that prioritized winning purchase orders and meeting delivery deadlines over ensuring quality. This financial implication of the drastic fall in stock price and the sharp jump in the cost of debt indicated a severe decline in both investor and creditor confidence. It also clearly suggested reduced growth opportunities for the future due to massive reputational damage and the loss of trust. And ironically, the company incurred significantly higher agency costs by having to hire multiple independent committees and external experts just to investigate and fix the very serious issues they themselves created.
It truly shows the cascading and devastating effect of poor governance, doesn't it? Now, my dear students, a common misconception exists, and I want to address it. Some people think that governance and controls are just bureaucratic and that they slow down decision-making and hinder value creation at companies. While it's true that poorly implemented governance, for example, having a board that's too big and ineffective, too many managerial layers that create bottlenecks, or just a check-the-box approach to compliance without genuine commitment can indeed slow things down. Effective governance is actually the exact opposite. It truly leads to increased competitiveness, improved operational efficiency, better overall control, and ultimately enhanced sustainable performance. It provides the essential framework for smart, ethical, and sustainable decisions. And finally, let's reiterate that even if there are no formal labor unions, employee relations are absolutely crucial for a company's success. The quality of their work directly impacts customer experience and product quality, and poor relations can lead to costly employee attrition, significant productivity losses, or very damaging negative press. Companies that build positive long-term relationships with their employees gain a strong and lasting competitive advantage. So, my dear students, a final question for this section. If a company has very strong and effective corporate governance practices, how might this positively affect the cost of debt for that company? Think about what creditors typically look for when lending money.
And there you have it, our wonderful students. We've taken a comprehensive and patient deep dive into the very important topic of corporate governance. We started by carefully understanding the fundamental principal-agent relationship and identifying the many diverse stakeholders involved in a corporation. Then we moved on to patiently explore the various conflicts that can, unfortunately, arise between these different stakeholder groups, from managers and shareholders to controlling versus minority shareholders, and even shareholders versus creditors. We then looked closely at the different mechanisms companies wisely use to manage these complex relationships and mitigate associated risks, including transparent reporting, shareholder meetings and activism, creditor mechanisms, and the crucial roles of independent board committees. And finally, we discussed the very real operational, legal, reputational, and financial risks that come with poor governance, contrasted powerfully with the immense, measurable benefits of effective corporate governance.
What's truly fascinating here, my dear students, is that understanding corporate governance is not just about passing your exams. It's a truly vital skill for any future financial professional. It helps you see beyond just the numbers on a balance sheet and truly understand the genuine health, the underlying values, and the long-term potential of a company. Good governance, Bataji, is truly the backbone of sustainable success in the corporate world, the foundation for all good things.
Absolutely. So as you go about your day and you look at any company around you, whether it's a massive corporation you read about in the news or even a small beloved business in your own town, consider this provocative thought. Who are its most important stakeholders, and how well do you think their diverse interests are truly being balanced and governed by those in charge?
A wonderful and insightful thought to leave with. Thank you, my dear students, for your time, your patience, and your keen attention in this deep dive. We sincerely hope you learned a great deal today. All the very best. Keep studying hard and keep exploring.
Namaste, and welcome back to the Deep Dive. So glad you could join us today.
Yes, welcome, everyone.
Today, we're going to embark on a journey right into the heart of how businesses manage their day-to-day money.
That's right. We're talking about concepts called working capital and liquidity.
And for you, our bright students preparing for the CFA exams, well, understanding this is absolutely crucial. It's like knowing how to keep your own household running smoothly, you know?
Exactly, even when that big electricity bill suddenly arrives.
We have some excellent materials here to help us understand this, and our mission today is really to break it all down piece by piece,
Uh-huh.
so it becomes clear as a sunny day in Mumbai.
Indeed. Think of it perhaps like peeking behind the curtain of a busy Kirana shop.
Oh, that's a good one.
How do they manage to buy goods, sell them, and still have cash to pay their suppliers? That's essentially what we'll be exploring.
Okay.
We'll look at concepts like the cash conversion cycle. That's
Yeah.
about how quickly a company turns its investments into cash, and also how it maintains enough ready cash to meet its urgent needs. That part is what we call liquidity.
Okay.
Our goal today is to make sure you not only understand the definitions, but also the why behind these financial decisions
Yes, the why is so important.
and how they really impact a company's ability to, well, to thrive, isn't it?
Absolutely. Okay, let's unpack this then. Imagine a company like a factory that makes, say, cricket bats.
Okay, cricket bats. Everyone understands that.
They have to buy wood first, right?
Right.
Then they shape it, make the bats, then they sell the bats, and finally they collect the money from the shops or customers.
Whole process.
This entire process, from buying the materials right up to getting paid, that's what we call the operating cycle.
Mhm.
If you look at Exhibit 1 in our materials, you can see it laid out. Purchases lead to production, then sales, then collection, which finally brings the cash back. It's a loop.
Yes, a continuous loop.
But, and this is really key, the cash doesn't always flow immediately with the activity.
Ah, the timing difference. Very important.
Exactly. They might buy the wood today, but only pay the supplier next month. Or they might sell the bats today, but the shop only pays them after, say, 60 days.
Right. There's a lag.
This gap in timing between the business activity and the actual cash changing hands is, well, it's central to understanding working capital.
That's absolutely critical to grasp. And to really, dissect this operating cycle, we need to understand some very important short-term accounts. These show up on a company's balance sheet.
Okay.
Short-term accounts.
Yes, they represent money expected to come in or go out, usually within a year. They are directly tied to these daily operations. Let's look at three main ones.
Okay, let's do that.
First, we have accounts receivable. This is simply money that customers owe the company.
Okay, money owed to the company.
Yes.
Yeah.
Like, imagine your neighbor borrows, say, Rs 500 from you for a week to buy groceries.
Okay.
He owes you that money, doesn't he? That Rs 500 is an account receivable for you. For a business, it arises when they sell something on credit.
Right. Sell now, get paid later. Exactly. It appears on the balance sheet then, and it disappears, or is derecognized, as we say, only when the customer actually pays the cash.
Got it. So, neighbor pays back, my receivable is gone.
Precisely. Next is inventory. This is the stock of goods a company has.
Like the wood for the cricket bat.
Yes, or the finished bats waiting to be sold. Or think of your local tailor.
Okay.
He has fabric, maybe some buttons, thread, and also some finished kurtas ready to sell. All of this is his inventory. He holds it to sell it, you see.
Ah, okay. All the materials and finished goods.
Correct. It's recognized when the company gets ownership and derecognized when it's sold.
Makes sense.
And the third one?
The third one is accounts payable. This is the opposite of receivables.
Yeah.
This is money we, the company, owe to our suppliers.
Okay, money we have to pay out later.
Yes. Just like when you buy vegetables from your local vendor and you tell him, Paya, I'll pay you tomorrow.
Uh-huh. I do that sometimes. Right. That amount you owe the Paya is an account payable for you. For a business, it appears when they receive goods or services but haven't paid yet, and it disappears once they make the cash payment.
Okay, so receivables is money coming in later. Payables is money going out later. Inventory is stuff waiting to be sold.
You've got it. And these are temporary accounts, always changing with the daily business. Now, a quick question for you students listening. If a shop sells a mobile phone on credit, what would that create for the shop on its balance sheet? Think about it.
Good question. While you think, let's move to where it gets really interesting. The cash conversion cycle, often called the CCC.
Ah, yes, the CCC. Very important measure.
It really is. It tells us how long it takes, on average, for the cash we invest in inventory.
Like buying that wood for the bats.
Exactly.
Yeah.
How long it takes for that cash to come back to us from our customers after we sell the bats. Think of it like a relay race for your money. How long does your rupee run around the track, buying materials, making the product, selling it, before it crosses the finish line and returns to your company's pocket?
That's a nice analogy, the relay race.
Now, there's a formula for this. Equation 1 in your materials. It's cash conversion cycle Days of inventory on hand, DOH, plus days sales outstanding, DSO, days payable outstanding, DPO.
DOAs plus DSO minus DPO.
Exactly. And if you look at Exhibit 4, it visually shows this timeline. You receive inventory, maybe pay your supplier sometime later, sell the inventory, and then finally receive the cash from the customer. The CCC measures that gap between paying out cash and getting cash back in.
Let's break down each part of that formula simply, shall we?
do.
Okay, first, days of inventory on hand, DOH. This is quite simply how long an item sits in your shop or warehouse before it's sold.
Like the cricket bats sitting on the shelf.
How nicely. Or imagine a sweet shop. If they make ladoos and keep them for, say, 3 days before selling them all, their DOH for ladoos is 3 days. A longer DOH means your money is stuck in that inventory for longer. Not ideal, generally.
Right, stuck capital.
Then we have days sales outstanding, DSO. This measures how long it takes you to collect the money after you've sold something on credit.
So after the bat is sold, but before the cash comes in.
Yes. If you sell a bike today, but your customer agrees to pay you after 10 days, and they do pay on the 10th day, your DSO is 10 days. Here, shorter is definitely better. You want your cash quickly? No.
Absolutely. Faster cash is always good.
And the third part is days payable. Outstanding. DPO. This is about how long we take to pay our suppliers.
The other side of the coin.
Exactly. Think about your electricity bill. It arrives, and maybe it says you have 15 days to pay it. If you wait and pay it on the very last day, day 15, then your DPO for that bill is 15 days.
Okay.
For company, a longer DPO means you get to hold on to your cash for longer before paying your suppliers. It's like getting a short-term interest-free loan from them.
So DOH and DSO you want short, but DPO you want long. Is that right?
Generally speaking, yes. You want to sell inventory quickly, low DOH, collect cash quickly, low DSO, and pay your suppliers slowly, high DPO.
Okay.
So putting it together, a short cash conversion cycle means a company is very efficient. It's turning its inventory into cash very quickly.
Like that relay runner finishing fast.
Exactly. This is generally very good. It means they need less external financing, less borrowing for their day-to-day operations.
And a long cycle.
A long cash conversion cycle means cash is tied up for longer periods in inventory, in receivables. This might mean the company needs to borrow more money just to keep things running smoothly. More financing required.
Okay, so short is good, long is, well, less good usually.
But here's something fascinating. A company can even have a negative cash conversion cycle.
Negative. How does that work? Less than 0 days.
Yes. Imagine you collect money from your customers before you even have to pay your suppliers for the goods you sold.
Wow. Like getting paid for a catering order before you buy the ingredients?
Precisely.
Mm.
That's the ideal scenario, isn't it?
Yep.
You're using your customers' and suppliers' money to run your business. This is seen with very efficient companies like Inditex, the parent company of Zara.
Ah, Zara. Fast fashion. They sell quickly.
Very quickly.
Mm.
And they likely have good payment terms with suppliers. So cash comes in fast, goes out slow, negative CCC. It's a huge advantage.
That makes sense. And this varies by industry, doesn't it?
Oh, tremendously. Look at Exhibit 5. It compares industries like pharmaceuticals and airlines. Pharma companies often have long CCCs.
Why is that?
Well, think about it. They might need to hold large inventories of specialized drugs, maybe due to regulations or long production lead times.
Yeah.
So high DOH.
Okay.
Airlines, on the other hand, often have very short CCCs. Wow. They sell tickets in advance. People pay before the flight.
Ah, prepayment, so low DSO.
Very low DSO and relatively low inventory compared to a manufacturer. So their cycle is much faster. The business model dictates a lot.
Fascinating. Okay, students, another question for you. If a company finds a way to sell its inventory faster, maybe by having a big sale, what happens to its DOH? And what effect will that likely have on its cash conversion cycle? Longer or shorter? Think about the formula.
Good one. Let them ponder that.
So if a company wants to shorten its CCC, wants its money to race faster, how can they actually do it? What are the levers?
Well, based on the formula, there are 3 main ways, aren't there?
Yeah.
Corresponding to the 3 components.
Right. Reduce DOH, reduce DSO, increase DPO.
Exactly. Let's take them one by one.
Okay. First, reduce DOH. How?
Think about our Kirana store owner again. He doesn't want old expired biscuits sitting on his shelf, does he?
Definitely not. Money wasted.
Right. So he needs good inventory management. Maybe he negotiates more frequent, smaller deliveries from his suppliers, something called just-in-time inventory.
So he doesn't hold too much stock.
Correct. Or he uses data, track what customers are buying to better predict demand so he doesn't overstock unpopular items. Less stock means less money tied up, shorter DOH.
Makes sense. Okay, second lever, reduce DSO.
This means getting customers to pay you faster.
How can a company encourage that?
Several ways. They could offer a small discount for early payment, like you sometimes see on bills. Pay within 10 days and get 2% off.
Ah, yes, like some electricity bills offer.
Exactly that. Or they could impose late fees to discourage delays. Or simply be stricter about who they offer credit to in the first place. Maybe check creditworthiness more carefully.
Okay, get the cash in quicker. And the third one, increase DPO.
Yes, this is about negotiating longer payment terms with your suppliers, taking longer to pay them.
So instead of paying in 30 days, try to get 60 days.
Precisely.
Yeah.
If you are a big customer and buy a lot from one supplier, you might have the bargaining power or the leverage to ask for that. Say, can I pay you in 60 days instead of 30?
But there must be a catch. No.
There can be. You have to be careful. Pushing suppliers too hard might damage the relationship. They might start charging you higher prices to compensate or ask for deposits up front. It's a balancing act.
Okay, so 3 levers, but each needs careful handling.
Absolutely.
Now, this ties into something really practical, shown in example 1, the Q Incorporation case. It highlights this tension between paying suppliers early versus later.
Yes. The discount dilemma.
Right. Keown gets offered a 2% discount if they pay a supplier in 10 days. The normal due date is 30 days. If they don't take the discount, they get an extra 20 days to pay.
So they are effectively borrowing from the supplier for those 20 days.
Exactly. But what's the cost of that borrowing? It's the 2% discount they gave up. The source material calculates the effective annual rate, EAR, of not taking the discount.
And it's surprisingly high, isn't it?
Astonishingly high. It works out to 44.6% per year.
Wow. 44.6%. That's like credit card debt interest rates, or even higher.
Right. Now, compare that to Keown potentially getting a short-term loan from a bank at, say, 7.7% AR.
The choice is obvious then.
It becomes crystal clear. It's much cheaper to borrow from the bank at 7.7% to pay the supplier early and get that 2% discount, which saves them the equivalent of 44.6%, than it is to skip the discount and use the free supplier credit.
So that free supplier credit is actually very expensive.
Hugely expensive. It really shows that sometimes taking a small, explicit loan from a bank to capture a big, implicit saving from a supplier discount is a very, very smart financial move.
Like borrowing from your uncle at a low rate to avoid a high-interest credit card debt, perhaps.
Exactly that kind of thinking. It's about understanding the true cost of different sources of funds.
Let's make this even more real with example 2, looking at those big U.S. discount retailers. We have data for Walmart, Target, Costco, TJX, and Ross.
Okay, the big names.
Yes, we can see their DOH, DSO, and DPO figures, and then calculate the CCC for each.
What does it show?
Well, it's quite fascinating. Target actually has a negative CCC of 9 to 5 days.
-5, so they get cash 5 days before paying suppliers.
Incredible, isn't it? Costco is also negative at -2 days. Then you have Ross at 0 days, Walmart at 6 days, and TJX has the longest cycle at 23 days.
Why are Target and Costco negative? How do they manage that?
Think about how you pay there. Usually cash or card right at the till? No.
Yes, immediately.
No, their DSO, days sales outstanding, is tiny. Maybe 2 or 3 days for card payments to settle. Super fast cash collection.
Okay, low DSO. What about inventory?
Well, Target is known for relatively quick turnover, and Costco. A huge part of their sales is perishable food items.
Ah, fruits, vegetables, milk. They have to sell those quickly.
Exactly. They can't afford a long DOH for those goods. It forces efficiency. So low DSO, low DOH, and likely strong negotiating power for longer DPO with suppliers. It leads to that negative CCC.
It's like they're using their suppliers' money and customers' money to fund their operations.
That's precisely what a negative CCC implies. It's a fantastic position to be in. It frees up so much capital.
So analysts must watch these CCC trends closely.
Oh, absolutely.
Yeah.
If a company's CCC starts getting longer compared to its competitors, or just longer over time for itself,
It's a warning sign.
it can be, yes.
Yeah.
It might mean customers are taking longer to pay, perhaps struggling financially, or maybe inventory isn't selling well, indicating weak demand. Or maybe the company is losing its bargaining power with suppliers and having to pay them sooner. Analysts really scrutinize these changes.
Okay, makes sense. So students, another question for you. If a company starts offering larger discounts for early payment to its customers, what effect will this likely have on its days sales outstanding, DSO? Will DSO go up or down?
Think about what the discount encourages customers to do.
Right. Moving on from the cycle itself, let's talk more broadly about working capital.
Okay, working capital.
Basically, this is the difference between what a company owns that can be quickly turned into cash, its short-term assets, and what it owes that needs to be paid soon, its short-term liabilities.
The money available for day-to-day running.
Exactly. It's the money a company has available for its daily operations after covering its immediate debts. Now, we often look at it in two ways.
Two measures.
Yes. First, there's total working capital. The formula, equation 2, is simple. Current assets minus current liabilities. It's a broad measure.
All short-term assets minus all short-term liabilities.
Correct. Then there's a slightly more focused measure called net working capital. That's equation 3.
How is that different?
It takes current assets, DUT. It excludes cash and marketable securities. This is super liquid stuff. And then it subtracts current liabilities, BUT. It excludes short-term debt and current portions of long-term debt, the financing items.
So it focuses more on the operational assets and liabilities, like inventory and receivables minus payables.
Exactly. It strips out the pure cash and the pure financing to give a clear picture of how much the day-to-day operational assets are financed by the day-to-day operational liabilities.
Okay, that distinction is useful.
Let's use Exhibit 6, the balance sheet for a company called Liquidity NV, to see this. In their year 20X2, their current assets were EUR 335 million. Their current liabilities were EUR 220 million. So total working capital is 335 minus 220.
Which is EUR 115 million.
Right. But for net working capital, we take the current assets, remove the cash and securities, take the current liabilities, remove the short-term bank loans. The calculation in the source shows this gives a net working capital of EUR 65 million for 20X2.
So total is 115 million, net is 65 million. Different perspectives.
Yes. And the key insight, connecting back to our earlier discussion, is that the cash conversion cycle and the amount of working capital a company needs, often measured as a ratio to sales, are very closely linked.
How so?
Well, a short CCC usually means a lower working capital requirement, particularly net working capital. Why? Because if your cycle is fast, you're not tying up as much money in inventory and receivables for long periods. Cash comes back quickly.
Less money stuck in the operational cycle means less working capital needed overall. Makes sense.
Right. Less need to fund those operational assets.
And this brings us back beautifully to Inditex, the Zara example.
The negative CCC champion.
Exactly. Because they have that super efficient, often negative cash conversion cycle, they also manage to operate with negative net working capital. And their ratio of net working capital to sales is also negative.
Negative working capital? That sounds counterintuitive. How is that even possible?
It's highly unusual, but incredibly efficient. Think about how they achieve it again.
Okay.
1, they get cash from customers. Almost immediately you pay when you buy the clothes, right? Off the rack sales.
Yes. Cash or card straight away.
2, they keep very little inventory relative to sales. Their fast fashion model means limited runs, quick turnover. Stuff doesn't sit around.
Low DOH.
Very low DOH.
Yeah.
And 3, because they are huge, they have immense bargaining power with their suppliers, so they likely negotiate very long payment terms.
High DPO.
Exactly. So cash comes in fast, low DSO. Inventory moves fast, low DOH. And cash goes out slow, high DPO.
Yeah.
The result is they collect cash well before they need to pay suppliers, leading to negative net working capital.
They're essentially using supplier money to fund the gap.
Precisely. It's incredibly efficient. Generally, most firms want less working capital tied up, not more, unless there's a very specific reason.
Like?
Well, maybe like aging spirits in the liquor industry. That takes time and inventory builds up. Or certain pharmaceutical regulations that require holding buffer stocks. Or sometimes it might be a strategic choice, maybe to ensure product availability. But generally, less capital tied up in WC is better.
Because that capital can be used elsewhere.
Exactly. For higher return projects, R&D, expansion, or even just returning it to the investors as dividends or buybacks, less idle capital is usually a sign of efficiency.
Okay. So students, here's a thought question. If a company decides to reduce its safety stock of inventory, the extra inventory it keeps just in case, will this likely increase or decrease its net working capital? What do you think?
Reducing safety stock.
Now, how do companies decide how much working capital to keep? It seems like a big balancing act.
It absolutely is. Like deciding how much food to stock in your kitchen at home, isn't it?
How do you mean?
Well, you need enough for your daily meals, maybe some staples like rice, dal, sugar that are always there. But you don't want to buy so much fresh vegetables that they spoil before you use them.
Okay. Enough for needs, but not so much it goes waste or ties up too much money.
Exactly. And companies have different approaches to this balancing act, different philosophies, you could say. Exhibit 10 in our material shows three main approaches to managing working capital levels and how they're financed: conservative, moderate, sometimes called matched, and aggressive.
Okay, conservative, moderate, aggressive, let's break those down. But first, help us visualize the components involved.
Right. Think of a company's current assets, the short-term ones, as having two parts.
Okay.
There are permanent current assets. This is the minimum level of inventory, receivables, and maybe some cash that the company always needs just to operate normally day to day, even in the slow season, like the basic groceries you always have in your kitchen, the rice, the sugar.
The base level needed constantly.
Yes. Then there are variable current assets. These are the extra amounts needed during busy times, like seasonal peaks, or maybe during a big growth spurt, like the extra food, the speckle sweets and vegetables you buy for a big festival like Diwali, or when many guests are coming over. It goes up and down.
Okay, permanent base plus fluctuating variable part.
Correct. And these assets need to be paid for, financed. The funding comes from either short-term liabilities like your monthly electricity bill or phone bill, things due soon, or from long-term debt and equity, like a long-term loan for your house or your own savings, more permanent funding sources.
So the strategy is about how you match the type of asset, permanent or variable, with the type of funding, short-term or long-term.
That's the heart of it. How do you finance the permanent part and the variable part? That's where the three approaches differ. Let's look at each one.
Okay, let's start with the conservative approach. What does that look like?
The conservative approach is like keeping a lot of cash readily available in your bank account just in case. You play it very safe.
So high levels of current assets.
Yes. More inventory than strictly needed, maybe more generous credit terms leading to higher receivables, holding more cash, and crucially, you finance a large portion of these current assets, even some of the variable ones, using long-term funding, long-term debt, or equity.
What's the benefit of that? Sounds safe.
It is safe. As Exhibit 11 shows, the big pro is maximum flexibility and very low risk of running out of cash or being unable to refinance short-term debt when it matures. That's called rollover risk. Especially important if the economy is shaky.
But the downside? Must be cost, no.
Exactly. The con is that it's generally the most expensive approach. Long-term debt usually has higher interest rates than short-term debt. Plus, holding lots of cash or extra inventory means that capital isn't earning a good return elsewhere. It's idle money.
So who might use this approach?
Maybe companies in very early growth stages who face uncertainty, or companies with very high profit margins who can afford the extra cost for the safety, or those in highly volatile industries where having that liquidity buffer is critical.
Okay, safe but potentially expensive. What about the other extreme, the aggressive approach?
The aggressive approach. This is more like living paycheck to paycheck, but doing it very, very efficiently. Meaning you minimize your investment in current assets, keep cash balances low, manage inventory tightly, push for faster customer payments, and you rely heavily on short-term debt to finance not just your variable assets, but also a good chunk of your permanent current asset base.
Wow, that sounds risky.
It is riskier. Look at Exhibit 12. The main pro is it's generally cheaper. Short-term debt often has lower interest rates, so financing costs are lower.
What the cons?
The big con is the higher risk, especially that rollover risk we mentioned. What happens if your short-term loan comes due and suddenly banks aren't willing to lend, or only at much higher rates?
Like during a financial crisis.
Exactly. We saw this happen during the 2008 crisis, and again during the early days of the COVID-19 pandemic. Many firms that relied heavily on short-term funding found it very difficult or impossible to roll over their debt. It could lead to a liquidity crisis very quickly.
So cheaper, but much higher risk if things go wrong.
Correct. It requires very accurate forecasting of sales and cash flows.
Okay. And the middle ground, the moderate or matched approach.
This is, as the name suggests, the balanced approach, trying to get the best of both worlds, or at least avoid the extremes.
How does it work?
The idea here, as shown in Exhibit 13, is to match the maturity of the funding to the life of the asset. So you use long-term funding, debt and equity, to finance your permanent current assets, the base level you always need, and also your fixed assets. And you use short-term funding only for the variable seasonal needs, the festival groceries.
So long-term needs funded long-term, short-term needs funded short-term. Makes intuitive sense.
It does, doesn't it? It aims to balance cost and risk. You get some benefit from lower cost short-term debt for temporary needs, but you maintain stability by funding your core operations with long-term sources. It reduces the rollover risk compared to the aggressive approach, but avoids the higher cost of the fully conservative one.
So this is probably what most companies aim for.
I'd say most well-managed firms try to find this kind of balance. Of course, the exact strategy depends heavily on their specific industry, their size, their predictability of sales, their access to capital markets, many factors.
Okay, that clarifies the different philosophies. Now, another question for our students. If a company prioritizes minimizing its financing costs above all else, and they are very confident in their ability to forecast sales accurately, which working capital management approach, conservative, aggressive, or moderate, would they most likely adopt? Which one focuses most on cost?
Good question. Think about the cost versus risk trade-off.
All right, let's shift our focus slightly now to the concept of liquidity. We've touched on it, but let's define it clearly.
Yes, liquidity, a crucial concept.
In simple terms, liquidity just means how quickly something can be turned into cash without losing significant value.
Or, put another way, how easily a company can pay its immediate bills as they come due.
Right. Cash itself is obviously the most liquid asset. It is cash. No conversion needed.
Can't get more liquid than cash.
But other things take time. Think about inventory, like those cricket bats. They have to be sold first, and then you have to collect the money. That takes time, so inventory is less liquid.
Much less liquid than, say, shares traded on the stock exchange.
Exactly. Or think about it this way. Selling a stack of old newspapers might take you weeks to get a few rupees. Getting cash from an ATM takes seconds. The ATM cash is far more liquid.
Good analogy.
Exhibit 7 in our materials shows this relative liquidity. It ranks short-term assets and liabilities. You see cash and short-term investments at the top most liquid, then maybe receivables, then inventory further down, and things like accounts payable are liabilities, but they represent a use of liquidity when paid.
And the business model plays a huge role here too, doesn't it?
Absolutely. A service business, like a software company or a consulting firm, might have very little physical inventory. Most of their assets might be receivables or cash. So their balance sheet looks naturally more liquid than, say, a heavy manufacturing plant with lots of raw materials and finished goods inventory.
Right. The nature of the business dictates the asset mix. So where do companies get this liquidity, this cash, when they need it?
Good question. There are different sources.
Yes, we generally categorize them into primary and secondary sources of liquidity. Knowing the difference is important for understanding a company's financial health.
Okay, primary versus secondary. What are primary sources?
Primary sources are the normal day-to-day ways a healthy company gets cash. They are readily accessible and generally preferred.
Like?
Well, first and most obvious is cash and marketable securities on hand. This is like the cash you have in your wallet or maybe fixed deposits in the bank that can be easily broken without much penalty. Quick and easy access.
Okay, ready money.
Second is borrowings. This includes using prearranged credit lines from banks, getting short-term loans, or even just using the credit offered by suppliers, like delaying payment or DPO. It's a source. But remember, borrowing creates an obligation to pay back later.
Right, it's not free money.
And third, perhaps the most crucial source for long-term sustainability is cash flow from operations, CFFO.
Ah, the money the business itself generates.
Exactly. This is the cash generated from the company's main business activity selling its products or services after paying for operating expenses. For a healthy, profitable company, this should be their main, steady source of income, like your regular salary.
Okay. Equation 4 shows how CFFO is calculated.
Yes, and sometimes we refine this further into free cash flow, FCF, shown in equation 5. FCF is basically CFFO minus the essential capital expenditures needed to maintain the business or invest in its growth, like buying necessary new machines.
So FCF is the cash left over after running the business and making necessary investments.
Precisely. It's the cash that's truly free for other things. Maybe paying down extra debt, giving dividends to shareholders, buying back shares, or making acquisitions. Very important metric.
Okay, so those are the primary sources, cash on hand, borrowing, and cash from operations. What about secondary sources?
Secondary sources are typically used only when the primary sources aren't enough, usually in times of financial stress or crisis. Think of these like having to sell your family jewelry or taking a loan from a local moneylender at a very high interest rate. You do it only when you absolutely have to, and often comes with significant downsides or sends a negative signal.
Okay, emergency measures. What are some examples for companies?
Well, they might suspend or reduce dividends paid to shareholders, saves cash, but investors won't be happy.
Understandable.
They can delay or reduce capital expenditures, postpone buying that new machinery or building that new factory wing. Saves cash now, but could hurt future growth.
Short-term gain, potential long-term pain.
Exactly. They might try to issue equity, sell new shares in the company, brings in cash, but dilutes the ownership percentage of existing shareholders.
Makes the existing slice of the pie smaller for everyone.
Yes. They could try to renegotiate contract terms, maybe ask suppliers for even more time to pay, or ask their landlord for a rent reduction. Can be difficult and strain relationships.
Tricky.
They could sell assets, sell off property, old equipment, maybe even a whole division of the business. Provides cash, but often at a discounted price if done under pressure, and you might lose a valuable part of the company.
Selling the family silver, as they say.
Indeed. And the absolute last resort is often filing for bankruptcy protection. This gives the company breathing room to restructure its debts while still operating, but it has huge negative consequences for reputation and future prospects.
So using secondary sources is usually a bad sign?
Generally, yes.
Yeah.
It often signals that the company is facing significant financial difficulty. Think about the airlines during the early part of the COVID pandemic.
Right, travel just stopped.
Exactly. Their primary source, cash flow from operations, vanished overnight. They were forced into secondary sources, raising funds through things like convertible bonds, getting government aid, drastically cutting capital expenditures, just to survive. It was a clear sign of distress.
That makes the distinction very clear. Now, example 3, about Kuhn Corporation again, seems to illustrate the cost of using less liquid sources.
Yes, it estimates the cost of accessing liquidity by selling different types of assets when they urgently need cash.
What does it show?
It shows a table with fair values and estimated liquidation cost, the percentage discount or fees you incur when selling quickly. Selling marketable securities might have a 0% liquidation cost. You get the full market value.
Okay, very efficient.
But selling, say, inventory or receivables quickly might involve a 10–15% discount or cost. Selling real estate might cost 15%, and selling a whole subsidiary under pressure. The example shows a 20% liquidation cost.
Wow, 20%. So if the subsidiary was worth CAD 30 million, you'd only get CAD 24 million after costs.
Exactly. That CAD 6 million difference is the cost of liquidating that less liquid asset quickly. It really highlights that accessing liquidity from less liquid assets can be very expensive. You lose value in the rush.
A very practical point. Okay, students, quick check. If a company decides to delay buying a new machine this year to save cash, would this be considered tapping into a primary or a secondary source of liquidity? Think about whether it's a normal or an emergency measure.
Good one. Is it routine or a sign of stress?
Now, sometimes companies' liquidity situation can be negatively affected by specific operational issues. We call these drags and pulls on liquidity.
Ah, yes, drags and pulls. Things that hinder cash coming in or accelerate cash going out.
Exactly. Let's start with drags on liquidity. These are situations where cash inflows are slowing down. It's like your salary payment getting delayed by a few days. Suddenly you have less cash than expected.
What causes drags for a company?
Well, a major one is uncollected receivables. Customers just aren't paying on time. Maybe they are paying later and later, or maybe some debts are becoming bad debts, unlikely to ever be collected. The longer money is stuck as a receivable, the less cash the company has. We often track the average day's receivables outstanding. If that number climbs, it's a drag.
Okay, slow payments from customers. What else?
Another big one is obsolete inventory. You have a warehouse full of goods, but nobody wants to buy them anymore. Like having a huge stock of old cassette tapes when everyone uses streaming. That inventory represents trapped cash. It's dragging down your liquidity because you can't convert it easily.
Money stuck in unwanted goods.
Right. And a third drag can be borrowing constraints. You need to borrow money, maybe to cover a temporary shortfall, but banks are saying no, or they're offering loans only at extremely high interest rates. Your access to that primary source of liquidity is restricted, dragging down your ability to get cash.
Okay, so drags slow down the inflow of cash. What about pulls?
Pulls on liquidity are the opposite. These are situations where cash is speeding up going out, or maybe your access to credit is suddenly reduced, forcing you to pay out cash sooner than planned.
So, cash leaving faster than expected. Like what?
One example is making payments early. If a company starts paying its suppliers before the due date, and there's no financial benefit like a discount for doing so, it's just pulling cash out of the company sooner than necessary.
Why would a company do that? Poor management.
It could be poor controls, yes. Another pull is reduced credit limits from suppliers. If your supplier suddenly says, sorry, we used to give you 60 days to pay, now we need payment in 10 days, That pulls cash out of your business much faster.
Forces you to pay sooner.
Yes. Similarly, limits on short-term lines of credit from banks.
Yeah.
If your bank reduces your overdraft facility or your available credit line, your readily available buffer of borrowed funds shrinks, effectively pulling liquidity away. This could be specific to the company's situation or due to broader economic worries.
Less access to backup funds.
Right. And finally, just having a chronically low liquidity position acts as a pull. Always scrambling for cash, always just barely meeting obligations, puts constant pressure on outgoing cash flow.
Living on the edge constantly.
Yes. Now, example 4 looks at these drags and pulls for Q Corporation again. It gives 3 trends and asks which one doesn't contribute to liquidity challenges.
Okay, let's see.
The trends are an increase in average days sales outstanding.
That's receivables taking longer to collect. That's a drag, so it is a challenge.
Right. Second, an increase in days of inventory on hand.
Inventory sitting longer. That's also a drag, another challenge.
Correct. And third, an increase in the company's credit limits granted by its lenders.
If lenders are giving more credit, that's actually improving their access to liquidity. That's a positive factor, not a challenge.
Exactly. So that's the answer. It shows how important it is to understand whether a change is helping or hurting liquidity.
Absolutely. So, students, another check. If a company finds that its customers are delaying their payments more often, would this be considered a drag on liquidity or a pull on liquidity? Is cash inflow slowing or outflow speeding up?
Think about where the impact is felt.
Right, we've talked about what liquidity is, where it comes from, and what can hurt it. But how do analysts actually measure it? How do they put a number on it?
The ratios. Yes, analysts use financial ratios to quantify liquidity. These ratios help compare companies, maybe of different sizes, or track how one company's liquidity is changing over time.
Like checking your pulse or temperature to see if you're healthy.
Exactly. These ratios are like financial health checks for liquidity. Exhibit 9 in our materials summarizes 3 key ones we should know.
Okay, let's look at them. What's the first one?
The first and broadest one is the current ratio.
Okay, the current ratio.
It's calculated simply as current assets divided by current liabilities. That's equation 6. It tells you, basically, how many rupees of current assets the company has for every 1 rupee of current liabilities it owes.
So if the ratio is 2.
It means the company has twice as many current assets as current liabilities. Generally, a ratio greater than 1 means the company has positive working capital, which is usually a good sign. A higher ratio typically indicates greater liquidity, more cushion.
Okay, current assets, current liabilities, broad measure. What's next?
Next is the quick ratio, which is also sometimes called the acid test ratio.
Acid test. Sounds serious. Why quick?
It's quick because it only considers the assets that can be converted to cash relatively quickly. It's a bit stricter than the current ratio.
Yeah.
The formula, equation 7, is cash plus short-term marketable securities plus accounts receivable divided by current liabilities.
What's missing compared to the current ratio?
Inventory. It deliberately excludes inventory from the asset.
Why exclude inventory?
Because, as we discussed, inventory is often the least liquid of the current assets. It can take time to sell, and you might have to offer discounts. So the quick ratio asks, can the company pay its immediate bills even without having to sell off its inventory?
Okay, so it's a tougher test of liquidity. Especially important if inventory might be slow-moving.
Exactly. A quick ratio greater than 1 is generally seen as a sign of good short-term financial strength.
All right, current ratio, then the stricter quick ratio. Is there an even stricter one?
Yes, there is. The most conservative measure is the cash ratio.
Cash ratio. What does that include?
This one only considers the absolute most liquid assets, cash plus short-term marketable securities. That sum is then divided by current liabilities. That's equation 8.
So it ignores receivables as well.
Yes. It basically asks the question, can this company pay off all its immediate bills using only the cash it has on hand and investments that are practically as good as cash?
Wow, that's the ultimate test, isn't it?
It really is. A cash ratio of 1 or more means the company has extremely strong liquidity. It could satisfy all its short-term obligations right now without selling any inventory or even waiting for customers to pay their bills. Very few companies achieve this consistently, but a higher ratio is better.
So if we rank them by how strict or conservative they are,
the order would be cash ratio is the strictest, then quick ratio, then current ratio is the broadest. It's because each one adds more types of assets into the numerator. Cash ratio, quick ratio, current ratio.
Okay, that makes sense. Cash only, cash plus receivables plus inventory, roughly speaking.
Precisely. Okay, students, question time again. Which of these three ratios, current, quick, or cash, would tell us if a company can pay all its immediate bills using only its readily available cash and easily sellable investments? Which is the most conservative one?
Think about what assets each one includes.
Now, let's see these ratios in action. They aren't just abstract calculations, they tell a story. Let's look at the Plow Corporation example from one of the self-assessment questions in the source.
Okay, Plow Corporation.
We are asked to calculate the cash ratio for 2 years, 20x1 and 20x2. The calculation shows the ratio was 0.1667 in 20x1.
Meaning they had about 17 pairs of cash for every rupee of current liabilities.
Right. But in 20x2, the ratio increased to 0.20,
So 20 pairs of cash per rupee of liability.
an improvement. Exactly. Based purely on the cash ratio, their immediate liquidity position improved from 20x1 to 20x2.
Okay, straightforward application.
Now let's look at the Liquidity NV example from the knowledge check questions. This one is a bit more interesting because it highlights why using just one ratio can sometimes be misleading.
Potential contradiction. Let's see.
First, we see their net working capital increased quite a lot, from EUR 16 million in 20x1 to EUR 65 million in 20x2. And the text notes this was mainly due to a big increase in inventory.
Okay, more inventory drove up net working capital.
Now let's calculate all three ratios for both years for Licht Renewend.
Okay, cash, quick, and current for 20x1 and 20x2.
Right, when we do that, we find something intriguing. The cash ratio actually declined from 0.60 in 20x1 to 0.50 in 20x2.
Declined. So less immediate cash relative to liabilities.
Yeah.
Worse liquidity by that measure.
Yes, and the quick ratio, which includes receivables but not inventory, also declined from 1.00 in 20x1 down to 0.89 in 20x2.
Declined again. So both stricter measures show liquidity got worse.
But the current ratio, which includes that big increase in inventory, actually increased. It went up from 1.36 in 20x1 to 1.52 in 20x2.
Increased. So the broadest measure shows liquidity improved. How can that be?
It's because the current ratio was boosted by the large increase in inventory. Inventory is a current asset, so it pushes the ratio up.
But inventory is the least liquid current asset. So while the total current assets look better relative to liabilities, the quality or immediacy of that liquidity, as measured by the cash and quick ratios, actually went down because it's tied up in inventory.
Exactly. That's the crucial point. Relying only on the current ratio here would give you a potentially misleading sense of improved liquidity. The cash and quick ratios tell a different, perhaps more cautionary story about their immediate ability to pay bills.
It really highlights why analysts look at multiple liquidity ratios together. You need the full picture. It's like looking at a cricket scoreboard. You don't just look at the total runs. You look at wickets lost, the run rate, who is batting. Multiple factors tell the real story of the match.
Excellent analogy. The ratios together paint the picture.
Okay, final ratio question for the students. If a company's quick ratio is significantly lower than its current ratio, what does that immediately tell you about the composition of its current assets? What asset category must be relatively large?
Think about what's different between the two formulas.
So we've covered the cycles, working capital management, liquidity sources, drags, pulls, and measurement ratios. What's the big picture goal here?
The ultimate goal, really, of managing working capital and liquidity effectively is quite simple at its core. It's to maximize the company's value for its owners, the shareholders,
While always ensuring.
while always ensuring the company has enough cash to meet its day-to-day needs and pay its debts as they fall due. It's about being efficient.
Not letting cash sit idle unnecessarily.
Right. You want to minimize idle cash and excess working capital so that money can be put to better use, invested in profitable projects, used for growth, or returned to investors. And ideally, you achieve this alongside a short, efficient cash conversion cycle.
But always tailored to the specific business, yes.
Oh, absolutely. Every business is different. A company making large, custom-built furniture will manage its inventory and receivables completely differently than a grocery store selling fresh vegetables daily. The business model dictates so much of the strategy.
Yes, and a key part of executing that strategy involves having a smart, short-term financing strategy. It's not just about if you need to borrow short-term, but how you approach it.
How you manage those short-term loans and credit lines.
Exactly. It's not just reacting when you need cash, but having a plan. What are the objectives of a good, prudent strategy here?
Good question. What should companies aim for?
Well, first, diversified credit sources. Don't put all your eggs in one basket. Don't rely on just one bank or one type of loan.
Like when planning for a big expense, maybe a wedding? You don't rely on just one source for funds, do you?
Exactly. You might have some savings, maybe borrow a bit from family, perhaps take a small personal loan. Diversification gives you options and reduces dependency. Same for a company. Have relationships with multiple banks, maybe access commercial paper markets if you're large enough.
Okay, diversify sources. What else?
Second, ensure adequate funding capacity. You need to have enough credit available to handle your peak needs. If you're a retailer, your busiest season might be around Diwali. You'll need more cash then for extra inventory, maybe extra staff. Your credit lines need to be large enough to cover those peaks.
Plan for the busy times. Makes sense.
Third, always seek competitive rates and terms. Don't just accept the first loan offer. Shop around, negotiate. Understand the interest rates, the fees, the covenants or conditions attached to the loan. Minimize your cost of borrowing.
Be a smart shopper for loans.
Yes. And fourth, always consider both implicit versus explicit costs. Remember our Kuhn Corporation example with the supplier discount?
The 44.6% cost of not taking the discount.
That 44.6% was an implicit cost. It wasn't written on any loan document, but it was a real cost of choosing that source of funding. Delaying payment? You need to compare the explicit interest rate from a bank loan against these hidden implicit costs of alternatives like trade credit.
Look beyond the obvious interest rate.
Definitely. Now, what influences the choices a company actually makes about its short-term funding?
Must be several factors.
Indeed. The company's size is a big one. A small startup might only be able to get a loan from its local bank branch. A huge multinational corporation can issue bonds in international markets. Access differs greatly.
Okay, size matters.
Creditworthiness. Just like for an individual applying for a home loan, a company's credit history and financial health are critical. A better credit rating means easier access to loans and lower interest rates.
Good credit pays off.
Absolutely. Then there are legal and regulatory constraints. Different countries, different industries have different rules about borrowing. A regulated utility company in India might face different borrowing restrictions than a tech startup.
Rules of the game.
Yes. And finally, the nature of the company's underlying assets can matter. If a company has assets that are easily valued and sold, like high-quality receivables or marketable securities, it might be able to use them as collateral to get secured loans, which are often cheaper than unsecured loans.
Using assets to back the loan.
Right. So pulling this all together, planning is key. Good financial managers constantly forecast their cash positions, try to match the timing of debt repayments with when they expect cash to come in.
Like planning your loan EMI payment just after your salary or festival bonus arrives?
Exactly that kind of thinking.
Yeah.
And they try to spread out their debt maturity so not too much comes due all at once. All these planning steps help reduce risk and manage liquidity smoothly.
It's proactive, not reactive.
Let's apply this strategic thinking one last time with the knowledge check question about Kuhn Corporation needing CAD $200,000 urgently for payroll.
Okay, they need cash fast. What are their options?
They consider three options.
Delay paying accounts payable of CAD $200,000, but this means giving up a 2% early payment discount. Cost new percent of $200,000 equals CAD $4,000.
Okay, cost is $4,000.
2. Sell accounts receivable. To get CAD $200,000 cash, they'd have to sell receivables at a 10% discount. So they need to sell $200,000 1.10 euro, CAD $222,222 worth of receivables. The cost is the discount, 10% of $222,222, which is CAD $22,222.
Wow, much higher cost.
Oh.
$22,222.
Yes. Option 3, sell marketable securities. They can sell CAD $200,000 worth, and the only cost is a 0.5% brokerage fee. Cost equal 0.5% of $200,000 equals CAD $1,000.
Only $1,000. That's clearly the best option.
Overwhelmingly the best. Selling the marketable securities is the cheapest way to get the needed cash quickly. This illustrates exactly what we discussed. Companies must always compare the true cost of different short-term funding sources, including fees, discounts given up, etc., to make the smartest financial decision.
A very practical outcome. Okay, final question for everyone listening. Why is it generally important for a company to have diversified sources of short-term credit rather than relying on just one bank? What's the main risk of relying on only one source?
Think about what happens if that one source dries up.
Phew. That was indeed a deep dive, wasn't it? We've covered a lot of ground today on working capital and liquidity.
We certainly have, from the operating cycle to the ratios.
You've seen how managing a company's short-term money is,
Yeah.
in many ways, like balancing your own household budget, just on a much larger scale.
Yes. You need enough cash for daily needs. You need to manage who owes you money and who you owe money to.
And you absolutely need a plan for when funds might run low or when unexpected bills arrive.
Mm-hmm.
Understanding the cash conversion cycle helps us see how efficiently a company turns its investments back into cash. Liquidity measures tell us about its ability to meet those immediate bills.
And the different approaches, conservative, moderate, aggressive, show how companies balance risk and cost based on their situation.
It all paints a picture of operational efficiency and financial health.
Indeed. And as you, our students, continue your journey in finance, please remember this one fundamental point. Even the most profitable company on paper can fail if it runs out of cash.
Profitability isn't enough for survival.
No. Profitability is important, of course, but liquidity is survival. Cash is king, as they say. So, the next time you read about a company struggling, perhaps even going bankrupt, ask yourself, were they actually unprofitable? Or did they simply run out of ready cash to pay their bills? Often, it's the latter.
A sobering thought.
And it leads to a final provocative thought for you to consider. In today's world, where business models are changing so fast, payment methods are evolving constantly with digital technology, and supply chains face new disruptions. How will the very definition and the strategic management of liquidity continue to transform in the coming years? What will liquidity management look like a decade from now?
That's something to really think about. How will these concepts adapt?
Exactly. Keep learning, keep questioning. Thank you for joining us for this deep dive today. We hope it was helpful.
Yes, thank you all. Alvida, and all the very best for your studies.
Namaste, and a very warm welcome, everyone, to the deep dive. We are so glad you've joined us today.
Hello to all of you. It's always a pleasure to spend this time with you.
Absolutely. I'm one of your guides today, and I'm here with my colleague. We're ready to guide you through another, well, really important journey in the world of finance. Our aim, as always, is to make these deep dives clear, understandable, and truly helpful for your learning.
That's right. And here at the Deep Dive, our mission is simple, really. We want to simplify these sometimes complex financial concepts. We want you to feel like you're in a supportive classroom, patiently building a strong foundation in finance, step by step.
Exactly. And today we're embarking on a truly crucial topic. This is especially for all you aspiring finance professionals and dedicated CFA students out there who might be new to finance. The topic is capital investments and capital allocation.
It sounds big, maybe. But you see, understanding how companies decide where to put their biggest, most important money for the long-term well, that's absolutely fundamental. It's key to understanding how businesses grow and, create value.
It really is. To help you visualize this, maybe think about your own family deciding on a big expense.
Yeah, not just buying groceries for tonight, no. We're talking about something much bigger, like deciding whether to build a brand new, bigger house, maybe, or perhaps doing a really significant renovation on your old one.
That's not a quick decision, is it? It's a massive long-term commitment. It involves a lot of money, careful planning, and a vision for the future, right?
Precisely. Companies face choices like these every single day, but usually on a much, much larger scale.
That's such a clear analogy. So our mission today is kind of threefold. First, we'll unpack what capital investments truly are. What do we mean by that term?
Second, we'll explore how companies systematically decide where to put their hard-earned money. That's the capital allocation part of it.
And third, we'll dive into the powerful analytical tools they use to make these big decisions. We're talking about key concepts like net present value, or NPV as we call it.
And also internal rate of return, which we usually shorten to IRR. And another one, return on invested capital, or ROIC.
We'll also peek into some, common mistakes that companies often make in this critical process. It happens. And we'll introduce you to a really fascinating concept called real options, which adds a lot of strategic flexibility.
Now, please don't worry if these terms, NPV, IRR, ROIC, real options, sound new or maybe a bit daunting. We promise we'll go step by step. We'll patiently explain everything with everyday examples, especially ones drawn from our Indian context, to make sure these finance concepts become really clear for you.
Okay, so let's begin our deep dive together. All right, let's start right at the foundation. What exactly are capital investments?
Well, simply put, capital investments are those significant expenditures a company makes on assets. Assets that have a long, useful life, typically we mean 1 year or longer.
Right. And you'll actually see these appearing on a company's balance sheet. They're listed under long-term assets. So when a company buys a new machine or, say, constructs a factory building,
Or even invests in a sophisticated new software system that they plan to use for many years.
Exactly. Those are all examples of capital investments. Big, long-term spending.
That's right. Now, it's very important for you to understand how these are recorded in a company's books, in their accounting.
Okay.
When a company first acquires a new asset, like that new factory building you mentioned, its full initial cost is recorded on the balance sheet. That's straightforward. But on the income statement, the statement that shows profit or loss, you don't see the entire cost hitting all at once in that first year.
Ah, okay, so it's treated differently?
Yes. Instead, a portion of that cost is systematically expensed each year. It's spread out. This non-cash expense, we call it depreciation, for tangible assets, things you can touch, like machinery.
Right, like the factory building or the machine.
Exactly. And we call it amortization for intangible assets, things you can't physically touch, like patents or software rights. And this cost is spread over the asset's estimated useful life.
Why do they do that? Why spread it out?
Well, it helps to smooth out the cost over time, you see. It tries to match the cost of the asset with the benefits, like the revenue, that the asset helps generate in each period. It makes the profit figure a bit more stable year to year.
Okay, that makes sense. But what about the actual cash spent?
Ah, good question. On the statement of cash flows, which tracks actual cash moving in and out, the full cash amount spent on the capital investment is reported right when it's paid out. So accounting profit and cash flow can be quite different because of this.
Let's make this clearer, maybe with a simple Indian example for depreciation. Imagine your local Kirana shop owner, okay? He decides to buy a new delivery scooter. Let's say it costs $60,000.
Okay.
Now, that scooter isn't going to be used up in just 1 year, is it? It will likely last for maybe 3 years?
Probably, yes.
So instead of saying the shop had this massive $60,000 expense in the first year, which would make their profit look very low, accounting rules allow them to spread that cost. They might record, say, $20,000 as depreciation expense each year for 3 years on their income statement.
Right, so $20,000 in year 1, $20,000 in year 2, and $20,000 in year 3.
Exactly. Now, this isn't just some accounting trick. It's a really crucial insight for an analyst. It gives you a window into how companies manage their reported profitability while still making these massive investments. Knowing this helps you see the true cash picture behind the accounting numbers. It's a bit like how your own mobile phone loses value over time, right? But its cost isn't just a sudden one-time hit in your mind.
Precisely. And it's vital to clarify something else, too. Capital investments aren't solely about tangible assets, things like buildings, machinery, or vehicles. Nowadays, companies are investing very heavily in intangible assets as well.
Like what, for example?
Things like developing new digital capabilities, acquiring patents for inventions, or funding significant research and development projects, R&D.
Ah, okay. So even things you can't touch can be capital investments.
Yes, absolutely. But the core principle for evaluating all these investments, whether tangible or intangible, remains the same. Our primary focus, as analysts, is always on the cash flows they are expected to generate over their long lives. Always comes back to the cash.
So from an analyst's point of view, then, why are these capital investments so incredibly important for us to understand deeply? Why focus on them?
Ah, that's a very perceptive question. They are crucial because, well, they offer us a profound insight into a company's future prospects. They really reveal how effectively management is creating long-term value for shareholders, not just focusing on short-term profits.
So it's about the future, not just the past.
Exactly. These investments are quite literally the building blocks of a company's future growth and profitability. Now, to help us understand the unique risk and return characteristics of different types of projects, our sources explain that we can group capital investments into 4 main categories.
Okay, 4 groups.
Yes. And understanding these isn't just about putting labels on things. It's really about predicting a company's strategic direction and future.
4 categories. Very interesting. Let's explore each one then. What's the first?
Yes. The first category is going concern projects. These are sometimes referred to as maintenance capital expenditures, or maintenance CapEx, you might hear.
Okay, maintenance, like keeping things running.
Exactly. These are essential investments a company makes simply to continue its current operations and maintain its existing size or level of business activity. They're really about keeping the business running smoothly day to day.
So, like, ensuring the lights stay on in the factory and the machines keep running efficiently, making sure things don't break down.
Precisely. Think of it like a popular bus company, maybe in Delhi or Mumbai, that regularly replaces its old, worn-out buses with new ones. They're not necessarily expanding their routes or adding hundreds more buses to their fleet initially. They're just ensuring their existing service runs smoothly, safely, and reliably for passengers.
Okay, makes sense. Like replacing,
Or imagine a large textile factory, perhaps in Gujarat. They might be updating their old, less efficient weaving machines. They're doing this not necessarily to dramatically increase production volume right away, but primarily to ensure they can continue producing efficiently, maintain the quality of their fabric, and avoid costly breakdowns that stop production.
Got it. So these are pretty standard, necessary things.
Yes, usually these projects are relatively straightforward for management to evaluate because they involve replicating or improving existing, well-understood operations. Consequently, they generally carry lower risk compared to other investment types.
Okay.
And a smart financial move here, often highlighted in our readings, is something called match funding.
Match funding, what's that?
It basically means borrowing money for a term, for a duration, that closely matches the expected lifespan of the new asset you're buying. So if the machine lasts 5 years, you try to get a loan for about 5 years.
Why is that smart?
It reduces something called rollover risk. That's the risk that when your short-term loan matures, maybe after just 1 year, you can't refinance it on good terms, or perhaps you can't refinance it at all because your asset, your machine, still has maybe 4 years of useful life left. Match funding avoids that problem.
Ah, I see. Aligning the funding with the asset life. And as analysts looking from the outside, we often find a useful shortcut, don't we? We often estimate a company's annual maintenance capital expenditure to be roughly equal to the amount of depreciation and amortization expense they report on their income statement.
That's a good rule of thumb, yes. It's a common proxy, giving us a quick idea of what they might need just to stay in business, just to maintain their current level.
But it's just an estimate, of course.
Absolutely. Always remember it's an estimate, not always precise to the last rupee. Okay, now for our first check for understanding for all of you listening. So, if a factory owner replaces a worn-out machine with a similar new one, what type of capital investment is that, and why is it important for the business? Take a moment to think about it.
And while you're contemplating that, let's move to the second category, regulatory and compliance projects.
Right. Now, these are investments that are, well, generally not optional for a company. They're often mandated by laws, government standards, or specific industry regulations. You have to do them.
So things the government or regulators tell you to do.
Precisely. For example, maybe a textile factory is legally required to install new, advanced water treatment plants to meet strict government environmental norms, like pollution control rules. This specific investment might not directly increase their sales or revenue at all.
In fact, it probably just adds cost.
It likely does. But it is absolutely necessary to avoid heavy fines, perhaps costly legal battles, reputational damage, or even just to continue their operations legally. They might lose their license otherwise.
Okay. Any other examples?
Another common Indian example is a bank upgrading its internal computer systems to comply with new KYC Know Your Customer regulations introduced by the Reserve Bank of India. It's an expense, yes, a hassle perhaps, but it's crucial for legal and ethical operation and to prevent things like money laundering.
Right. Banks have to do a lot of that.
They do. Now, these projects often increase a firm's expenses without directly adding to revenue, as you said. But they are essential to avoid severe penalties, damage to the company's reputation, or even being forced to shut down. Interestingly, sometimes these stringent regulations can act as a significant barrier to entry for new competitors.
How so?
Well, a new company starting up might find it too costly to comply with all these complex rules right from day one, making it harder for them to enter the market and compete with established players who have already made these investments.
Ah, that's an interesting side effect.
And some shrewd firms even adopt new rules early, before they are strictly enforced, maybe to gain a competitive edge or enhance their public image as being responsible.
I remember our source material mentioned the Danske Bank anti-money laundering investigation, the huge penalties and the comprehensive changes they had to implement because they didn't comply earlier. Well, that really highlights just how critical these investments are, even if they don't seem profitable on their own in the short term.
That's a powerful point. Avoiding those huge fines and, perhaps more importantly, this severe damage to your reputation, that's a big part of creating long-term value for shareholders, too.
Definitely. Okay, time for your next check for understanding. Why might a company choose to invest in a regulatory compliance project even if it doesn't directly bring in more money or boost sales? Think about the deeper necessity or maybe even a hidden benefit.
Good question. All right, moving on to our third category. This is often what most people think of when they hear the word investment: expansion projects.
Growth.
Yes. As the name clearly suggests, these are investments explicitly aimed at growing the business, taking it to the next level. This could mean increasing the scale of existing activities or maybe expanding into new but related areas, or even entering completely new geographical markets.
Okay, so this is about getting bigger or broader.
Exactly. These projects generally involve a much greater degree of uncertainty compared to maintenance or regulatory ones. They usually take more time to implement, and they certainly require significantly more capital.
Makes sense. More ambitious means more risk and cost.
Our sources highlight two main types under this expansion umbrella. First, there's expansion of existing business. This is pretty straightforward. It's about increasing the size of your current successful operations.
Okay, like doing more of what you already do well.
Exactly. Think of a very successful restaurant chain, perhaps like Saravana Pavan or Haldiram's in India. They might decide to open several new branches in different cities across the country. They're replicating their successful formula, just on a larger scale.
Right. But even if they're successful already, these expansion projects must come with their own unique set of risks, right? Like execution risks.
Absolutely. You need to source more ingredients reliably, manage a much larger workforce across different locations, deal with new logistical challenges like transport and storage, and you have to budget for acquiring new customers in those different cities who might not know your brand yet. It's not automatic.
And how do companies typically fund these?
Well, early phase companies that are expanding rapidly often rely more on equity financing selling shares
Yeah.
because they're typically seen as riskier and might not have established predictable cash flows yet to support taking on a lot of debt. In contrast, more established firms with a proven track record of success might comfortably use debt financing for expansion.
Okay. And the sources gave examples like pharmaceutical companies investing heavily in R&D for new drugs.
Yes, or energy exploration companies investing to find new oil or gas reserves, or tech companies accelerating their product development to capture market share. These are all about growing their core business capabilities.
Got it. What's the second type of expansion?
The second type is expansion of business scope. This means extending your existing operations to adjacent products or services, or maybe moving into new regions that can leverage your existing capabilities.
So related but slightly different.
Exactly. For instance, imagine that popular clothing brand you love suddenly decides to launch a new line of home decor, maybe bed sheets, cushions, things like that. They are cleverly leveraging their existing brand recognition, their design skills, perhaps even parts of their supply chain, but they're venturing into a slightly different product category.
Okay, I can see that happening.
Or the sources cite Sony acquiring Bungie, the game developer. Sony wanted to grow its gaming business, yes, but also specifically enhance its expertise in live game services games that run continuously online. So while it's still within the gaming industry, it expands their strategic approach within that ecosystem.
What are the risks here?
The key risks often involve managing increased operational complexity, different products, maybe different customer types, and also potentially facing new, strong competitors who are already established in that slightly different space you're entering.
Right. New territory means new challenges. Okay, so for your understanding, a quick question for everyone. What's the main difference between a going concern or maintenance project and an expansion project in terms of a company's strategic goals? Think about the fundamental purpose behind each type.
Excellent. And finally, we arrive at our fourth and often, well, most daring category, new lines of business and other projects.
Okay, this sounds adventurous.
It often is. These are investments in activities that are completely outside or perhaps only minimally related to a company's existing core business. It's a real leap.
So these must be the riskiest capital investments a company can make.
Generally, yes,
Yeah.
by far. They often resemble investing in a completely separate startup or acquiring a firm in a totally new, unfamiliar industry. Imagine a well-known Indian automobile company, like Tata Motors or Mahindra, suddenly deciding to invest a huge sum in a space technology startup that develops rockets or satellites.
Wow, okay. That's completely different.
Exactly. It's a totally new area for them. It requires different expertise, different supply chains, a different understanding of the market, different regulations. The risks are inherently very high because the company is dealing with unfamiliar challenges, new competitive landscapes, and also the significant possibility of overpaying if they acquire a company in an industry they don't really understand well.
That makes sense. Paying too much for something you don't fully grasp.
Our sources give an intriguing example. Kirin Holdings, which is primarily a beverage producer in Japan, invested in Fancl, which is a cosmetics and dietary supplement maker.
That's quite a strategic leap, isn't it? From drinks to cosmetics.
It certainly is. So as analysts, how should we view these kinds of big, diversifying moves? Well, from an analyst's perspective, when you're studying a company, you should pay very close attention to the overall level and also the trend of their expansion capital investment, especially these new lines of business investments,
Why specifically?
because it helps you analyze their true growth prospects. Are they finding growth within their core, or are they forced to look elsewhere? It helps you understand management's priorities. Are they sticking to their knitting, as they say, or are they diversifying boldly, maybe too boldly? And it helps you assess the potential returns they expect from these risky ventures.
Can we estimate how much they're spending on expansion versus just maintenance?
You often can, roughly.
Yeah.
You can estimate the level of expansion capital spending by taking the company's total reported capital expenditures from their cash flow statement and subtracting the maintenance capital portion. And remember our rule of thumb. We can estimate maintenance capital as being roughly equal to the depreciation and amortization expense from the income statement.
Ah, right. Total CapEx minus D&A gives a rough idea of growth spending.
Exactly. It's an estimate, but a useful one. Okay, now, for your final check-in for this first part. Why are new lines of business projects usually considered the riskiest types of capital investments for a company? What makes them stand out so much from the other categories we discussed?
Great. So we now have a good handle on the different types of capital investments.
Excellent. With that understanding firmly in place, let's now shift our focus to part 2, the capital allocation process and core tools.
Yes. We've talked about what capital investments are. Now let's understand how companies systematically decide which ones to pursue, which ones to fund, and maybe which ones to delay or reject. It's a process.
Okay, so to define it clearly first, what exactly is capital allocation?
In essence, capital allocation is the structured and systematic process that a company's management team, usually working closely with its board of directors, uses to evaluate all the potential investment opportunities that are available to the firm.
Okay, evaluating all the options. And what's the main goal? The ultimate, overriding goal is almost always to increase shareholder value over the long term. But importantly, companies today are increasingly considering other vital factors as well, like ESG aspects, environmental, social, and governance impacts of their investments. It's becoming broader.
Right, so it's not just about profit anymore, but that's still the core financial goal. The primary objective of effective capital allocation is to ensure that the company directs its capital, its money, towards projects and initiatives that are expected to deliver risk-adjusted returns. Returns that are greater than what investors could earn elsewhere on investments of similar risk.
That risk-adjusted part is key, isn't it?
Absolutely. And as an analyst, your role here is absolutely critical. You need to develop a keen judgment, a good sense of whether the company's management is allocating capital wisely over the long term. How do you do that? Well, you do it by meticulously evaluating their capital allocation process itself. How do they make decisions? And perhaps even more importantly, by scrutinizing their historical track record. How well have their past investments actually performed?
Actions speak louder than words sometimes.
Indeed. Now, our sources lay out 4 generic steps in this capital allocation process. Think of them following a very logical progression, like steps in a staircase leading up to a good decision.
Okay, 4 steps. Let's start with the very first step. Idea generation. Where do the ideas for projects come from?
Good question. Ideas for new projects can truly come from anywhere within the company, maybe from the people working on the shop floor, maybe from engineers, maybe from sales teams, or right up to the executive boardroom.
So not just top down.
Ideally not.
That.
But it's crucial that wherever the idea comes from, management deeply understands the competitive environment that the potential investment would operate in. And also, they need to understand the firm's existing operations and capabilities. Can we actually do this project well?
Makes sense. You need to know the landscape and your own strength.
Often, the best and most innovative ideas spring from managers who are directly involved in the day-to-day business. They see opportunities firsthand. Maybe opportunities to expand scale or broaden the scope of what they do, or even venture into adjacent businesses that someone sitting in headquarters might miss.
And sometimes external consultants are also brought in, right? To provide fresh perspectives or specialized knowledge.
Yes, that happens too. It's quite interesting to observe, though, that capital spending levels tend to be highly correlated from year to year in many companies. What does that suggest? Well, it suggests that prior period ideas and plans often heavily influence the new ones. Sometimes this leads to inertia, a reluctance to change, which we'll discuss later as a potential pitfall.
Okay.
Oh.
Sticking to what, maybe too much. What's step 2?
Once these ideas are generated and gathered, we move to the second step, investment analysis. This is where the rigorous quantitative work really begins, crunching the numbers.
Okay, the analysis part.
Yes. Managers must meticulously forecast several things about the potential investment's future cash flows: the amount of cash expected, the precise timing of when it will arrive, the duration over which it will continue, and even the potential volatility or uncertainty around those cash flows. The entire goal of this step is to estimate whether this particular investment is truly a wise and value-adding use of the company's precious capital. Is it worth the risk and the money?
And the second step, investment analysis, is precisely where our main analytical tools like NPV and IRR become indispensable. They help us quantify that potential value.
Right, the tools we mentioned earlier.
But before we deep dive into those specific tools, let's quickly talk about step 3, planning and prioritization.
Okay, so you've analyzed the ideas. Now what?
Now, management takes all the thoroughly analyzed investment opportunities, and they have to select and prioritize them. Which ones are the most profitable? Which ones, when considered together within the company's overall strategy, promise the greatest value enhancement on a risk-adjusted return basis? You probably can't fund everything.
So you have to choose the best ones.
Exactly. And a critically important principle here is that only investment candidates that are expected to generate returns greater than the investor's opportunity cost should be pursued. If a project can't clear that hurdle rate, that minimum acceptable return, it simply isn't worth undertaking from a financial perspective.
Let's make sure everyone understands opportunity cost properly. We can use an everyday Indian example again. Imagine you have 10,000 saved up. Okay?
Okay.
You could put it in a fixed deposit at your bank and earn, let's say, a guaranteed 7% interest per year, nice and safe. Or maybe you could invest that same euro 10,000 in your cousin's promising new business venture. He says it will grow quickly, maybe make a lot more than 7%.
The risky option versus the safe one.
Right. If you choose to invest in your cousin's business, the 7% interest you could have earned from that fixed deposit, the safe option you gave up, that is your opportunity cost. It's the return you sacrificed by choosing the alternative.
I see. The value of the next best alternative foregone.
Yeah.
Exactly. Companies face similar choices every single day. If they have capital, they could invest it in a new project within the company, or they could return that capital to shareholders, perhaps through dividends or share buybacks. Those shareholders could then invest that money elsewhere in the market to earn their own required rate of return.
So the company needs to beat what shareholders could do themselves.
Precisely. This is why, if there are genuinely no value-creative opportunities within the company that meet that opportunity cost hurdle, then the capital should be returned to shareholders. Let them find better opportunities elsewhere.
Okay, that's a key principle. Don't invest just for the sake of investing. It's about maximizing the value of every rupee, making sure it works hard. And the final step, number 4, monitoring and post-investment review.
Checking up afterwards. This sounds important.
It's crucial. This step involves continuously monitoring the investment's actual performance against the initial projections that were made back in the analysis phase. And then, based on that ongoing monitoring, making necessary adjustments.
Adjustments like what?
Well, perhaps increasing investment if the project is doing much better than expected and there's more opportunity. Or maybe decreasing investment or even stopping it altogether if it's performing poorly. It's about being dynamic.
Why is this step so important? The money's already spent, isn't it?
Yes, but this review is vital for several reasons. First, it helps to validate the fundamental assumptions made earlier in the process. Did we forecast revenues correctly? Were our cost estimates accurate? It can reveal systematic errors in forecasting, like maybe we are always overly optimistic about sales.
Okay. Learning from mistakes.
Exactly. Second, it enforces strong financial discipline in business operations. It focuses management's attention on aligning actual performance with the planned projections. People know their projects will be tracked. And finally, it can even generate valuable new ideas for future investments by highlighting what worked well and what didn't in the past.
So it feeds back into step 1, idea generation.
Precisely. The ultimate goal here is to keep investing capital in areas that are proving profitable and meeting or exceeding expectations, and to scale down or even dispose of assets in areas that are generating suboptimal returns. It ensures resources are always being deployed as efficiently as possible over time.
That makes a lot of sense. It's like checking your progress on a long road trip, isn't it? To see if you're still on the right path and maybe adjusting your route if you took a wrong turn or if there's a better way ahead. Okay, time for your next check-in question. Why is monitoring and post-investment review such a crucial step in the capital allocation process, even after the money has already been invested in a project?
Very good. Now, as you mentioned earlier, back in step 2, investment analysis, companies use powerful analytical tools to help them make these big decisions. The two most widely used tools for evaluating individual investment projects are net present value, NPV, and internal rate of return, IRR.
Right, NPV and IRR.
Both of these are basically applications of a fundamental concept in finance, the time value of money, which simply means
A rupee today is worth more than a rupee tomorrow.
exactly, because you can invest today's rupee and earn a return on it. And then, besides NPV and IRR for projects, we also have return on invested capital, ROIC. This is a broader company-wide measure that independent analysts like you listening can often calculate using publicly available financial statements.
Okay, so NPV and IRR for specific projects, ROIC for the whole company. Let's dive deep into each of these now, starting with the net present value, or NPV. This is really a core concept in finance, isn't it?
It absolutely is. So what is net present value, NPV? In simple terms, NPV is the present value, meaning the value in today's money of all the expected future cash inflows a project is expected to generate.
Okay, all the money coming in, valued today.
Minus the initial investments costs, which are the cash outflows, also valued today, though usually the initial cost happens today at time zero.
Okay, so present value of inflows minus present value of outflows. What does the result tell us?
It essentially tells you how much that project adds to the firm's total value today. If the NPV is positive, the project is expected to increase shareholder wealth. If it's negative, it's expected to actually subtract value.
Got it. Positive good, negative bad.
Basically, yes. The mathematical formula for NPV, as shown in our sources, looks something like this. NPV equals CF0 plus CF1 plus R1 plus CF21 plus RCR2 plus 0 plus CFT1 plus RT.
Okay, let's break that down a bit. CFT must be the cash flow at different times too.
That's right. CFT stands for the after-tax cash flow that occurs at time t. So CF0 is the cash flow today, usually the initial investment, so it's negative. CF1 is the cash flow at the end of year 1, CF2 at the end of year 2, and so on up to the end of the project's life at time t.
And what's the R in the denominator?
R is a very, very important rate. It's the required rate of return, often called the discount rate. This R represents what a company's investors could earn on an investment of similar risk elsewhere in the market. It's their opportunity cost, which we just talked about, for providing capital to this specific project.
Okay, so R is the hurdle rate, the minimum acceptable return based on risk, and we use it to discount future cash flows back to today's value.
Exactly. Let's use that Indian example again to illustrate present value more clearly. Remember, you had $10,000. Imagine instead your friend promises to give you $1,100 exactly 1 year from now.
Okay, 1,100 next year.
Now, if the prevailing interest rate in the market, maybe on that safe fixed deposit, is 10% per year, how much is that promise of $1,100 next year worth to you today?
Well, if I had 1,000 today and invested it at 10%, in 1 year I'd have 1,000 plus 10% interest, which is $100. So I'd have exactly $100.
Precisely. So the promise of $1,100 next year is actually only worth $1,000 to you today, given that 10% interest rate. That $1,000 is the present value of $1,100 received in 1 year when the discount rate is 10%.
I see. It brings future money back to today's terms.
Exactly. And NPV takes all the future cash promises or cash flows expected from a project, brings them back to their value today using that discount rate R, sums them all up, and then subtracts your initial spending, CF0. It helps you compare apples to apples, value created today, no matter when the money actually changes hands in the future.
Okay, that's much clearer now. Let's quickly walk through example 4 from our source material, Gerhardt Corporation NPVI, to see this in action with some numbers. Gerhardt Corporation is considering a capital investment.
Okay. The initial investment, which is our CF00, is $50 million today. Since it's an outflow, money going out, we represent it as a negative number, €90 million.
Got it. Negative 50 million at time zero. And the project is expected to generate positive cash inflows of 16 million per year for the next 4 years, so at times 1, 2, 3, and 4, and then a larger inflow of 20 million in year 5 at time 5.
Right. And the company's required rate of return, or the discount rate for this project, is given as 10%.
Okay, so to calculate the NPV, we need to bring each of those future cash flows, 16 euros, 16 euros, 16 euros, 16 euros, 20 euros, back to today's value using that 10% discount rate, and then subtract the initial 50 million.
Exactly. So for year 1, the present value of 16 million is 16 euro, 1 plus 1 euro 1, which is about 14.545 million.
Okay.
For year 2, it's a 16 1.02, which is about 13.223 million. We continue this for all 5 years.
For year 3, it's 16 euro, 1 point neo in there. 3, about 12.021 million. Year 4 is 16, 1.04, about 10.928 million. And year 5 is 20 euro, 1.205, which is about 12.41 now we're at 1.
Good. Now, if you sum up all these present values of the inflows, 14.545 plus 13.223 plus 12.021 plus 10.928 plus 12.41, you get a total present value of inflows of approximately 63.136 million.
Okay, so that's the value today of all the money expected to come in. Now we account for the money going out.
Right. Now we subtract our initial investment, NPV, net of 15 euros plus 63.136 million. This gives us a positive NPV of approximately 13.136 million.
Ah, it's positive. That means the investment is expected to increase the firm's wealth by over 13 million in today's terms. That sounds good.
It does indeed. Oh, and a quick practical note, if you're using spreadsheet software like Excel, when you use the built-in NPV function in Excel, please remember it usually assumes the first cash flow you give it occurs at time T1, not TOA. So your initial investment, which happens at TOA, needs to be handled outside the function. Typically, you calculate the NPV of all flows from year 1 onwards using the function, and then subtract the initial CSCO separately. Just a common mistake to watch out for.
Good tip. Okay, so we have the NTV. Now let's establish the NTV decision rule clearly. It seems simple.
It is quite straightforward. You should invest if the NPV is greater than or equal to 0. And you should not invest if the NPV is less than 0.
Okay, so positive or 0 NPV means go ahead. Negative NTV means stop.
Exactly. A positive NPV clearly means the project is expected to increase shareholder wealth, which is generally the goal. A negative NPV, however, would actually reduce shareholder wealth, so you should definitely avoid it.
What if the NPV is exactly 0?
If the NPV is exactly 0, it means the project is expected to earn exactly the required rate of return. So it's technically acceptable because it meets the investor's minimum requirement. But it leaves absolutely no margin for error or unexpected negative surprises. Many managers prefer a cushion, a positive NPV.
Right. Some buffer is good. And you mentioned NTV EUR is necessary, but maybe not always sufficient. What does that mean?
It means that while a project must have a non-negative NPV to even be considered financially viable, there might be other factors that influence the final decision. Maybe there are strategic reasons to do a project even if the NPV is slightly negative. Or maybe there are 2 projects with positive NPVs, but you only have enough money for one. We call those mutually exclusive projects, so you pick the one with the higher positive NPV. Or maybe there are non-financial factors like ESG considerations that play a role. So NPV is a crucial hurdle, but not always the only one.
Got it. Now, you also mentioned earlier that cash outflows don't just happen at the very beginning at time 0. Our sources discuss unconventional cash flow patterns, as shown in Exhibit 5. Can you elaborate on that?
Yes, absolutely. It's quite common in real-life business scenarios that additional cash outflows might occur at later dates too. It's not always just one big spend up front.
Like what?
For example, maybe a company needs to invest in additional production capacity a few years into the project if demand grows faster than expected. Or perhaps a major overhaul or refurbishment of equipment is needed midway through a project's life. These are subsequent cash outflows.
Okay. Does that complicate the NPV calculation?
Not really the calculation method itself. You still just discount all cash flows back to the present. But it means you need to be careful to include all cash flows, positive and negative, at the correct time periods. Let's look at example 5, Gerhardt Corporation NPD2 from the source. Here, the initial investment is again 50 million today, so CS0 equals 00050 million. But the subsequent cash flows are a bit more complex. 10 million inflow at time 1. Then, interestingly, a negative 5 million at time 1.5 neuro. Maybe that's for an expansion halfway through the second year.
Ah, an outflow later on?
Yes. Followed by 13 million inflow at time 2, 16 million at time 3, 19 million at time 4, and finally 23 million inflow at time 5. The required rate of return is still 10%.
Okay, so we have flows at non-integer times too, like 1.5 years. How do we handle that?
The formula still works. You just use the exact t in the exponent. So the present value of the 5 million times 1.5 would be 1.5, 1.2, and 1.5. You calculate the present value of each of these cash flows, remembering the signs, positive for inflows, negative for outflows, and then sum them all up, including the initial negative euro million.
And what does the MPV come out to in this case?
For this project, the MPV comes out to approximately 4.78 million.
Okay, it's still positive, though smaller than the first example.
Correct. Since 4.78 million is greater than or equal to zero, the NPV rule says Gerhardt Corporation should still make this investment.
And for these unevenly spaced cash flows, like the one at time 1.5, you mentioned Excel has a special function.
Yes, for these situations where cash flows don't happen neatly at the end of each year, Excel has a very useful function called XMPV. It allows you to input the exact dates for each cash flow alongside the cash flow amount. This makes it much more flexible and accurate than the standard NPV function when dealing with real-world irregular cash flow schedules. So if you ever face complex timing, remember XMPV.
Good to know. Okay, now for your next check for understanding. Why is NPV considered a better measure for project evaluation than simply looking at how much total cash a project brings in over its entire lifetime? Think about what key factor NPV accounts for that simply summing up the cash does not.
Very well done. That's a key distinction, understanding the time value of money. Now let's move to our second key analytical tool, internal rate of return, or IRR. This is another very popular metric used by companies and managers.
Okay, IRR. What exactly is it? How is it defined?
It's defined as the specific discount rate, that unique interest rate that makes the net present value, NPV, of an investment exactly equal to zero.
Okay, the rate that makes NPV zero. What does that mean in simpler terms?
In simpler terms, you can think of it as the project's expected rate of return or its effective yield. It's the percentage return the project is expected to generate on the capital invested over its life.
So if NPV tells us the value added in currency, IRR tells us the percentage return.
That's a good way to think about it, yes.
Yeah.
If you think back to the NPV formula, where we plugged in the required rate of return R and calculated the NPV.
Yes.
With IRR, we're essentially working backwards. We set the NPV equal to zero, and we solve for the discount rate R that makes that equation true. That specific rate is the IRR.
Okay, so mathematically, the formula CFT, 1 plus IRRT plus 0, means we're finding the IRR that makes the sum of the present values of all cash flows, including the negative initial investment, equal 0.
Precisely. You are looking for that specific rate, the IRR, which, when used to discount all future cash flows back to the present and then netted against the initial investment, results in a net present value of exactly 0. It's like finding the break-even discount rate for the project.
The rate at which the project just covers its cost, in a sense.
Exactly. The point at which it just covers its cost in terms of time value of money.
Okay. Let's go back to example 6, Gerhardt Corporation IRR, using the same simple project as our first NPV example. Initial investment of $50 million today, so net of 50, then cash inflows of $16 million for 4 years and $20 million in year 5. We want to find the IRR for this stream of cash flows.
Right. We're looking for the discount rate IRR such that negative 50 plus 16, 1 plus 16, 1 plus 16, 1 plus IRR 2 plus 16, 1 plus 16, 1 plus IRR plus 20, 1 plus IRR 5 equals 0.
Now, calculating this manually looks difficult. You'd have to guess rates and try them out.
It can be quite complex, yes. It often requires trial and error, or using numerical methods like interpolation. But luckily, just like with NPV, spreadsheet software like Excel has a straightforward IRR function that does this calculation for us very quickly. You just need to input this series of cash flows, starting with the initial investment.
So if we input the cash flows, negative 15, 16, 16, 16, 20, into Excel's IRR function, what do we get?
For this project, the IRR comes out to approximately 19.52%.
Okay, 19.52%. Now, what do we do with that number? How does it help us decide?
Right, once you have the IRR, you need the IRR decision rule. It's also quite simple and intuitive. Invest if the IRR is greater than or equal to the required rate of return. And do not invest if the IRR is less than R.
So you compare the project's expected rate of return, IRR, to the minimum acceptable rate of return.
Exactly. That required rate of return, R, is often called the hurdle rate, as we mentioned before, because the project's IRR has to jump over or clear that minimum return hurdle for it to be considered worthwhile.
Let's use another personal example for the hurdle rate. Maybe if you are saving money for a very important family event, like your sister's wedding down the line, and you calculate that, given how much you need and how much time you have, you absolutely need your investment to grow by at least 8% per year to reach your financial goal on time.
Okay, 8% is the target growth rate needed.
Yes. Then that 8% is your personal hurdle rate for any investment you consider for that goal. You would only invest in something that promises to give you 8% or more. Anything less simply won't get you to your goal in time.
That's a very clear analogy.
Yeah.
So Applying that logic back to Gerhardt Corporation, their required rate of return, their hurdle rate R was 10%. We just calculated the project's IRR to be 19.52%.
Okay, so IRR, 19.52%, is definitely greater than the hurdle rate, 10%.
Much higher, yes. So based on the IRR rule, Gerhardt should definitely invest. This project promises a rate of return well above what their investors require for this level of risk.
That makes perfect sense. So both NPV and IRR gave the same yes decision for this project. Now, you mentioned earlier there's an important assumption behind IRR that we need to be aware of, something about reinvestment.
Ah, yes, this is a crucial point, and it's a potential and often debated limitation of the IRR method. The IRR calculation mathematically assumes that any interim cash flows generated by the project, meaning those cash flows received before the project fully ends, like the $16 million received in years 1, 2, 3, and 4, in our example, are somehow reinvested at the IRR itself.
Reinvest at 19.52% in our example.
Yes, the calculation implicitly assumes you can take that $16 million received in year 1 and immediately reinvest it somewhere else to earn 19.52% until the end of the project. And the same for the cash flows from years 2, 3, and 4.
Is that realistic? Can companies always find new investments that yield such high rates, especially if the IRR is very high, say 30% or 40%?
That's the potential problem. It might be unrealistic, especially if the IRR is very high. Finding subsequent investment opportunities that consistently yield, say, 30% or 40% might be very difficult in practice. The opportunities just might not be there.
So what does NPV assume about reinvestment?
NPV, on the other hand, implicitly assumes that interim cash flows are reinvested at the required rate of return, the discount rate used in the calculation, 10% in our example. This is often considered a more realistic and conservative assumption, as commonly represents the typical return a company expects to earn on average projects of similar risk.
Okay. So IRR assumes reinvestment at the potentially high IRR, while NPV assumes reinvestment at the usually more moderate required rate of return.
Exactly. This difference in the implicit reinvestment rate assumption can be very significant, especially for projects with long lifespans or large interim cash flows received early on. It's one of the main theoretical reasons why NPV is often preferred over IRR, especially when comparing projects. We will definitely delve much deeper into this specific point later in your CFA curriculum. It's a classic debate, but it's very important to be aware of this fundamental difference now.
Good to know. It adds nuance. Now, what about those unevenly spaced cash flows we saw with NPV? Can IRR handle that kind of irregularity too? Say, like in example 7, Gerhardt Corporation IRR 3.
That's a great question. Yes, it can. Just like NPV has its XNPV function for irregular timing, IRR has a companion function. For unevenly spaced cash flows for IRR, as illustrated in example 7, where cash flows are not received neatly at the end of each perfectly spaced period, Excel's XIR function is the proper tool to use.
Okay, XIR for irregular timing. Let's quickly look at the cash flows for that example again. Miscalira million at time 0 today, then 0 time 1, then 1 million inflow at time 2. Then, interestingly, a negative 3 million outflow at time 2.5, then 16 million inflow at time 3, 20 million at time 4, and 25 million inflow at time 5. A real mix.
Yes, quite unconventional. If you input these cash flow amounts into the XIR function in Excel, along with their respective dates or times 0, 1, 2, 2.5, 3, 4, 5, the calculated IRR for this particular project is approximately 6.76%.
Okay, 6.76%. Now, how do we use the decision rule? Gerhardt's required rate of return, their hurdle rate R, is still 10%.
Right. So since the calculated IRR of 6.76% is less than their 10% hurdle rate, Gerhardt should definitely not invest in this project based on the IRR rule. It fails to meet their minimum acceptable rate of return.
Got it. So XIR helps, but the rule is the same. Compare IRR to R. Now, is there another limitation of IRR we need to know about? Something about multiple answers?
Yes. Another critically important limitation of IRR that you absolutely must be aware of is the possibility of getting multiple IRRs for a single project.
Multiple answers. How can that happen?
This confusing situation can arise when the signs of the project's cash flows, meaning they switch from an inflow plus to an outflow or vice versa, change more than once over the project's life. Our earlier examples had only one sign change, from the initial outflow to subsequent inflows.
Okay, so if it goes negative, then positive, then negative again.
Exactly, or positive, negative, positive. Anytime there's more than one reversal of sign. For example, consider a project with cash flows like this: a $9,000 today outflow, then a large inflow of plus $5,000 in year 1, but then a large outflow again of negative year $6,000 in year 2, maybe for decommissioning costs. This project actually has two valid mathematical solutions for IRR, both 100% and 200%.
Wow. 100% and 200%. Which one is right? How do you decide them?
That's the problem. It's clearly confusing and makes the IRR unreliable for decision-making in these specific cases. Which rate do you compare to the hurdle rate? There's no clear guidance. So in such cases, where cash flow signs change more than once, NPV should always be used instead of IRR. NPV will always give you a single unambiguous answer, euro value added or subtracted, regardless of the cash flow pattern.
That's a very important warning. NPV avoids that confusion.
Yes. And be careful, because sometimes financial calculators or spreadsheet software might misleadingly return only one of the possible IRRs, often the lowest positive one, without warning you that others exist. This could lead to incorrect investment decisions if you're not aware of the potential for multiple IRRs with unconventional cash flows. Always check the pattern of cash flows first.
Crucial advice. Okay, so for your next check for understanding, what is a major underlying assumption of the IRR calculation that makes it sometimes less realistic than NPV, particularly for projects that generate significant cash flows over their lifetime?
Excellent point to remember. All right, we've explored both NPV and IRR in quite some detail now. We understand their mechanics, their decision rules, and some of their key assumptions and limitations. Now, let's address the elephant in the room, the big question: NPV versus IRR. Making the right choice. When push comes to shove, which one should we rely on?
Yes, this is important. You mentioned earlier they usually agree, but not always. So when do these two powerful tools tend to agree, and when might they give us conflicting signals, pointing in different directions?
That's a fundamental question. For a single standalone project, meaning a project that doesn't compete directly with any other specific project for funding, it's just a yes or no decision on its own merits, NPV and IRR will usually lead to the exact same investment decision.
Okay, so for independent projects, they generally align.
Yes. That means if the NPV is positive, the IRR will typically be greater than the required rate of return, leading to an accept decision from both rules. And if the NPV is negative, the IRR will typically be less than R, leading to a reject decision from both. They give consistent guidance in most simple cases.
But, yeah, there's a but, isn't there? When does the conflict arise?
Exactly. Here's where it gets really interesting, and where we need to be much more careful for mutually exclusive projects.
Mutually exclusive, meaning you can only choose one.
Precisely. Where you have two or more projects, but you can only pick one of them, perhaps due to budget constraints, or because they serve the same purpose. Like deciding between buying a new car or a new scooter with the same budget. You can't realistically have both serving the same need. In these situations where you have to rank projects and choose the best one, NPV and IRR might give conflicting signals.
How so? Conflicting rankings.
Yes. One project might have a higher IRR, suggesting it offers a better percentage rate of return, but another competing project might have a higher NPV, suggesting it adds more absolute wealth to the company, even if its percentage return IRR is slightly lower. They can rank the projects differently.
Ah, okay, so they might disagree on which project is best when you can only pick one. So if they sometimes give conflicting advice in these crucial ranking situations, which one should we use?
What's the theoretically correct choice for a finance manager aiming to maximize company value?
Theoretically, and this is widely accepted in finance, NPV is considered superior, especially when choosing between mutually exclusive projects.
Why NPV? What makes it better in theory?
Because NPV directly shows the expected increase in the firm's wealth in actual currency terms, rupees, dollars, euros, whatever the currency may be. It answers the question, how much richer in absolute terms will the company and thus its shareholders be today if we undertake this project? It measures the total value creation.
Okay, it gives a direct value impact. What's the issue with IRR in this context? IRR, on the other hand, only shows a rate of return, a percentage. It doesn't inherently consider the scale or size of the project, nor does it fully capture the impact of the timing or duration over which that return is earned, in the same way NPV does.
Can you give an example of the scale issue?
Sure, think about it. Yeah. Maybe you have a small project A with an investment of only 1 lakh, but it has a very high IRR of, say, 30%. The NPV might be 30,000. Now compare that to a much larger project B requiring an investment of 10 lakh, but with a slightly lower, yet still very good, IRR of, say, 15%. Project B's NPV would be 1.5 lakh for 15% of 10 lakh.
Ah, so Project A has the higher IRR, 30%, V is 15%, but Project B has the higher NPV, 1.5 lakh versus 30,000.
Exactly. If you can only choose one, which one actually adds more total value to the company? It's Project B, the one with the higher NPV, even though its percentage return is lower. NPV directly addresses the goal of maximizing the total wealth of the firm. This is what shareholders ultimately care about: the total value generated, not just the percentage rate on one small part of their investment.
That makes a lot of sense. It's not just about the percentage return you make, but how much actual wealth, how many rupees you create. A higher rate on a smaller base might be less impactful overall than a slightly lower rate on a much larger investment base. NPV captures that scale difference directly.
Precisely. You've hit upon the key insight there. However, despite this theoretical superiority of NPV, we should acknowledge that, in practice, many financial professionals and managers still find IRR easier to interpret and communicate.
Why is that?
Well, for instance, saying, "This project is expected to yield a 15% return," often sounds more intuitive and easily comparable to other market rates than saying this project had a $1.5 million NPV, especially if the listener doesn't know the overall size of the company or the scale of its total investments. A percentage feels more self-contained sometimes.
True. Percentages are often easier to grasp quickly.
They can be. But the good news is that if you have all the cash flow data needed to calculate the NPV, it's usually very simple to also calculate the IRR using modern spreadsheet software or financial calculators. You can easily look at both. But remember, the theoretically sound and more appropriate criterion for making the final decision, especially when choosing between mutually exclusive projects that differ significantly in their scale, size of investment, or timing of cash flows, is NPV.
Okay, prioritize NPV when rankings conflict, especially for mutually exclusive choices. Got it. So for your next check for understanding, if you, as a finance manager, had to choose between two mutually exclusive projects, and Project X had a higher IRR, but Project Y had a higher NPV, which project would you choose and why? Think about the fundamental goal of financial management.
Excellent. Thinking like a finance manager already. Now let's pivot to our third important analytical tool. This one is particularly useful for independent analysts like you, who often have to rely on publicly available information rather than internal project details. Return on invested capital, or ROIC.
Okay, ROIC. You mentioned this is a company-wide measure.
Yes, exactly. So what is ROIC? It's a powerful profitability measure that essentially tells us how much profit a company is making for the total capital that its management has invested across the entire company. It's a broader view. You might also hear it called return on capital employed, or ROCE. The terms are often used interchangeably.
Right, ROCE or ROIC. And how is it different from NPV and IRR again?
Unlike NPV and IRR, which are typically used to evaluate specific individual investment projects before they are undertaken, ROIC is a measure calculated after the fact, using a company's published financial statements. It looks at the overall performance of all the capital already invested in the business. It's an aggregate historical measure.
Okay, backward looking for the whole company using public data. Let's use an everyday Indian example again for ROIC. Imagine a very successful restaurant chain, maybe like Barbac Nation or a Paradise Biryani, that has dozens of outlets across the country. They've invested heavily over the years in their kitchens, the dining areas, their brand name, maybe a central food processing facility.
Okay, lots of capital invested.
Yes, ROIC helps the owners of that chain, and also external analysts like us see how much profit they are generating for every single rupee they have put into the business over time. That includes the money tied up in the buildings, whether owned or leased long-term, the expensive kitchen equipment, the furniture, the IT systems, everything required to run the business, except very short-term working capital.
So it's a holistic measure of efficiency. How well are they using all that invested money?
Exactly. It's a way to judge their overall efficiency in using all that cumulative capital. It tells you if they are truly getting a good bang for their buck from all their past and current investments combined. Are they generating good returns on the total money entrusted to them?
Okay, that's clear. So how exactly is it calculated from the numbers we find in the financial statements?
The formula for ROIC, as provided in our sources, is fairly straightforward. ROIC except after-tax operating profit, average invested capital.
Okay, let's break down those two components, the numerator and the denominator.
Right. The numerator is the after-tax operating profit. This is essentially the profit a company makes from its core day-to-day business operations after considering corporate income taxes. But importantly, it's calculated before accounting for interest expenses paid to debt holders. We often use EBIT, earnings before interest and taxes, multiplied by one tax rate as a proxy for this.
Okay, Profit from operations after tax, before interest. Why before interest?
Because the denominator, the invested capital, includes both debt and equity capital. So the numerator should represent the profit available to both types of capital providers before debt holders take their share interest.
That makes sense. Consistency between numerator and denominator. What about the denominator? Average invested capital.
Yes. The denominator is the average invested capital. This is a measure of the total long-term capital that has been permanently invested in the business by both debt holders and equity holders. Importantly, as I mentioned, it typically excludes short-term working capital items like accounts receivable, inventory, minus accounts payable, because those are seen as financing the very short-term operating cycle, not the long-term assets.
So how do we find this invested capital on the balance sheet?
From the balance sheet, we typically calculate invested capital as the sum of long-term liabilities, like long-term bank loans and bonds, plus total shareholders' equity, which includes the original share capital, plus all the accumulated retained earnings over the years. That sum represents the total pool of long-term funds supplied to the company.
Okay, long-term debt plus equity. And why do we use the average invested capital?
We usually use the average over the accounting period, like the average of the invested capital at the beginning of the year and the end of the year, to get a more representative picture. Capital levels can fluctuate during the year, so averaging smooths things out and better matches the profit generated during the year, the numerator, with the capital employed throughout that year, the denominator.
I got it. Average avoids distortions from end-of-period snapshots. Let's quickly walk through example 8, return on invested capital, from the source to put some numbers to this calculation. Assume a company reported $24,395 in year 2 after-tax operating profits. That's our numerator.
Okay. And we need balance sheet data for the invested capital. Let's say we have the following for the end of year 1 and year 2. End of year 1. Long-term debt, it are $112,257. Share capital, other $15,688. Retained earnings, over $148,442. End of year 2. Long-term debt equal $106,597. Share capital equals $15,688. Retained earnings, $159,995.
Okay, let's calculate this step by step then. First, we need the invested capital figure for the end of year 1.
Right. Invested capital year 1 equals long-term debt plus share capital plus retained earnings, $112,257 plus $15,688 plus $148,442. That sums up to $276,387.
Good. Next, invested capital for the end of year 2.
Invested capital year 2, it was $106,597 plus $15,688 plus $159,995. That totals $282,285.
Okay, now we need the average invested capital for year 2. We take the average of the beginning, end of year 1, and end of year 2 figures.
Average invested capital, $276,387 plus $282,282 divided by average invested capital, our denominator.
ROIC, €24,395, 279,333.5. That gives us approximately 8.73%.
Okay, 8.73%. Now, let's say an investor requires a rate of return of 10% on their investment in this company, given its risk profile. Is this company a promising investment candidate based solely on this ROIC figure for year 2?
Well, based only on this one number for this 1 year, probably not, right? While the company is profitable, its ROIC of 8.73% is below the investor's required rate of return of 10%. Exactly. This indicates that for the total capital invested in it, the company is not generating enough return in that year to fully satisfy investors who believe they could potentially earn 10% or more elsewhere on investments of similar risk. It suggests value might not be being created or possibly even being destroyed in that period.
But as our source rightly says, this is just one metric for one historical year. You wouldn't make a final decision based just on this, would you?
Absolutely not. Many other factors must be considered. You'd want to look at the trend of ROIC over several years. Is it improving or declining? How does it compare to the ROIC of its competitors in the same industry? What's the company's growth strategy? And are they investing in things that might depress ROIC now, but lead to much higher returns later? It's just one piece of the puzzle, but a very important one.
Right. So apart from just being calculable from public data, what are the key benefits of ROIC for us as analysts? What insights does it truly offer that maybe other metrics don't?
There are several key benefits, and this is where ROIC truly shines as an analytical tool. Firstly, as we've highlighted, it's a huge benefit that ROIC can be calculated by independent analysts. Unlike project-level NPV and IRR, which rely on internal proprietary forecasts and data that isn't usually public.
Right, we can't see inside the company's project files.
Exactly. But ROIC uses financial statement data that is publicly available for listed companies. This means you, as an external analyst or investor, can independently assess a company's overall capital efficiency and its track record of value creation, even without any insider information. This gives you a powerful diagnostic tool.
That's incredibly valuable. It's like being able to assess the overall performance of a cricket team by looking at their public match results and statistics without needing to know the secret details of every single practice session or team meeting. You get a good picture of the outcome.
That's a great analogy.
Right.
Exactly. Secondly, unlike simpler profitability measures like, say, net profit margin at income sales, ROIC accounts for the capital needed to generate those returns.
What do you mean by that?
Well, a company might report very high profit margins on its sales. But if it requires an enormous amount of capital, maybe huge, expensive factories, lots of complex machinery, massive R&D spending to generate those margins, its ROIC might still be quite low because the denominator, invested capital, is so large. ROIC forces you to consider the efficiency of capital deployment, not just profitability on sales.
Okay. High margin isn't enough if you need tons of capital to get it.
Precisely. And we can actually decompose ROIC into two key components, which is a particularly useful trick for analysts doing diagnosis. The formula is ROIC equals after-tax operating profit sales, X, sales average invested capital.
Okay, so ROIC equals profit margin times. So it's
Okay.
the second part, sales divided by invested capital.
Yes, the first part is the after-tax operating profit margin.
Right.
The second part, sales average invested capital, is called capital turnover, or sometimes asset turnover. It measures how efficiently the company is using its invested capital to generate sales revenue.
So ROIC depends on both margin and turnover.
Exactly. This decomposition is powerful because it shows us that a high ROIC can come from either having very high profit margins or from having very high capital turnover, meaning using capital very efficiently to generate lots of sales for every rupee invested, or, of course, a good combination of both.
So a company like maybe a high-end luxury goods retailer might have high margins but lower turnover, while a supermarket might have very thin margins but extremely high turnover. Both could potentially achieve a good ROIC.
Precisely. And this decomposition helps you diagnose why a company's ROIC might be low. Is the problem with their pricing power and margins, or are they simply inefficiently using their assets and capital to generate sales? Low turnover. It's a powerful diagnostic tool for any investor trying to understand the drivers of performance.
That's a key insight. It's not just about how much profit you make on each individual sale, but also how efficiently you use your overall asset base to generate those sales in the first place. Brilliant.
Exactly. Thirdly, while NPV and IRR focus on individual projects, ROIC is an aggregate measure. As we've said, it gauges the firm's ability to create value across all its investments, its entire portfolio of projects and assets accumulated over time. This is vitally important because investors typically buy shares in the whole company, not just in one specific project it undertook last year. So ROIC gives a more holistic, bird's-eye view of overall management effectiveness.
Okay, a view of the entire forest, not just individual trees.
Good analogy. Fourth, ROIC can be directly compared to the investor's overall required rate of return for the entire company, often called the weighted average cost of capital, or WACC, which you'll learn about later. If a company's ROIC consistently stays above its WACC, it indicates the company is actively creating value for its shareholders. If ROIC consistently falls below WACC, it's a clear warning sign that value is likely being destroyed, and management needs to take action, maybe improve efficiency, dispose of underperforming assets, or perhaps return capital to shareholders if they can't earn adequate returns.
So ROIC WACC is the goal for value creation.
That's the benchmark, yes. And finally, ROIC considers both debt and equity in its denominator, invested capital. This is important because companies typically use a mix of both types of capital to fund their operations. Therefore, ROIC, which measures the return generated by that total capital, should logically be compared to a blended required rate of return for both debt and equity investors, which is exactly what the WACC represents.
Okay, those are some significant benefits, but you mentioned earlier no financial measure is perfect. So what are the main limitations of ROIC that we as analysts should be careful about?
Right. It's crucial to be aware of the downsides, too. First, ROIC is an accounting-based, not purely cash-based measure. Its numerator, operating profit, is based on accrual accounting principles. This can differ significantly from actual cash flow generated by the business, largely due to things like depreciation, which is a non-cash expense deducted to get operating profit, and the timing differences between when capital expenditures are made, cash outflow, and when they're depreciated, expense over time. So ROIC doesn't give you a direct picture of the cash generated or the company's ability to pay its bills.
Okay, accounting numbers can differ from cash reality. What else?
Second, ROIC is inherently backward-looking and can be quite volatile from year to year. It's calculated using historical financial statement data. Therefore, it's absolutely essential to examine the trends in ROIC over several years rather than just relying heavily on a single year's number, which might be unusually high or low due to temporary factors. Also, remember that large, profitable investments can sometimes take several years to mature and start showing competitive returns. So a single low ROIC year during a heavy investment phase might be misleading about the long-term prospect.
Right, look for the trend, not just a snapshot. Makes sense.
Third, because it's a highly aggregated measure for the entire company, ROIC can sometimes mask significant differences in performance within the firm. The overall company ROIC might look acceptable, maybe just above the WACC, but hidden beneath that average, some specific business segments or recent large projects could be performing very poorly and dragging down the average, while others might be doing exceptionally well. ROIC doesn't give you that divisional breakdown.
Okay, the average can hide winners and losers inside the company.
Exactly. And finally, there's often less universal consensus on how to precisely measure ROIC, particularly the denominator, invested capital. Different analysts or data providers might make slightly different adjustments. For example, how should intangible assets, like goodwill from acquisitions, be treated? Should excess cash held by the company be included or excluded from invested capital? How should certain liabilities, like operating leases, be handled? These subtle differences in calculation methodology can lead to variations in the reported ROIC number for the same company, so it's important to understand how it's being calculated if you're comparing ROIC figures from different sources.
Good point. Always check the definition being used. Okay, that's very helpful for your next check for understanding. If a company reports a very high profit margin, does that automatically mean it has a good ROIC? Why or why not? Think back to that decomposition formula we discussed.
All right, fantastic progress, everyone. With our core analytical tools, NPV, IRR, and ROIC now understood, let's move into Part 7, Capital Allocation Principles and Pitfalls. Because even with the best tools in your toolkit, it's still quite easy to make mistakes if you don't follow sound fundamental principles, or if, well, human biases creep into the decision-making process.
Indeed. Tools are only as good as the person using them, right? So what are some of these key principles we should always keep in mind? The first one you mentioned is to always use after-tax cash flows for evaluation.
Yes, this is absolutely fundamental. It's not enough to look at pre-tax profits or even just operating profit before taxes when evaluating a project using NPV or IRR.
Yeah.
You absolutely must consider the impact of corporate income taxation on a project's expected cash flows.
Why is tax so critical here?
Because taxes represent a real cash outflow for the company, reducing the amount of cash actually available from the project. So you need to estimate the taxes the project will likely incur and subtract them to get the after-tax cash flow for each period. And specifically, remember the tax benefits, the tax savings that could arise from non-cash deductions like depreciation and amortization.
Ah, the depreciation tax shield.
Exactly. Depreciation itself isn't a cash flow, but because it's a deductible expense for tax purposes, it reduces the company's taxable income, which in turn reduces the actual cash taxes paid. These tax savings are real cash flow benefits generated because of the investment and must be carefully included in your cash flow analysis. Ignoring taxes or the tax shield from depreciation will give you a wrong estimate of the project's value.
Okay, always use after-tax cash flows and include the depreciation tax shield.
Got it.
What's the second principle?
The second principle is to include incremental cash flows only, but always examine broadly. Let's break that down. First part, incremental cash flows only. This means you should only include those cash flows in your analysis that will occur if and only if the project is undertaken. They are the additional or marginal cash flows generated because of the project.
So if a cash flow would happen anyway, whether we do the project or not, we ignore it.
Precisely. And a very important part of this is that you must always ignore sunk costs.
Sunk costs. We mentioned these briefly. What are they again?
Sunk costs are expenses that have already been incurred in the past or commitments that have already been made. And crucially, They cannot be recovered or changed, regardless of whether you decide to go ahead with a new project now or not. That money is already gone. It's sunk.
Let me try that Indian movie ticket example again to make sure we get it.
Yeah.
I bought a ticket for €200 for a movie. I go in, watch the first 5 minutes, and realize it's absolutely terrible. I'm not enjoying it at all.
Okay, a bad movie. Happens often.
Yes. Now, the $200 I already spent on the ticket is a sunk cost. It's gone. Should I stay and suffer through a bad movie for the next 2 hours just because I already paid for the ticket?
Logically, no. Your decision now should be based on whether you'll get more value or enjoyment from leaving and doing something else for the next 2 hours compared to staying. The 200 is irrelevant to that future decision.
Exactly. Staying won't bring the 200 back. Similarly, companies should ignore past expenses, maybe money spent on market research for a project last year, or the cost of land bought 5 years ago when deciding whether to proceed with a new investment decision today. That past spending is sunk, and it shouldn't influence today's decision about future cash flows, nor should it become a psychological reason to throw good money after bad just to try and justify the past expense.
That's a perfect illustration of ignoring sunk costs. So only include incremental cash flows. But the second part of the principle was examine broadly. What does that mean?
It means you need to think beyond just the direct revenues and costs of the project itself. Capital investments often have broader impacts or side effects on the rest of the firm's operations. These can be positive or negative, and they are also incremental, so they should be included.
Okay, like what kind of side effects?
A positive effect could be significant cost savings in other parts of the business that directly result from the new investment. For example, investing in automation in one department might reduce labor costs elsewhere. That saving is an incremental inflow for the project. A negative effect could be the loss of sales from the company's existing products, because the new product you're launching is taking away sales from an old one. We call this cannibalization.
The new product eats the sales of the old one.
Exactly. That loss of profit from the old product is a real cost caused by the new project, so it's an incremental outflow that needs to be factored into the new project's analysis. You need to look at the net impact on the entire company's cash flows.
Okay, so think about all the knock-on effects, positive and negative. Got it.
Yeah.
And the third key principle.
The third principle is recognizing the absolute importance of the timing of cash flows. This is incredibly crucial. When you forecast cash flows for NPV or IRR, it's not just the total amount that matters, but when those cash flows are expected to occur. The forecasted timing, the duration over which cash flows are received, and even the potential volatility or uncertainty of those expected cash flows must be meticulously considered.
Why is timing so critical again?
Because of the time value of money. NPV and IRR calculations change significantly if the same total amount of cash flow is received earlier versus later. Generally, earlier cash flows are strongly preferred because their present value is higher. Remember our time value of money concept? A rupee received today is worth much more than the same rupee received 10 years from now, because you lose the opportunity to invest it for those 10 years. So timing is everything in discounting.
Makes perfect sense. Okay, for your next check for understanding, why should a company only focus on incremental cash flows when evaluating a new project, and specifically, why should they completely ignore sunk costs in their decision-making process?
Now, even if managers understand these sound principles use after-tax incremental cash flows, consider timing capital allocation remains an incredibly challenging process in practice. And firms, unfortunately, often fall into what our sources call common capital allocation pitfalls or mistakes.
Yes, it's easy to slip up. We can generally divide these pitfalls into two broad categories. First, there are cognitive errors. These are essentially mistakes that arise from flawed analysis, faulty calculations, or incomplete information gathering. Errors in thinking, basically.
Okay, analytical mistakes. And the second category?
The second category is behavioral biases. These are more subtle errors in judgment or blind spots that stem from human psychology, emotions, or organizational dynamics. They can unconsciously influence decisions even when the analysis seems okay on the surface.
Right, biases affecting judgment. Let's start with the cognitive errors. What are some common ones?
The first common error mentioned is internal forecasting errors. Management teams, even with the best intentions, might make significant mistakes in their cash flow forecasts. And these can be very difficult for external analysts like us to spot, because we usually don't have access to all their detailed internal assumptions and data.
What kind of forecasting errors are typical?
Well, they could include incorrect cost estimates, for example, significantly underestimating the overhead costs that a new project might impose on the rest of the organization. Things like the extra management time required, IT support, legal fees, or the burden on financial systems often get overlooked or lowballed. Another common one is failing to adequately incorporate how competitors might react to the new investment.
Ah, forgetting about the competition.
Yes, management might optimistically assume their market share will increase as planned, but they might fail to factor in that a major competitor could launch a similar product, cut prices aggressively, or increase their own marketing spend in response. These competitive reactions can significantly impact a project's eventual success and profitability.
That's a big oversight. What's the second cognitive error?
The second cognitive error, which is surprisingly common according to research, is ignoring the true costs of internal financing. Many managers seem to behave as if cash generated directly from the company's own operations, that is, retained earnings or profits from normal business activities, is somehow free money to invest.
But we already established that's not true, right? It has an opportunity cost.
Exactly. But many managers don't seem to fully internalize this. Internally generated capital, like cash flow from operations, is actually a very important form of equity financing. It belongs to the shareholders. If management decides not to pay it out as a dividend or use it for share buybacks, but instead chooses to reinvest it in the business, they are implicitly making an investment decision on behalf of the shareholders. And that decision must earn a return sufficient to compensate shareholders for the opportunity cost they incurred, the return they could have earned by investing that capital themselves elsewhere.
Let's use that Indian small business owner example again. The owner has 5 lakh sitting in the business bank account from past profits. They might think, great, I have cash. I can buy that new machine without borrowing.
Yes, it feels free because they don't write a check to a bank for interest.
But they could have earned interest on that euro lakh if they'd put it in a fixed deposit. Or they could have paid it out to themselves or the family members who own the business as a distribution, like a dividend. That potential interest or the value of that distribution is the opportunity cost of using those internal funds for the new machine. The funds are definitely not free.
A very clear illustration. Therefore, the principle is, regardless of whether the money for a project comes from internal operations, retained earnings, or from issuing new debt, or from issuing new equity shares, management should always use the appropriate risk-adjusted required rate of return, like the WACC, to evaluate that capital investment. The source of funds does not change the required return hurdle. Internally generated funds do not get a lower R or come for free.
That's a crucial point for managers to remember. Don't treat internal cash differently. Okay, and the third cognitive error mentioned.
The third one is the inconsistent treatment of, or sometimes completely ignoring, the effects of inflation in the analysis. Inflation can affect capital allocation decisions in several important ways, and mishandling it leads to errors.
How should inflation be handled consistently?
Your analysis must be internally consistent. There are 2 valid ways. Either you forecast cash flows that include the effects of expected future inflation, these are called nominal cash flows, and then you discount them using a nominal discount rate, which also includes an allowance for expected inflation. Or you forecast cash flows after removing the effects of expected inflation. These are called real cash flows, representing constant purchasing power. And then you discount them using a real discount rate, which has the inflation component removed. You must use nominal with nominal or real with real. Mixing them up, like using nominal cash flows with a real discount rate, will lead to incorrect NPVs and potentially wrong decisions.
Okay, consistency is key. Nominal, nominal, or real, real.
Yes. But it's not just about consistency in the calculation. You also need to think about how inflation impacts the business itself. Inflation generally doesn't affect all selling prices and all input costs uniformly across the economy or even within a company.
What do you mean?
For instance, let's go back to that company manufacturing biscuits in India. Maybe the price of flour and sugar key ingredients increases very sharply due to specific market factors or unexpected inflation, maybe by 15%. But perhaps competitive pressures mean the company can only increase the selling price of its biscuits by, say, 5%.
Ah, so costs go up much more than prices. Their profit margin gets squeezed.
Exactly. Their profits will be hit significantly, even if they'd initially adjusted their plans for some general level of inflation, maybe 6%. If actual inflation, or the relative inflation of costs versus prices, differs significantly from what was expected over a project's long life, the project's actual profitability can be materially altered. A project that looked good based on expected inflation might turn out bad if actual inflation is higher or affects costs more than prices or vice versa. So sensitivity analysis around inflation assumptions is often very important.
Right. Unexpected inflation changes can really hurt. Okay, so for your next check for understanding, Why is it a cognitive mistake for a company to think that money generated internally from its own operations is free money to invest rather than recognizing it has a real economic cost?
Now let's move on to the second category of pitfalls, behavioral biases. These are often more subtle, psychologically driven judgment errors that can unconsciously influence decision-making, even by smart, experienced managers.
Okay, biases from human nature. What's the first one?
The first one discussed is inertia. This is the tendency for management to anchor their capital investment budgets and allocations heavily to prior year amounts almost automatically, without necessarily reevaluating the changing merits of different business segments or opportunities each year.
So just doing pretty much the same thing as last year, maybe with a small increase without deep questioning.
Exactly. Our sources cite research that found a very high correlation, a statistical measure of 0.92, which is extremely high between the levels of capital investment allocated to a specific business segment in one year and the allocation to that same segment in the next year for many large U.S. companies. This high correlation strongly suggests inertia is at play. Management seems reluctant to make significant shifts in capital allocation, even if the underlying performance or prospects of different segments are changing.
So how would we spot this as analysts? If we see a company like, say, the hypothetical XYZ company mentioned in our sources, where maybe segment A and segment B consistently received increasing capital allocation year after year, maybe from 20x through 20x2.
Okay, getting more money each year.
Yes, but during that exact same period, their return on invested capital, ROIC, actually decreased year after year. More investment, but lower returns.
That's a classic potential red flag for inertia. As analysts, if we observe that pattern investment that is static or even rising despite clearly falling returns in that segment, we should seriously question management's justification. Why are they continuing to pour money into an area that's becoming less profitable? It's like continuing to water a plant that clearly isn't growing or is even wilting. Is it just inertia, or is there a strategic reason they haven't explained well?
Right, challenge the status quo if the numbers don't support it. What's the second behavioral bias?
The second one is basing investment decisions primarily on short-term accounting measures, like the reported earnings per share EPS number that gets a lot of attention each quarter.
Why is focusing on EPS a bias? Isn't higher EPS good?
Higher EPS is generally preferred, yes. But the bias comes when managers prioritize boosting short-term EPS over making investments that maximize long-term value, especially if those two goals conflict. And they often do. Managers frequently have strong incentives. Maybe their annual bonuses or stock options are directly tied to hitting specific quarterly or annual EPS targets.
Okay, their compensation drives their focus. How does this conflict with good investment decisions?
Well, many truly excellent high NPV projects, which are clearly value-creating in the long run, can actually reduce reported accounting measures like EPS or net income in the near term, maybe for the first year or two.
Why would a good project lower EPS initially?
It could be because they require significant upfront investment costs that get partially expensed immediately. Or maybe the assets involved have high depreciation charges in the early years, which lowers reported profit even though cash flow might be strong. Conversely, actions like aggressive cost-cutting, which might harm long-term capabilities, or using cash to buy back shares, can often provide an immediate boost to EPS, making management look good in the short term, even if these actions don't necessarily create sustainable long-term value for the company.
So the pressure for short-term EPS can lead managers to avoid great long-term projects that have initial profit dips and maybe favor share buybacks or cost cuts that look good now but might not be the best use of capital for the future.
Precisely. This bias can lead companies to choose investments or not choose investments in a way that is not in the long-run best interest of their shareholders, simply because management is chasing short-term accounting targets linked to their own pay. It's a classic agency problem.
It really highlights the importance of designing management compensation carefully. Okay, time for your next check-in. Why might a project with a very high NPV, which is great for long-term value, actually make a company's earnings per share, EPS, look worse in the short term?
The third behavioral bias is what the literature often calls the pet project bias. This is, well, exactly what it sounds like. Certain projects sometimes receive preferential treatment and funding, perhaps without undergoing the same rigorous objective analysis as other proposals, or maybe their projections are allowed to be overly optimistic, simply because they are strongly championed by a powerful executive, maybe the CEO, or a senior manager whose opinion carries a lot of weight. It's their project.
So projects getting approved based on who supports them rather than just their financial merits.
It can happen, yes. It's often difficult for external analysts like us to definitively identify these pet projects just by looking at the aggregated financial statements, because specific project details are usually not disclosed individually unless they're extremely large. But there are sometimes warning signs or contextual factors that might make us more alert to this possibility.
Like what? What are the red flags?
Things like companies where ownership is very concentrated in the hands of a single individual or family. They might have more leeway to push through their preferred projects. Or companies with historically weak oversight from the board of directors. Or situations where executive compensation structures don't seem well aligned with creating long-term value for all shareholders. These governance factors can sometimes create an environment where pet projects are more likely to thrive.
It's very much like that example we used earlier. A family business in India, where maybe the founder or the current head insists on investing a large sum in a particular new venture, even if the financial analysis looks shaky or market research advises against it, simply because it's their personal idea or their passion project. It might be driven more by emotion, ego, or a gut feeling, rather than purely objective, sound financial analysis.
A very relatable example indeed. Pet projects can definitely destroy value if they aren't properly vetted. And the fourth behavioral bias listed is the failure to consider investment alternatives or alternative scenarios.
What does this involve?
It means, firstly, that many potentially viable alternative projects or different ways of achieving a goal might never even be seriously considered by some companies. Management might latch onto one particular idea early on and then suffer from confirmation bias, only looking for information that supports that first idea rather than actively exploring other possibilities. They get tunnel vision.
Okay, not exploring the full range of options. What about alternative scenarios?
This means that firms often fail to adequately incorporate and analyze different possible outcomes for a project they are considering. What happens if sales are much lower than we expect? What if our key input costs are much higher? What's the worst-case scenario? What's the break-even point? This could be done through robust techniques like break-even analysis, sensitivity analysis, or scenario planning, looking at specific combinations of bad outcomes, or even more advanced simulation analysis. But often, companies just rely on a single base case forecast.
So not stress testing the plan enough.
Exactly. Not being prepared for things potentially going wrong. This pitfall can sometimes stem from management having limited investment experience. Perhaps the company hasn't made many divestitures, selling off parts of the business, or acquisitions. Or maybe they've been lucky and never really experienced a truly significant failed investment in the past. While failure itself is obviously undesirable, a complete lack of any failed projects over a long period might paradoxically suggest that management is perhaps not taking enough appropriate risks necessary for healthy long-term growth and innovation. They might be too cautious, only backing sure things, which might not lead to maximizing value either. It's about taking calculated risks and being prepared for different outcomes.
That's an interesting perspective. Never failing might mean you're not trying hard enough or being innovative enough. Okay, so for your final check for understanding in this section, if a company keeps investing heavily in the same business segments year after year, perhaps even increasing the investment amounts, but the returns on capital in those segments are steadily falling, what behavioral bias might they be exhibiting?
All right, excellent. We've covered the process, the tools, and the pitfalls. That brings us now to a very interesting and strategically important concept that adds a vital layer of flexibility and sophistication to capital investment decisions. Real options. Thinking about these can truly change the game for how we evaluate certain projects.
Real options. Okay, this sounds intriguing. It's not just about the initial plan.
Exactly. What are real options? Think of them as built-in plan Bs or plan Cs or maybe escape hatches for a project. They represent alternative or choices that management has the ability to make after an investment has already been initiated, which can alter the course and ultimately the value of that investment. They provide the company with a right, but crucially not an obligation, to take some specific future action.
Oh, right, but not an obligation. That sounds like financial options, like stock options.
It's a very similar concept. You've hit the nail on the head. They're analogous to financial options, like those derivatives you might hear about traded in the stock market. But instead of dealing with financial assets like stocks or bonds, real options deal with decisions about real assets, tangible things like a factory, a piece of land, a product line, or even intangible things like an R&D project or a patent.
Okay, options related to real business decisions. And because it's an option, you only exercise it if it helps.
Precisely. A company will only pursue or exercise a real option, like the option to expand or the option to delay, or the option to abandon if doing so is expected to be value-enhancing at that future point in time when the decision needs to be made. This embedded flexibility, the ability to adapt the project based on how things unfold, can greatly enhance a project's overall expected net present value, NPV, sometimes even turning a project that looks like a no based on its initial plan into a yes once you factor in the value of this future flexibility.
That's a fascinating concept. It makes investment less rigid, more adaptive. So, what are the different types of real options that companies often encounter or can build into their projects?
Our sources typically highlight four main categories, each offering a distinct kind of strategic flexibility. The first type is a timing option.
Timing option, like deciding when to invest.
Exactly. This is the choice to delay starting an investment decision, perhaps for a year or two, specifically to gain more information about uncertain factors like future market conditions, the direction of new technology developments, or potential changes in government regulations or competitor actions. Waiting can have value if uncertainty is high.
Okay. Can you give an example, maybe an Indian context?
Sure. Imagine an Indian real estate developer who owns a prime piece of land in a rapidly growing city. They could start building a large residential apartment complex right now. Or they could exercise a timing option and wait a year or two. Why? Maybe they hope that clearer government policies on infrastructure development in that area will emerge, or perhaps more solid market demand data for apartments will become available, or maybe construction costs will stabilize. That delay allows them to make a more informed decision later and potentially avoid costly mistakes if the market turns down or regulations change unfavorably. This kind of option is very common in real estate, mining, or large infrastructure projects, where uncertainty is high and investments are largely irreversible.
Makes sense. Waiting for the fog to clear a bit. What's the second type?
The second major type is a sizing option. This relates to the ability to adjust the scale or size of the project after it has begun, based on how things are going. This has two very important and opposite sides to it.
Okay, sizing up or sizing down?
Exactly. First, there's the abandonment option. This gives a company the explicit right, or at least the practical ability, to abandon or shut down an investment project partway through, if the financial results turn out to be very disappointing, or if market conditions deteriorate significantly and unexpectedly.
The escape hatch.
Precisely. If the estimated cash flow the company can get from abandoning the project right now, maybe by selling off the remaining assets or equipment, exceeds the estimated present value of all the future cash flows expected from continuing the struggling project, then the company should exercise this abandonment option. It helps to cap potential losses and cut bait on failing ventures.
Okay, that's downside protection. What's the other side of the sizing option?
The other side is the growth option or expansion option. This is the right, but again, not the obligation, to make additional investments in the future if the initial project turns out to be very successful. Maybe if financial results are strong, demand is much higher than originally expected, or new related opportunities arise directly as a result of the initial investment.
So, the option to double down if things go well.
Exactly. Let's imagine that new software startup in Bengaluru again. They might launch a small initial version of their product, maybe a minimum viable product. That's their initial, relatively low-cost investment. Now, if that initial product becomes hugely popular, gets great reviews, and shows strong early financial results like rapid user growth or revenue.
Okay, a hit.
Yes. Then they have the growth option to expand significantly. They can decide to exercise this option by hiring many more software engineers, investing heavily in more powerful servers, ramping up marketing spending, maybe developing additional premium features, all to capitalize on that early success and capture a large market share. But on the flip side, if that initial product fails to gain traction, gets bad reviews, and looks unprofitable.
The flop scenario.
Right. Then they have the abandonment option we just talked about.
Yeah.
They can choose to shut it down quickly, maybe sell any useful code or assets, cut their losses, and crucially, avoid sinking more good money into a clearly failing venture. This combination of being able to abandon failure and expand success is incredibly valuable. It manages risk beautifully by allowing them to limit the downside while retaining the potential for significant upside.
It really does. It makes taking the initial risk much more palatable. Okay, what's the third type of real option?
The third type is a flexibility option. This refers to various kinds of operational flexibility that a company might have once an investment is already up and running, allowing them to adapt their operations to changing market conditions or demand fluctuations in real time.
Okay, flexibility in how you operate the asset. Like what?
One example given is a price-setting option. If a firm finds that demand for its product or service suddenly far exceeds its current production capacity, It might have the flexibility, at least in the short term, to increase prices and capture more value from that excess demand, rather than immediately having to undertake a costly and time-consuming expansion of production capacity.
Ah, use price to manage short-term demand spikes.
Yes, if the market allows. Another common type is production flexibility options. This gives a firm the ability to alter its production levels or methods when actual demand turns out to be different from what was originally forecasted. For example, let's think about a popular bakery, maybe in Mumbai, known for its fresh bread. Suppose demand for their bread suddenly doubles overnight because a competitor shut down.
Okay, a sudden surge in customers.
Yes, they might have a production flexibility option. Instead of immediately deciding to build a whole new, expensive second bakery, a huge expansion project, they might have the flexibility to run extra shifts with their existing staff and ovens, or maybe buy a small, relatively inexpensive portable oven to add some capacity quickly, or perhaps even temporarily outsource some bread production to another bakery. These options allow them to meet the immediate surge in demand without making a massive, irreversible commitment right away.
Got it. Adapting operations on the fly. And the fourth type?
And finally, the fourth type is sometimes called a fundamental option. In these cases, the entire value or viability of an investment fundamentally depends, almost like a pure bet, on external factors that are largely outside the firm's direct control, such as the future price of a globally traded commodity.
Okay, where the project value swings wildly based on external prices.
Exactly. The classic example is the value of developing an oil well or opening a copper mine. The decision to invest heavily in extracting the resource is highly contingent on the prevailing and expected future price of oil or copper. If prices are very low, the company might choose not to drill or mine right now, even if they've already spent money exploring and finding the resource. They essentially hold the option to develop it later if and when prices recover sufficiently to make it profitable. If prices are high, they exercise the option and go ahead with development.
So the investment itself is like holding an option on the commodity price.
In many ways, yes. Many large early-stage research and development R&D projects, especially in pharmaceuticals or biotech, also behave like fundamental options. Their ultimate success and commercial value often depend heavily on external factors like achieving scientific breakthroughs, getting regulatory approvals, or broad market acceptance by doctors and patients, all of which are highly uncertain at the outset when the initial R&D investment is made.
That makes sense. R&D is inherently optionality. Okay, so for your check for understanding on this fascinating concept, how does an abandonment option specifically help a company manage the risk associated with its capital investments?
Excellent. Now, if these real options can materially change a project's perceived value and risk profile, how do we actually approach evaluating projects that contain real options in our financial analysis? Do we just ignore them, or is there a way to incorporate their value? Our sources typically describe three main approaches, generally moving from the simplest to the most complex.
Okay, 3 ways to handle them. What's the simplest approach?
The first approach is quite straightforward, maybe even a bit conservative. You perform the standard investment analysis, like calculating NPV, without explicitly considering the value of any embedded real options.
So just calculate the base NPV as if the options didn't exist.
Yes. Now, if the NPV of the project turns out to be positive, even without factoring in the value of those potential real options, and the project does actually involve valuable options, like the option to expand or abandon later, that could only increase its NPV further.
Then it must be a good project, right? The positive NPV is like a minimum value.
Exactly. In this scenario, that initial positive NPV represents a minimum expected return or value creation. Since the options can only add more potential value on top of that, the firm should definitely make the investment. It's a clear yes decision, and you didn't even need to go through the complexity of valuing the options themselves.
Okay, that's a simple screen. If it passes without options, it's definitely a go if options exist. What's the second approach?
The second approach tries to be a bit more precise by incorporating an estimate of the option's value. It involves a more refined calculation of the project's total NPV, including the value of the real options, using a formula like the one shown as equation 4 in our sources. It looks something like this. Project NPV with options, NPV base case without options, option cost plus option value.
Okay, let's break that down. Start with the base NPV.
Yes, you first calculate the base NPV of the project just based on the initial expected cash flows, as if there were no future flexibility or options.
Then you subtract option cost. What's that?
Sometimes, obtaining the flexibility represented by a real option might require an explicit upfront cost. For example, maybe you have to pay a bit extra now to engineer the factory in a way that allows for easy expansion later, or pay for a legal right to abandon a lease early. If there's a direct cost to acquire the option, you subtract that. Often, this cost is zero, but not always.
Okay, and then you add option value. How do you estimate that?
Ah, that's the tricky part. You then need to estimate the value of that flexibility, the value of having that choice in the future, the option value itself. This value arises because the option allows you to capitalize on upside potential, like the expansion option, or limit downside risk, like the abandonment option. Estimating this value accurately can be complex, sometimes requiring sophisticated option pricing models similar to those used for financial auctions. But the formula provides the conceptual framework. Adjust the base NPV by the cost and value of the embedded options.
So this gives a more comprehensive total NPV, including the flexibility value?
Ideally, yes. And the third approach involves using these more advanced methods directly, like decision trees and option pricing models.
Decision trees, like flowcharts with probabilities.
Exactly. These are particularly useful when a project involves complex future sequential decisions, where a decision made at one point opens up different paths and further decisions later, and multiple alternative outcomes are possible at each stage, each with different probabilities assigned to them. Decision trees help map out these branching possibilities and calculate the expected NPV of the project by working backwards through the tree, considering the optimal choices at each decision point. Option pricing models, like the Black-Scholes model adapted for real assets, can also be used, especially for valuing timing options or expansion options where the underlying uncertainty relates to market prices or project values. These are more advanced techniques usually covered later in finance studies.
Okay, decision trees for mapping out choices and probabilities. Let's try to make this more concrete by walking through example 9, Gerhardt Corporation capital allocation, using a decision tree from the source. This seems like a great way to see how real options can really change the decision. Gerhardt Corporation is considering building a new production facility.
Right. The initial outlay, CF0, is quite large, $500 million. Their required rate of return is 10%.
Okay, now let's first analyze this project the simple way. Part 1. Calculate NPV without considering any real options, just the immediate success or failure.
Okay. In this simple scenario, the analysis assumes only two outcomes in year one. Either the product launch is successful or it fails. There's a 60% probability of a successful product launch, which, if it happens, would bring in a large cash flow of $750 million in year one.
Okay, 60% chance of $750 million. What's the alternative?
But there's a 40% probability that the product launch fails completely, yielding zero cash flow in year one in this simple model.
Right. So first we need to calculate the expected cash flow for year one, right?
Yeah.
Averaging the outcomes by their probabilities.
Exactly. The expected cash flow for year one, ECF1, is calculated as probability of success, cash flow success, plus probability of failure, cash flow failure. So ECF1 equals 0.60, 750 million, plus 40 more over euro.
Okay, 0.6750 is 450,
Yeah.
and 0.40 is 0. So the expected cash flow in year one is 450 million.
Correct. Now let's calculate the NPV for this basic scenario, without considering any future options. NPV initial outlay, CS0, plus expected cash flow year one, 1 plus R1.
So NPV equals 500 million plus 450 million, 1 plus 0.01. We need to discount that 450 million back 1 year at 10%.
Right. 450 million divided by 1.10 is approximately 409.09 million. So the NPV calculation gives us negative €10 plus 409.09 million. The result is a negative NPV of approximately negative 90.91 million.
Negative 90.91 million. Based on this initial simple NPV analysis, which ignores any future flexibility, Gerhardt Corporation should clearly not pursue this project. It looks like a losing proposition expected to destroy nearly 91 million in value.
Correct. If this was the end of the analysis, the decision would be reject. But now let's bring in the real options. Let's consider part 2. Calculate NPV with the real options using the decision tree logic. This is where we factor in the future alternatives, the plan Bs, specifically in the scenario where the product initially fails.
Okay, so we focus on that 40% probability branch where the product launch fails in year 1. What happens then in year 2 according to the decision tree?
If the initial product fails, the 40% path, Gerhardt doesn't just give up. They have some important strategic choices they can make at the beginning of year 2. 1. They could try to launch an alternative product using the same facility. The tree says there's a 30% chance of this happening within the failure scenario. If they do this and it works, it generates $600 million in cash flow. Let's assume this also occurs effectively at the start of year 2 for simplicity, or discounted back to start of year 2. Or they could decide to sell the facility to another company. The tree assigns another 30% chance within the failure scenario to this outcome, generating $400 million from the sale of year 2.3. Or, the worst case, they might find neither of those is viable, and they have to simply abandon the facility entirely. The tree gives us a 40% chance within the failure scenario, generating 0 over euro at year 2.
Okay, so if the initial product fails, 40% chance, then there are 3 possible outcomes in year 2 with probabilities 30%, 30%, and 40%, which add up to 100% within that failure branch. We need to calculate the expected cash flow at year 2, conditional on failure having occurred in year 1.
Exactly. But let's think about the overall probabilities first. The probability of fail then launch alternative is 40% fail, 30% launch alt, 12% overall probability. The probability of fail then sell facility is 40%, 30% equals 12% overall probability. And the probability of fail then abandon is 40%, 40% overall probability. Notice 12% plus 12% plus 16%, but 40%, the original failure probability.
Okay, those are the probabilities of reaching those year 2 outcomes from the very start, time 0. Now, let's calculate the expected cash flow at year 2, considering these possibilities.
Right. The expected cash flow at year 2, ECF2, would be overall probability of alt product cash flow if alt product, plus overall probability of sale cash flow if sale, plus overall probability of abandoning cash flow if abandoned. So ECF2 equals 0.12 euro bleed plus 0.12 euro of euro 400 million plus 0.16 euro.
Okay, 0.12 600 is 72 million, and 0.12 400 is 48 million, and 0.1600 euro. So the total expected cash flow at year 2, driven by the options available after failure, is 72 euro plus 48 euro plus 0 euro 120 million.
Perfect. Now we can calculate the total MPV of the project with these real options included. We still have the initial outlay at time 0 and the expected cash flow at time 1 from the 60% success chance, but now we also have this expected cash flow at time 2 coming from the options exercised in the failure scenario.
Okay, so the new NPV calculation is NPV with options ECF1 1 plus R1 plus ECF2 1 plus R2.
Exactly. Plugging in the numbers, MPV with Oxyura 1.50 million, 1.01 plus 120 million, 1.02.
We already know the first discounted value is about 409.09 million. Now we need the present value of the year 2 expected cash flow, 120 million, 1.72. 1.20 squared is 1.21. So 121 is approximately 99.17 million.
Good calculation. So the total MPV with options is 90 euro million plus 409.09 million plus 99.17 million. What does that sum up to?
Let's see. Negative 500 plus 409.09 plus 99.17. That comes out to approximately plus 8.26 million.
Look at that. The NPV, when we properly account for the real options, the flexibility Gerhardt has if things go wrong initially, is now positive.
Wow. It went from being definitely negative 901M to being positive plus 8M. That completely changes the decision, doesn't it?
It absolutely does. Based on this more complete analysis that incorporates the value of future flexibility, Gerhardt Corporation should invest in the new production facility. This example clearly highlights how including real options in the evaluation can materially change the investment decision from a definite no, based on a static plan, to a clear yes once strategic adaptability is considered. It's a powerful illustration of the value of managerial flexibility in a dynamic and uncertain business environment.
It truly is a remarkable demonstration of how strategy and finance intertwine. Okay, for your final check for understanding on this topic, why is it so important for a company to consider real options when evaluating a project, especially if the initial NTV calculated without those options looks negative?
Well, everyone, we've certainly covered a tremendous amount of ground today in our deep dives on capital investments and allocation. We started by understanding the different types of capital investments, remember, from just maintaining existing operations, maintenance CapEx, all the way to venturing into completely new lines of business. Understanding these types gives crucial insights into a company's strategy and risk profile.
Right. And then we explored the disciplined 4-step process of capital allocation that well-managed companies should ideally follow, from generating good ideas in the first place to rigorously analyzing them, then prioritizing them based on value creation, and finally, the critical step of monitoring and post-investment review to learn and adapt. It's about ensuring every rupee invested is carefully considered and tracked.
And we really dug deep into the critical analytical tools that help companies make these crucial investment decisions. Net present value, or NPV, which measures the absolute value added today, and internal rate of return, or IRR, which gives the project's expected percentage return. We saw how they're calculated, how to apply their decision rules, and importantly, we also understood their respective strengths, weaknesses, and underlying assumptions, especially regarding reinvestment rates.
Yes, and the potential pitfalls like multiple IRRs. Then we explored return on invested capital, or ROIC, that powerful aggregate measure calculated from financial statements. It lets you, as an analyst looking from the outside, truly diagnose a company's overall capital efficiency and see if it's earning returns above its cost of capital using that useful margin times turnover decomposition.
We also spent some important time looking at the common pitfalls, both the cognitive errors in analysis, like forecasting mistakes or ignoring the cost of internal funds, and the more subtle human behavioral biases, like inertia, focusing too much on short-term EPS, pet projects, or failing to consider alternatives that can unfortunately derail even the best-intentioned capital allocation decisions and lead to value destruction. Being aware of these is half the battle.
Absolutely. And finally, we introduced the fascinating and strategically powerful concept of real options, that often hidden value of managerial flexibility that can truly enhance a project's worth. We saw how options to time, size, expand or abandon, or change operations can fundamentally alter the attractiveness of an investment, sometimes turning a seemingly unprofitable venture into a value-creating one just by building in those strategic choices for the future.
These concepts we've discussed today, the types of investment, the allocation process, the tools like NPV, IRR, ROIC, the pitfalls, and real options. They are absolutely fundamental for anyone working in or studying finance. And they're certainly cornerstones of your CFA journey ahead. Understanding them helps you grasp how companies truly grow their businesses, create lasting shareholder value, and wisely adapt to changing economic and competitive environments in the long run.
It's certainly a lot to absorb in one session, we know that. But remember, like anything complex, practice makes perfect. Keep revisiting these concepts, maybe work through the examples in your study materials again, and try to think about how they apply to the real companies and businesses you see around you every day in the news or in your own experience. The more you apply them, the clearer and more intuitive they will become over time.
And as a final thought for you to perhaps mull over after today's deep dive, something to think about on your own. Given all we've discussed today about those tricky behavioral biases, like managers focusing too much on short-term EPS due to their compensation, and the absolute importance of long-term value creation in effective capital allocation, what kind of management compensation structure do you think would best encourage a company's leaders, the CEO, the CFO, the top executives, to make capital allocation decisions that truly benefit shareholders over the long term and help them avoid those short-sighted pitfalls we talked about? How would you design their pay to align their interests with long-run value?
That's a challenging but very important question. Something to definitely think about. Well, thank you all for joining us on this step dive today. We sincerely hope it was insightful and helped you build a stronger foundation in this critical area of finance. Happy learning.
Namaste, my wonderful students. A very warm welcome to another exciting deep dive with us. This is especially crafted just for you, whether you are just starting your journey into the world of finance or perhaps preparing for important exams like the CFA. Today, our focus is on a very fundamental, yet really fascinating concept, capital structure. Now, what exactly is this capital structure we speak of? Imagine, if you will, your own family. When your family decides to buy something very big, very important, like a new home or perhaps a new car, how do they gather the money? Do they use all their hard-earned savings, every single rupee they have saved, or do they perhaps take a loan from a bank? Or maybe it's a smart mix of both some of their own savings and some money borrowed from the bank. That clever mix, my students, of their own money, which we call equity, and the money borrowed from others, which we call debt. Well, that is essentially what capital structure is for a company. It is how a business decides to find the money, the funds, to finance its long-term needs, its big dreams, its expansion plans, and its daily operations.
That is a truly wonderful and very easy to understand example. And for our mission today, especially for you, our dedicated students who are really keen to build a strong foundation in finance, we're going to take some financial terms that might seem a little complicated at first glance. Terms you will definitely encounter in your learning materials, and we will simplify them piece by piece. Our goal is to make sure you have those clear aha moments so that you feel confident and not at all overwhelmed by, well, the amount of information out there. We really want to help you build a very strong, very clear, and very practical foundation for your entire finance journey.
Exactly. Think of us as your friendly guides, here to help you navigate through your comprehensive learning module on capital structure. We're here to help you find the most important nuggets of knowledge from this excellent material, just like finding the sweetest, juiciest mangoes in a big orchard. We will pick out the best for you.
Absolutely. And in this deep dive, we will slowly, patiently, and clearly explain terms that might sound a bit intimidating initially, like WACC, the weighted average cost of capital. We will also explore the truly interesting Modigliani-Miller propositions, and then the very practical concept of optimal capital structure. We will make them all as clear and as easy to understand as reading a cricket scorecard after a thrilling match. Every run, every wicket, every decision will make perfect sense.
So are you ready, my curious students, to learn how these big companies finance their big, ambitious dreams and what these important financial decisions mean for their overall value and success? Let us begin our exciting exploration into the very heart of corporate finance. All right, my diligent students, let's begin our journey by understanding the most fundamental goal, the main objective behind every single capital structure decision that a company makes. It is all about minimizing the firm's weighted average cost of capital, or for short, we call it WACC. Think of it this way. Imagine your family wants to get the best possible loan rate for a new car. The lower the interest rate, the better, right? Well, for a company, minimizing its WACC means they are arranging to get money at the cheapest possible overall rate to fund their growth and their projects. This helps them keep more of their earnings.
Exactly. To make this even clearer, capital structure simply refers to how a firm organizes its long-term funding. It's that crucial blend, that mix of long-term debt and equity financing. Let's use some examples from our everyday life here in India to make these terms absolutely clear for you. When we talk about long-term debt, imagine a small shopkeeper, perhaps someone who sells beautiful textiles or aromatic spices in the local market. He has a dream. He wants to expand his shop, maybe add a new section for ready-made garments or buy a large, efficient new machine for his business. So what does he do? He goes to a bank and takes a loan. But this isn't a loan he plans to repay next month or even next year. No, he plans to repay it slowly, patiently, over many years, let's say 5 or even 10 years. This kind of loan, which is meant to be paid back over a substantial period, is what we call long-term debt. It's typically used for big investments that will benefit the business for a long, long time. Do you understand this concept, my students? What kind of loan would your family take to buy a new home, a short-term or long-term one? It would be long-term, wouldn't it? Right, a long-term loan, just like the shopkeeper. Now, what about equity financing? Let's consider the same shopkeeper again. Instead of taking a bank loan, he decides to use his own personal savings, all that money he has patiently accumulated, to expand his shop. Or perhaps he asks his family members, his elder brother, or a trusted cousin to invest some money in his shop. In return for their investment, these family members don't get a fixed interest payment every month like a bank would. No. Instead, they get a share in the business, a part of its ownership. And because they are owners, they also get a share in the business's future profits. This, my students, is equity. It's the owner's money, or money from those who become owners by investing. It signifies direct ownership. So, do you see how both debt and equity help a business grow, but in different ways? What is the main difference between giving a loan to the shopkeeper and investing in his shop as an owner? Did you catch that? Very good. When you give a loan, you expect fixed interest back. When you invest as an owner, equity, you share in the profits, which can be more or sometimes less. So when we use the term cost of capital, we are essentially talking about the required rate of return that investors expect for providing their money to a company. It's a very fair expectation, isn't it? Just like when you lend some money to a friend, you might expect them to return it with a little extra, perhaps as a gesture of goodwill or a small thank you. Similarly, when investors provide capital to a company, whether through debt or equity, they absolutely expect a return on their money. That expectation, that return they demand for their investment, becomes the company's cost to use that money. It is the minimum profit rate, the hurdle rate that the company must achieve from its investments to make it worthwhile for those who provided the funds. Does this make sense, students? If you invest your money in a company, what do you expect back from it? You expect a return, right?
Yes, you expect a return, a profit on your investment, just like the company needs to pay back its cost of capital. So my bright students, it becomes very clear that a company's total cost of capital isn't just one single number, is it? It's a blend, a careful mix of two main components. First, the cost of debt, which is what the company pays to borrow money, and second, the cost of equity, which is what they essentially pay to their owners or shareholders for using their invested funds. It's like combining two different flavors to make a new, unique taste.
That's absolutely right. And here's where it gets really interesting, my students. The cost of debt is almost always lower than the cost of equity. Why do you think this is so? Well, it's all about risk, my dear students. For investors, providing money as debt is generally considered less risky. Why is that? Because debt holders, like banks or people who buy a company's bonds, have what we call a priority claim on the firm's cash flows. This means their claim is fixed, it's written in a contract, and it absolutely comes first.
They get paid first before anyone else.
Exactly. Let me give you an Indian example to explain priority claim. Imagine you're traveling by train, perhaps on a long journey from Delhi to Mumbai. What is the very first thing you do? You buy your train ticket, right? That's a fixed, essential payment that comes before anything else. Only after you have bought your ticket and secured your seat for the journey do you then think about spending money on snacks from the vendor or buying a hot cup of chai on the platform. The train ticket payment is like the debt payment, it has priority. The money you have left over for snacks and chai, that's what's available for the owners, the equity holders, after all the priority claims are met. Do you see how the train ticket payment is a must, why the snacks are optional depending on what's left? Furthermore, some debt can be secured with an underlying asset. Think of it like this, using our shopkeeper example again. If he takes a loan specifically to buy a new textile machine for his shop, he might tell the bank, if for some reason I cannot repay this loan, you can take this machine. Oh, that machine then becomes the collateral. It makes the loan much less risky for the bank because they have something tangible, something valuable to fall back on if things go wrong. Similarly, if you take a gold loan, your gold jewelry is the collateral. If you don't pay, the lender keeps the gold. The security makes the loan even safer for the lender, which means they can often offer a lower interest rate. Does the idea of something being secured make it less risky for the person lending the money? What do you think?
Yes, it absolutely does. When something is secured with an asset, the lender has more confidence they will get their money back, one way or another.
Precisely. In contrast, equity is a residual claim of indeterminate length. What does residual claim mean? It means that shareholders, the owners, only get what's left after all other obligations of the company are met. This includes paying back bank loans, paying suppliers for goods, paying employees their salaries, and covering all other operating expenses. Going back to our shopkeeper, after he pays his shop rent, pays his staff salaries, pays his loan EMIs, and covers all his other business expenses, whatever profit remains, that is for him, the owner. That's the residual. It's not a fixed amount. It can vary greatly, sometimes high, sometimes low, and there's no specific end date to their claim as owners. They are owners for as long as they hold the shares. This higher uncertainty, this variability, means that equity investors demand a higher return, a bigger share of the potential profits, to compensate for the greater risk they are taking. Is the shop owner guaranteed a fixed income every month, like a lender is guaranteed interest? What do you think?
Now, the shop owner's income varies quite a bit, which really shows the residual nature of equity. It's riskier. So it makes perfect financial sense, doesn't it, my diligent students? Less risk for the lender, for the person or institution giving the money, naturally means a lower cost for the borrower, the company that is taking the money. It's a very simple, yet fundamental principle of finance that you'll understand and see again and again in various situations.
Indeed. Now, let's bring all these pieces together and talk about the weighted average cost of capital, or WACC. This is a blended cost, essentially an average of all the different capital sources a company uses, like debt and equity. But importantly, it's weighted by how much of each they use. It gives us a single overall cost of capital for the entire firm, telling us how much it costs the company, on average, to finance all its operations and investments. The formula, which you will become very familiar with, is WACC equals cost of debt, weighting of debt, plus cost of equity, equity at weighting of equity. To explain weighting with another familiar example, imagine your family is buying a new car. If they decide to use 60% of their own savings and take a 40% loan from the bank, then 60% and 40% are the weights. The WACC for this car purchase would be the average cost of all the money they used, including the opportunity cost of their savings, meaning what they could have earned if they invested that savings elsewhere, and the interest rate on the loan weighted by how much of each type of money they used. It's a true reflection of the overall cost of funding their new car. Does this idea of giving weight or importance to each source of money make sense to you?
Yes, just like giving more importance to the bigger part of something. If savings are 60%, they matter more than the average.
Exactly. Now let's look at the components needed to calculate WACC in a bit more detail. First, the cost of debt. This, as we discussed, is the required return for those who lend money to the company. A good starting point to estimate this is often the interest rates on a company's existing loans or bonds. However, if we want a forward-looking measure, meaning what it would cost the company to raise new debt today for a new project, we would look at what similar comparable companies have recently borrowed at in the market. This gives us a current, realistic market rate for debt. A very, very crucial point here for debt, my students. In many countries, including our own India, interest expense is tax deductible. Well, what does tax deductible mean in simple terms? Imagine if the government said that for every rupee of interest you pay on a business loan, you don't have to pay income tax on that particular rupee of your earnings. It effectively makes the loan cheaper because you are saving money on taxes. So if your business earned 100 profit and you paid €10 in interest, only 90 would be considered for tax purposes. That euro is literally shielded from tax. Because of the significant tax benefit, we always adjust the cost of debt by multiplying it by one tax rate. This gives us the after-tax cost of debt, which is the true effective cost of debt to the company after considering the tax savings. Is interest tax deductible for individuals' personal loans too, like a car loan? Usually not, right?
No, usually not for personal loans. Typically only for business loans. This really highlights how companies get a special benefit.
Absolutely. Next, we consider the weightings of debt and equity. For calculating WACC, we always prefer to use market value proportions over book value. Why is this important? Let me give you an Indian example to explain market value versus book value. If you bought a share of a company many years ago for 100, that euro is its original book value in the company's records. But if today you check the stock market, you might find that same share is trading for 500. That 500 is its market value. The market value is what truly reflects its current worth and what an investor could actually get or would have to pay if they bought or sold that share today. It reflects the investor's opportunity cost, what they're giving up by keeping their money in this company versus investing it elsewhere today. So we always use market values for WACC because they reflect current economic reality and investor decisions. However, sometimes, for practical reasons, management's target weights for their overall capital structure might be expressed using book values or indirectly through other financial ratios. We'll touch on that later. Finally, we come to the cost of equity. This is the required return for equity investors, the owners of the company. Unlike debt, where we can clearly see an interest rate, there isn't a simple observable rate for equity. We just know it's generally higher than the cost of debt, as we discussed, because of the higher risk equity investors take. And importantly, distributions to shareholders, like dividends, are generally not tax deductible for the company, unlike interest payments. A simple way to estimate the cost of equity, especially in our learning examples, is to look at historical returns on broad market indices. For example, a large stock market index might have grown at an average of 10% per year for a very long period, say from 1928 to 2021. This 10% can serve as a general starting estimate for the cost of equity in our lessons. There are more sophisticated methods, of course, but this gives you the basic idea. We also need to remember that if a company uses other types of financing, like preferred stock or certain non-controlling interests, their after-tax costs also need to be included in the overall WACC calculation to get a complete picture. Do you remember why we call it preferred stock? Does it have any advantage?
Yes, preferred stock usually gets paid dividends before common shareholders, making it slightly less risky than common equity, though still riskier than debt. That's a lot of important details, my dear students, but understanding each piece of WACC is like mastering each stroke in cricket. Every single one is essential for the overall game, for hitting that boundary or taking that wicket. Now let's try a couple of simple examples together to solidify this concept in your minds.
Excellent idea. Let's walk through the Nutri Inc. WACC calculation from your source material. Imagine Nutri is a company with a capital structure made up of 30% debt and 70% equity. Their interest expense, as we know, is tax deductible. Debt investors require a before-tax return of 5%, and equity investors' required return is 10%. If the marginal corporate tax rate for Nutri is 20%, what will be their WACC? Let's calculate this step by step patiently. Okay, first, we'll need the after-tax cost of debt. That's 5% multiplied by 1 minus the tax rate of 0.20. So 5% times 1.20 equals 5% times 0.80, which gives us 4%. Okay, now let's plug these values into our WACC formula. WACC, after-tax cost of debt, equating of debt, plus cost of equity, equating of equity. So WACC equals 4% times 0.30 plus 10% 0.70. Let's calculate that. 4% times 0.30 is 0.012 or 1.2%. And 10% times 0.70 is 0.07 or 7%. So WACC, it's 1.2% plus 7%, 8.2%. There we have it.
See, my dear students, how that tax benefit changes things. That 20% tax rate made the original 5% cost of debt effectively only 4% for Nutri. It significantly lowers the cost of debt, impacting the overall WACC. It's like getting a special discount on your mobile recharge because you are a loyal customer. That discount effectively makes your recharge cheaper.
Exactly. Let's do one more example together just so you feel completely comfortable. Consider ABC Corporation. They're financed with 40% debt and 60% equity, and yes, their interest expense is also tax deductible. Their debt investors require a before-tax return of 4%, and equity investors require 10%. The marginal tax rate for ABC is 23%. Let's calculate their WACC, again, step by step, carefully. First, the after-tax cost of debt. 4% multiplied by 1 minus the tax rate of 0.23. So 4% times 1.23 equals 4% times 0.77, which is 3.08%. Got that. Now let's apply the WACC formula. WACC, after-tax cost of debt, weighting of debt, plus cost of equity, weighting of equity. WACC equals 3.08% times 0.40 plus 10%, 0.60. Let's work it out. 3.08% times word 40 is 1.23% plus 6%, approximately 7.23%.
Now, my bright students, just to check your understanding, can you tell us in your own words, why is the cost of equity generally higher than the cost of debt? Think about who takes on more risk, the lender or the owner.
That's an excellent question to pause and consider, our students. And the answer, as we have thoroughly discussed, is exactly this. Debt investors take on less risk than equity investors. This is because debt has a priority, contractual claim on the firm's cash flow, meaning they are first in line to get paid. And often, debt is secured with underlying assets, providing an extra layer of safety for the lender. Equity, on the other hand, is a residual claim, which means shareholders only get what is left over after everyone else has been paid. So they bear more risk, and because of this higher risk, they naturally demand a higher return for their investment. Well done if you got that right.
So, my dear students, we now have a solid understanding of WACC and its various components. That's great progress. But that naturally leads us to the next big question. What practical factors genuinely influence a company's strategic decision on how much debt or equity to employ? It can't simply be a random allocation of funds, can it? There must be some important considerations, right?
Not at all random. It's a very thoughtful process. The overarching goal for management is still to minimize their WACC, as we discussed, and where possible, to try and match the duration of their assets with their financing. For instance, if you buy a house, which is a long-term asset that you will use for many years, you would naturally take a long-term loan for it, not a short-term personal loan, wouldn't you? Similarly, a company buying a factory, a very long-term asset, would seek long-term financing. Many factors come into play, my students, both internal to the company itself and external factors from the financial market. These determine not only the amount and type of financing needed, but also the actual costs of both debt and equity. Let's first discuss the determinants of the amount and type of financing needed, which essentially influence the weightings of debt and equity in our WACC calculation. One very major determinant is the company's business model itself. Some businesses, my students, are what we call capital-intensive businesses. These businesses require a lot, and I mean a lot, of assets, expensive machines, large buildings, vast networks to operate and generate revenue. Think of big utility companies, like those that provide electricity or water, or transportation companies with their huge fleets of buses, trains, or even aircraft. Real estate developers who build towering buildings, or manufacturing companies, especially in very complex sectors like semiconductor chip manufacturing, or companies involved in natural resource production like mining. These are all capital intensive. These companies typically have a low asset turnover, meaning they don't generate a lot of sales for every rupee of assets they own. They have high capital expenditures relative to their sales, meaning they spend a significant portion of their money to buy and maintain their assets. And they might also have high net working capital to sales ratios, indicating that a lot of their capital is tied up in their daily operations. Do you think a small neighborhood bakery would be considered capital intensive compared to, say, an airline? Probably not, right?
No, probably not. It needs some equipment, but nowhere near the massive investment an airline needs for planes and infrastructure.
Right. It's interesting, my students, how some businesses have adapted to this. For example, a huge global hotel company like Hilton often operates hotels but often doesn't own the actual buildings themselves. Other companies own them. Similarly, a brilliant company like NVIDIA designs powerful computer chips, but giant manufacturing companies like TSMC actually manufacture them. This strategy helps to separate the capital-intensive manufacturing part from the design and branding part, allowing companies to focus on what they do best without tying up huge amounts of capital. A very common example of how capital-intensive businesses manage their financing is through leases as debt financing. leasing. Many businesses, instead of outright buying expensive assets like office space, data centers, or even aircraft, choose to lease them. A lease, in essence, is very much like a loan for an asset. You don't receive cash directly, but you get to use the asset, and in return, you make regular payments that reflect an implicit interest rate. This implicit interest rate is often lower than a traditional loan because the leased asset itself serves as collateral. Let me give you another Indian example for a collateral here. If you take a gold loan from a bank, your gold jewelry is the collateral, isn't it? If, unfortunately, you don't pay back the loan, the lender keeps the gold. Similarly, for a company, if they lease an expensive aircraft and cannot make their lease payments, the leasing company can simply take back the aircraft. This makes it less risky for the leasing company, leading to a lower interest rate embedded in the lease payments. Secured debt works in a very similar way. Using an asset as collateral for a loan almost always results in a lower cost of debt. Does that make sense? Why do banks and lenders like collateral? What does it do for them?
Banks like collateral because it reduces their risk of losing money if the borrower defaults. It gives them something back.
Exactly. On the other hand, my students, we have capital-light businesses. These are businesses with very low capital needs, meaning they don't need a lot of expensive assets to operate. You'll find many of them in the technology sector or in service industries that have cleverly separated themselves from asset ownership. Think of hugely popular companies like Uber or Airbnb. They operate vast networks connecting service providers like drivers or homeowners with customers, but they don't own the cars or the properties themselves. Their main assets might primarily be cash and intangible assets like brand names, software, customer lists. They typically have a high fixed asset turnover and low capital expenditures relative to their sales.
Think about it like this, my students. A company that simply runs a platform for renting out rooms, like Airbnb, doesn't need to buy hotels themselves. They don't have to invest enormous amounts of money in constructing buildings, buying furniture, hiring hundreds of staff for each hotel, and maintaining all that infrastructure. This makes them inherently capital light compared to a traditional hotel chain that owns all its buildings and properties. It drastically changes their financing needs, doesn't it? They need far less external money to operate.
Absolutely. Such companies might also have business models where they charge customers upfront for services, or they might have a very short or even negative cash conversion cycle. This means they receive cash from customers before they even have to pay their own suppliers. Think about that. It significantly reduces their need for external financing. They might also compensate their employees with company stock, which is another clever form of equity financing that comes from employees rather than formal financial markets, thereby reducing the need for cash outlays. Beyond the business model, my students, another major determinant of the type of financing used is the corporate life cycle of a company. A company's capital structure is not fixed or static. It dynamically changes as the company grows and matures over time, just like a child grows into an adult. In the startup phase, a company is just, well, starting up. It has zero or perhaps minimal revenue, faces very high business risk because its products or services are unproven, and it typically has negative free cash flow because it's spending a lot to develop its product or service without earning much yet. At this very early stage, getting traditional debt from banks is extremely difficult due to the high risk. So financing primarily comes from equity. The founder's own hard-earned money, shares given to early employees, and investments from venture capitalists who are willing to take high risks for potentially high rewards. Large public offerings, like IPOs, initial public offerings, are very unlikely at this stage due to strict regulatory requirements and the company's small size. Debt is very limited, maybe just leases for office space or convertible debt, which is a special type of debt that can be turned into equity later, often allowing the company to defer interest payments until it becomes more stable. Would a startup company prefer a fixed interest payment loan or a way to share future profits with investors, which makes more sense when cash is tight?
A startup would likely prefer sharing future profits using equity because its income is so uncertain. Fixed payments would be very risky for them. Just like a new chai stall that's just starting up in your neighborhood. It needs money from the family or friends' investments to get started, doesn't it? They wouldn't get a big bank loan because they don't have a proven track record or stable income yet. It's all about that initial push, that belief from those who truly believe in the idea and are willing to share the risk.
Precisely. Then we slowly move to the growth phase. Here, the company's revenue is rising and its growth is accelerating, which is wonderful. However, they often still have negative free cash flow because they're reinvesting very heavily to scale up their operations. Think of all the marketing expenses, expanding to new cities, buying more equipment. But during this phase, the company's visibility is improving. They are building a strong customer and supplier base. As the overall business risk starts to decline, lenders become more willing to provide some debt. But equity still remains the most important source of financing, and companies use debt conservatively, meaning carefully, to maintain flexibility. Secured debt, where they offer an asset as collateral, is more likely here because it makes the loan safer for the bank. If your chai stall started opening your branches, would you expect banks to be more or less willing to lend money now?
They would likely be more willing to lend money, as your business now has a proven track record and perhaps some assets to offer as security. So now your chai stall is becoming really popular, and you're thinking of opening a few new branches across the city. You're still spending a lot of money to grow and set up these new places, but because you have a proven concept and some stable revenue, banks might be more willing to lend you money, especially if you offer some security, like your existing shop or new equipment. This is a sign of growing trust, isn't it?
That's a perfect analogy, absolutely correct. Finally, we have the mature phase. In this stage, the company's revenue growth slows down, but it becomes much more predictable and stable. A mature firm generates reliable and positive free cash flow, and its investment needs for rapid growth usually decline. Because of this consistent and predictable cash flow, such companies can borrow money much more cheaply than they can raise new equity. They often aim to maintain an investment-grade credit rating to keep their borrowing costs very low. At this point, because they have surplus cash, they might even start distributing capital back to shareholders through dividends or by buying back their own shares from the market. Which company would a bank prefer to lend money to? A brand new startup or a mature, stable company with predictable profits? It's quite clear, isn't it?
Yes, a bank would much prefer to lend money to a mature, stable company. They're simply less risky from the lender's point of view. This is like a very successful, large chain of restaurants, perhaps with branches all over the country. They have a steady, predictable income from all their branches. So banks are very happy to lend them money at low rates because they know the money will be repaid reliably. And because they're so profitable and stable, they might even return a part of their profits to shareholders regularly as a reward for their investment. It's a sign of a very well-established business.
Excellent points. Now, my bright students, based on what we just discussed about the corporate life cycle, which type of company among these three phases, startup, growth, or mature, would likely find it easiest to get an unsecured bank loan? Remember, an unsecured loan doesn't require specific collateral. Think about which one has the most predictable cash flows and lowest business risk. The answer, my students, is the mature phase company. They have the most stable, predictable cash flows and generally lower business risk, making them very attractive to lenders even for unsecured debt, where no specific collateral is needed. Lenders simply trust their ability to repay. Okay, now let's turn our attention to the determinants of the cost of debt and equity themselves. So, not just the type or amount of financing a company uses, but how expensive these types of financing actually are for the company. These costs are determined in the broader financial markets by two main categories of factors: top-down factors, which affect entire markets and industries, and issuer-specific factors, which are unique to each individual company. Under top-down factors, we first have financial market conditions. Economic conditions like real economic growth, inflation rates, and the central bank's monetary policy significantly influence the required returns for investors across the board. For instance, if the central bank increases general interest rates, the interest rates on government debt will naturally go up. Consequently, companies will also have to pay higher rates to borrow money. If there's an increased risk of a recession, debt investors will demand higher credit spreads, which is an extra cost borrowers pay, to compensate for the higher risk that the company might not be able to repay its loan. Ideally, companies prefer to borrow when overall interest rates are low and issue new equity when stock prices are high to get the best terms. It's common sense, really.
It's like how the general economy affects everyone in our country, isn't it? If the overall market is doing well, if there's good economic growth and stability, getting a loan for your business might be cheaper because lenders feel more secure. But if there's a recession or a lot of economic uncertainty, it becomes very difficult and expensive for everyone to borrow money. The financial tide, whether high or low, tends to lift or lower all boats.
Exactly. And then there are industry conditions. The specific industry a firm operates in plays a very big role in its financing costs. For example, if global oil prices are very high, it generally benefits oil-producing companies, leading to lower credit spreads for them and making it easier for them to take on more debt because their profits are higher. However, for companies like airlines, high oil prices mean significantly higher fuel costs, which could lead to increased business risk for them and thus higher financing costs. So the same factor affects different industries differently. Moving on to issuer-specific factors, my students. These are elements unique to each individual company, and they significantly influence how debt and equity investors assess that company's risk and the returns they require from it. First, we have sales risks. Companies with stable, predictable, and consistently growing revenues generally enjoy lower financing costs. Think of a well-established telecom company or a software company with many customers paying recurring monthly subscriptions. Their cash flows are very stable and reliable. Now compare that to companies in, say, automobile manufacturing or construction equipment, where sales and cash flows can be highly volatile, swinging wildly up and down with general economic conditions. The latter, with volatile sales, are considered riskier, so investors demand a higher return. Do you think a mobile network provider with monthly bill payments from millions of customers has high or low sales risk? What would you say?
A mobile network provider usually has quite low sales risk because of those recurring payments from a very large customer base. It's predictable.
All right. Second, profitability risks, often measured by operating leverage. This concept tells us how much of a company's total costs are fixed costs, meaning they don't change regardless of how much the company produces or sells, versus variable costs, which do change directly with the level of sales. The simple way to understand operating leverage is operating leverage equals fixed cost total costs. A higher ratio means more fixed costs. A company with high operating leverage will experience a much greater change in its cash flow and profitability for a given change in its revenue. This means that higher operating leverage generally implies higher business risk. Let's look at a simplified example to understand this better. Imagine two companies, let's call them Firm FC Plus and Firm FC, and both start with an operating profit of 30. Firm FC Plus is primarily fixed cost. It has high fixed costs of 50 and variable costs that are only 20% of its sales, say 20. Firm FC is primarily variable cost. It has lower fixed costs of 20, but higher variable costs that are 50% of its sales, say 50. Now let's see what happens if sales change by 25%, if sales rise by 25%. Firm FC Plus, high fixed costs, sees its profit jump from 30 to 50, a big jump. Firm FC, high variable costs, sees its profit go from 30 to 42.5, still good, but less dramatic. So when sales go up, the fixed cost company seems to do a bit better because its costs don't rise as much. But what if sales decline by 25%? This is where stability really matters. Firm FC Plus's profit goes from 30 way down to just 10, a huge drop. Firm FC's profit goes from 30 down to 17.5, a much smaller drop. So you see, Firm FC is much more stable and resilient in downturns because its costs adjust more directly with sales. If sales drop, its variable costs also drop, providing a cushion. Debt investors who always want predictable payments prefer this kind of stability. They would likely lend to Firm FC at a lower cost because it appears less risky. Which of these two firms would a lender prefer during an economic slowdown? The one with high fixed costs or high variable costs?
A lender would definitely prefer to lend to Firm FC, the one with higher variable costs, because its costs are more flexible and adjust to lower sales, making it more stable and reliable. Think of it like this, my students. Imagine you operate a bus service. This is like Firm FC plus high fixed costs. Whether 10 people ride the bus or 100 people ride, the big costs of the bus itself, loan payments, driver salary, insurance remain the same, mostly fixed. But now think of a taxi service like Firm FC, high variable costs. The taxi driver pays more in petrol only if there are more rides. That's a variable cost. So if there are fewer customers, the taxi service's costs adjust better, making it more stable for a lender. This is operating leverage in action, how fixed costs make profits more volatile.
Excellent, clear example. Now, the third issuer-specific factor is financial leverage and interest coverage. This refers to how much debt a company already has in its capital structure. If a company has a lot of existing debt, it means it has less capacity, less room to take on even more debt without significantly increasing its risk. For equity investors, high debt means there are significant priority claims, those fixed interest and principal payments that must be paid before they, the owners, get anything. This makes their investment in equity much riskier. Financial leverage is often measured as total debt divided by operating income or total equity. Interest coverage specifically measures a company's ability to easily make its regular interest payments from its core business profits. The formula is simple. Interest coverage, profit before interest and taxes, interest expense. A higher number is better. Let's compare two companies. Firm A, more equity, and Firm B, more debt, both starting with 100 in total assets to understand financial leverage. Firm A has 80 in equity and only 20 in debt. Interest expense is low, just 2. Its profit is 28, and it has a very high interest coverage of 15, because 30 profit before interest, 2 interest equal at 15. Very safe. Firm B has 40 in equity and 60 in debt, much more debt. Interest expense is higher, 9. Its profit is 21, giving it a higher return on equity, ROE initially, but a lower interest coverage of 3.3. 39 equals 3.3. More risky. Now let's see what happens if operating income increases by 25%. Firm B's ROE jumps significantly, much higher than Firm A's. Debt boosts returns in good times. However, if operating income decreases by 25%, this is where the risk shows. Firm B's interest coverage plummets to just 2.5, indicating it's becoming difficult to cover interest. Firm A's interest coverage, even in the downturn, remains very high at 11, much safer. The conclusion here, my students, is that Firm A with more equity has a narrower range of outcomes and more stable profits. Its high interest coverage means it can withstand significant drops in operating income. This stability makes investors require lower returns from Firm A because it's less risky. Does having high interest coverage make a company seem more reliable to a bank? Yes or no?
Yes, absolutely. High interest coverage makes the company seem very reliable and creditworthy to a bank. It shows they can easily handle their debt payments. My students, imagine you have a monthly salary. If a very big chunk of your salary goes to EMIs for loans like a home loan or a car loan, you have high financial leverage, like our Firm B. A small drop in your salary can make it very, very hard to pay those EMIs. But if your EMIs are very small compared to your salary, like Firm A, you're much safer, aren't you? You have more cushion if your income fluctuates. So debt can certainly amplify both good times and bad times for a company.
Very true. Finally, the collateral or type of assets a firm owns is a significant factor. Assets that are strong collateral, meaning they can easily back a loan and that generate consistent cash, or are fungible and liquid, meaning they can be easily sold, like real estate, vehicles, or receivables. These types of assets support greater use of debt. A bank will be much more willing to lend against these kinds of assets. However, for technology or pharmaceutical firms, which often have a lot of intangible assets like patents, software, or brand names rather than physical, easily sellable assets, the costs of financial distress are much higher because these assets are harder to sell quickly or value precisely in a distressed situation. The probability of distress naturally rises with more debt, higher sales risk, higher operating leverage, and lower liquidity. Can a company easily use its famous brand name as collateral for a bank loan? What do you think?
No, probably not. A brand name is an intangible asset and is very difficult, almost impossible, to use as direct collateral for a typical bank loan. Banks prefer physical things they can potentially sell. Now, my intelligence students, if a company has very stable sales and a high interest coverage ratio, what do you think that means for its cost of debt and equity? Will it be higher or lower? Take a moment to think carefully about the risk.
That's absolutely correct. It suggests a much lower risk profile for the company. And therefore, both debt and equity investors would require a lower rate of return for their investment. Stability and strong financial health are always rewarded with lower financing costs in the market.
Now, my dear students, let's explore some truly groundbreaking and highly influential ideas in finance from two Nobel Prize-winning economists named Franco Modigliani and Merton Miller. We often refer to them simply as MM for short. Their ideas, though very theoretical in nature, provide an incredibly important framework for understanding the very core of capital structure decisions.
Indeed. Their core argument, under a very specific set of important assumptions, was that a company's capital structure, meaning how it mixes its debt and equity, simply does not affect its overall value. In their view, the firm's value comes primarily from its expected future cash flows, the money it is expected to generate from its operations, not from how it's financed. It's a bit like saying the delicious taste of your favorite biryani comes from the quality of the rice, the spices, and the chicken, not from whether you paid for those ingredients with cash or credit. The biryani's essence remains the same. Now, my students, these are the key assumptions that MM started with. It's very, very important to understand these before we start relaxing them and bringing in real-world complexities. Your source material highlights them. 1. Homogeneous expectations. This means all investors agree on the expected future cash flows. Everyone sees the same future. 2. Perfect capital markets. This is a very big one. It means no transaction costs, no taxes, no bankruptcy costs. And crucially, everyone has the same information instantly. No secrets. Let me give you an Indian example for perfect capital markets. Imagine a market where buying or selling anything vegetables shares costs you absolutely no money, no commission, no fees. There are also no taxes on anything. And, most importantly, everyone knows absolutely everything about every product or company instantly. No hidden information. This is a perfect market, very different from our everyday life, isn't it?
Yeah.
3. Risk-free rate. Investors can borrow and lend at the exact same constant risk-free rate. 4. No agency costs. Managers always act perfectly to maximize shareholder wealth, no conflicts of interest. 5. Independent decisions. Financing decisions, how to get money, and investment decisions, what projects to do, are completely separate.
Wow, those assumptions are quite simplified, aren't they? They don't sound much like our real world with all its complexities and taxes and hidden information. But My students, they are very helpful. They help us understand the core, pure logic of MM's arguments before we start adding in the complexities. It's like learning to walk steadily before you learn to run fast.
Precisely. Let's delve into their first major conclusion, known as Proposition I without taxes. Capital structure irrelevance. The core idea here is very straightforward. VL equals VU. This means the value of a levered company, VL, which uses debt, is equal to the value of an unlevered company, VU, which uses only equity. They are worth the same under these assumptions. Argued that if a company is, let's say, all equity, no debt, unlevered, but an investor wants some leverage, wants to magnify their returns with borrowed money, they can simply create homemade leverage. What does this powerful idea mean? If the company itself doesn't take a loan, but you as an individual investor want your investment to have some loan effect, you can personally take a loan from your bank and use that borrowed money to buy the company's shares. You, the investor, have created the leverage yourself, at home. This personal action doesn't change the company's fundamental cash flows or its overall value. Used an arbitrage argument to prove this. Arbitrage, my students, means making a riskless profit from price differences. If, hypothetically, a levered company were more valuable than an unlevered one without taxes, smart investors could make riskless profit by selling the overvalued one and buying the undervalued one, forcing their values to be equal. So, the conclusion of Proposition I without taxes. Firm value is determined by future cash flows, not how it's financed, and consequently, the WAC is also unaffected by capital structure. Do you think a magician can make money appear out of thin air by just shuffling cards? says it can't create value just by shuffling debt and equity without taxes. What do you think?
No, just shuffling cards doesn't create new money. Similarly, for capital structure alone doesn't create value without taxes. It's the underlying business that matters. So my students, according to without taxes, whether a company uses debt or not, its overall value doesn't change. It's truly like preparing your favorite biryani. Its delicious taste and true value comes from the quality of the ingredients. The fresh rice, the fragrant spices, the tender chicken. These are like the future cash flows. The taste doesn't change based on whether you bought those ingredients with your cash savings or on credit from the grocery shop. The biryani's essence remains the same.
Exactly. Now, my students, what is the main driver, the most important factor of a firm's value, according to Modigliani Miller, when they assume no taxes? A quick check for you. The main driver, my students, is its expected future cash flows. The capital structure, according to Proposition I without taxes, is irrelevant to the firm's total value. Okay, let's move to Proposition II without taxes. Higher financial leverage raises the cost of equity. This might sound a little bit counterintuitive at first, so please listen carefully. We know that debt is generally cheaper than equity because it's less risky for investors, so you might logically think that adding more debt should lower the company's overall WACC. However, Proposition 2 states that this isn't true without taxes. Why? Because while debt is indeed cheaper, adding more debt also significantly increases the risk for the equity investors. As the company takes on more debt, the probability of financial distress or even bankruptcy for the shareholders increases. As a result, equity investors will demand a higher return, a larger compensation for this increased risk. The formula for the cost of equity under this proposition is RE equals R0 plus R0 RDE. Here, RE is the cost of equity, R0 is the cost of capital for an all-equity firm. It's WACC if it had no debt. Recatter is the cost of debt, and DE is the debt-to-equity ratio. What this formula tells us is that the increase in the cost of equity perfectly offsets the greater use of lower-cost debt. The total risk of the entire business remains the same for all investors combined, so the WACC for the entire firm also remains unchanged, regardless of the mix. It's like shifting a risk from one group debt holders to another, shareholders. Let's illustrate this with the Gerhardt Corporation example. Suppose Gerhardt is an all-equity firm. Its expected annual cash flows are EUR 5,000, and its cost of equity in WACC is 10%. So its value is EUR 5,000.10.10. Now, Gerhardt issues EUR 15,000 in debt at a 5% cost and uses this money to buy back equity. So now it has EUR 15,000 debt and EUR 35,000 equity. Total value still EUR 50,000. Using the Proposition 2 formula for the new cost of equity, RE equals 0.10.10.0.05, EUR 15,000, EUR 15,000, EUR 35,000, RE equals raised up 0.10 plus 0.10 plus 0.0.143 plus 0.02143. Do you see how the cost of equity jumped from 10% to over 12%? Now let's calculate the new WACC. New WACC, weight of debt, cost of debt, plus weight of equity, cost of equity. New WACC, 15K, 50K, now 5 plus 35, negative 50, 0.12143. New WACC, 0.3005 plus 0.12143. 0.1055 plus 0.085, that's 0.085 plus 0.085 plus 0.5, 0.12 by 10%, still 10%.
Yeah.
The WACC remains completely unchanged, and the firm's total value remains EUR 50,000. The final cost of equity perfectly offsets the cheaper debt, since this makes sense. It's a perfect balance.
Yes, it shows that without taxes, the overall cost of WACC doesn't actually change. It's just the components shifting. So my students, imagine a group of friends deciding how to finance a fun trip together. If one friend takes a very big loan to pay for most of the trip, the others think of them as the equity holders naturally take on more risk. Why? Because there's now a fixed payment, that loan EMI that must be made, even if the trip isn't as fun or profitable as expected. So to compensate for that extra risk, those friends would naturally expect a bigger share of the fun or rewards from the trip. It's an internal balancing act.
A very relatable example. So my students, what happens to the WACC of a company under Proposition 2 without taxes when it increases its debt? Does it go up, go down, or stay the same? Think carefully. The WACC, my students, stays the same. The increase in the cost of equity perfectly offsets the greater use of lower cost debt, leaving the overall cost unchanged in the specific theoretical world. Okay, now let's bring MM's propositions much closer to reality. We need to consider the firm value with taxes, propositions with taxes. The big reality check that brought into their later work is this. In most countries around the world, including India, interest expense is tax deductible for companies. This provides what we call a tax shield. What exactly is a tax shield? It's a very powerful concept. Imagine if the government told a business, for every rupee of interest you pay on your business loan, we will reduce your taxable income by 1 rupee. It literally shields a part of your company's profit from being taxed. It makes the loan cheaper because you save money on taxes. So if your business earned 100 profit and you paid 10 in interest, only 90 would be considered for tax purposes. That euro is shielded from tax because of the significant benefit the after-tax cost of debt is. Before tax cost of debt, equity marginal tax rate. This tax shield is a very real benefit of using debt for profitable companies. Does this shield make debt more attractive or less attractive for a profitable company? What do you think?
It makes debt much more attractive
Yeah.
because it effectively lowers the cost by saving the company money on its taxes.
Exactly. With this tax benefit in mind, Proposition I, with corporate taxes, states a very different conclusion. VL equals VU plus TB. Where VL is the value of the levered firm using debt, VU is the value of the unlevered firm, no debt. T is the marginal corporate tax rate, and D is the total value of the debt. This means that in the presence of corporate taxes, a profitable company can increase its overall value by using debt due to this powerful tax shield. The higher the corporate tax rate, the greater the tax benefit, and thus the greater the value added by debt. If we were to take this theory alone to an unrealistic extreme, it would suggest a company should have 100% debt to maximize value, which, as we'll see, isn't true in reality for other important reasons.
Here's where the real world starts to truly peek in and change the picture. If the government gives a tax break or a discount for taking on debt, of course companies would want to use more debt. It makes perfect financial sense to leverage that benefit and reduce your overall tax bill. It's a smart strategy for any business to save money where it can.
Exactly. And this leads us to Proposition 2 with corporate taxes, cost of capital. If the value of the company increases with debt due to the tax shield, then logically its WACC, its overall cost of capital, must decrease as it uses more debt. Why? Because the tax shield effectively lowers the cost of debt even further. The revised cost of equity formula under corporate taxes is RE-R0 plus R01TDE. Notice the crucial 1T term here. This means that while the cost of equity still rises with more debt, shareholders still take on more risk, it rises at a slower rate than in the no tax case. This is because the tax shield makes the debt cheaper, partially lessening the increased risk burden for equity holders. Consequently, as debt increases, the company's WACC decreases and its overall value increases. Let's revisit our Gerhardt Corporation example, but now with a 25% corporate tax rate. Original all-equity firm cash flow is EUR 5,000. With a 25% tax rate, the after-tax cash flow is EUR 5,000, 1.25, EUR 3,750. Original WACC was 10%, so the unlevered value of EUR 3,750, 0.10 plus taxes reduce cash flow.
Now, Gerhardt issues EUR 15,000 debt still at 5% cost and buys back equity. The new value of the levered firm using Prop I with taxes, VLVU plus TD will EUR 37,500 plus EUR 3,715, EUR 15,000 is EUR 37,500 plus EUR 3,750, EUR 41,250. Do you see how the value has increased significantly due to the tax shield from 37,500 to 41,250? Now let's find a new cost of equity using Prop 2 with taxes. The new equity value is VL at EUR 41,250, EUR 15,000, EUR 26,000, EUR 20, EUR 5, 1.25, EUR 15,000, 15,000, you are 26,200.5. You are 15,000, you are 26,250. You are for 0.10, 0.714. Total made after tax costs into 12.143, 0.142%. You have portfolio equity, cost of equity, and WACC 15K 4125K. Weighted bet trust cost of debt plus weighted cost of equity. WACC 15K 41.25K 0.136 plus 1.25P 0.211 0.3. Did you notice, my students, with taxes, the WACC actually decreased from 10% down to about 9.09%. This means the company is getting money at a cheaper overall rate. Why would a company prefer a lower WACC? What does it mean for them?
A company prefers a lower WACC because it means its overall cost of funding is cheaper, which ultimately makes the company more valuable and potentially more profitable. That's a huge difference, isn't it? With taxes, the WACC actually decreased. This means the company is getting money at a cheaper overall rate, making it more valuable. It's like the government giving you a subsidy to take a loan for your business, making it even more attractive for you to grow and expand. It's a powerful financial incentive.
Indeed. So, my diligent students, if a company operates in a country with high corporate taxes, would it be more or less inclined to use debt, considering only the tax benefits? Think about that tax shield value. Based purely on the tax benefit, my students, it would be more inclined to use debt, as the tax shield, the tax savings, would be larger, leading to greater value enhancement for the company in that high tax environment. Now, my students, we have talked about the good things about debt, like the tax advantages. But now we absolutely must talk about the elephant in the room, the significant downside. While debt offers clear tax advantages, there's a very significant risk it introduces, the cost of financial distress.
Exactly. It's like finding a great shortcut to reach your destination faster, but then realizing the shortcut comes with a very big, bumpy road or maybe a few deep potholes. You have to weigh the benefits against the potential problems.
That's right. Financial distress refers to a situation where a company faces heightened uncertainty about its ability to meet its financial obligations, like paying interest or repaying principal. This often happens because its earnings have diminished or it's facing ongoing losses. High operating leverage and high financial leverage can really magnify these problems. When a company is in distress, even before it officially files for bankruptcy, it can face both direct costs and indirect costs. Direct costs are the obvious cash expenses, like legal and administrative fees during bankruptcy proceedings. These can be substantial. But, my students, the indirect costs are often much, much larger and more damaging. These include things like foregone business opportunities, potential deals lost because others see the company as shaky. Customers might stop buying, feeling the company won't be around to honor warranties. Suppliers might demand upfront payments or refuse business. Key employees might leave. There's also significant reputational damage that can last a long time. And often, new agency costs of debt arise conflicts of interest between managers, shareholders, and bondholders new bankruptcy. For instance, shareholders might want the company to take huge risks to save it, even if it jeopardizes the bondholders' claims. Which type of cost, direct or indirect, is typically larger and more damaging? What would we say?
Indirect costs, my students, are typically much larger and more damaging because they impact the company's reputation, its relationships, and its future business prospects long before any court case starts.
Right. The costs of financial distress are also influenced by the type of assets a firm has. They are lower for firms with assets that have a ready secondary market, meaning they can be easily sold, like aircraft, real estate, or vehicles. These tangible assets can be readily liquidated if needed. However, for tech or pharma firms, where much value is in intangible assets like patents or software, the costs of distress are higher because these assets are harder to sell quickly or value precisely. The probability of financial distress naturally rises with more debt, higher sales risk, higher operating leverage, and lower liquidity. A stark example is Rite Aid Corporation, a large U.S. retail pharmacy. It had a very highly leveraged balance sheet, lots of debt compared to earnings. During COVID, it actually did okay with testing vaccines, but afterwards revenue fell and it faced pricing declines and wage pressures. Because of its high financial leverage, this magnified the issues. Its bond prices fell sharply, its stock price plummeted. By May 2022, Rite Aid's cost of debt exceeded 20% due to stress risk. An analyst even warned the stock might be worthless. Management had to close stores and cut costs just to survive. Do you think Rite Aid would have faced such severe problems if it had very little debt? Probably not, right?
No, if Rite Aid had very little debt, its financial problems from the lower revenue would likely not have been nearly as severe. The debt amplified the problem hugely. This is a stark reminder, my students. Too much debt is like taking on too many responsibilities with a limited income for your household. If something unexpected goes wrong, the whole household budget can collapse. You start losing your reputation with lenders, and even your customers might stop trusting you. Debt is powerful, but must be used with great care.
Indeed. My diligent students, can you recall just one indirect cost of financial distress that a company might face even before it officially declares bankruptcy? Think about its relationships. One indirect cost, my students, could be losing customers or suppliers demanding upfront payments or perhaps key employees leaving the company for safer jobs. All very damaging.
So, my bright students, we've carefully seen the good side of debt, the valuable tax shield, and also the challenging bad side, the significant costs of financial distress. Now, the big practical question companies face is how do they find that sweet spot? How do they cleverly balance these opposing forces to get the most advantage without taking on too much danger?
This brings us to a very important concept called the static trade-off theory of capital structure. This theory attempts to find that sweet spot by carefully balancing the value-enhancing effect of the debt tax shield with the value-reducing impact of financial distress costs. The formula summarizes it well. VL equals VU plus TD PV, costs of financial distress. This means, my students, that the value of a levered firm, VL, equals the value of an unlevered firm, VU, plus the tax benefit of debt, TD, minus the present value of the expected costs of financial distress. It's a balancing act. Let's visualize this. Imagine a graph. As a company starts adding a small amount of debt, the tax benefits are usually greater than distress costs, so the firm's value increases. However, as more and more debt is added, the potential costs of financial distress start to rise substantially, maybe even exponentially. At some point, these rapidly rising distress costs begin to outweigh the tax benefits of adding even more debt. The optimal capital structure, let's call it D, is that specific level of debt where the marginal tax benefit of debt exactly equals the marginal cost of financial distress. This is the point where the firm's total value is maximized. If the company takes on debt beyond this D level, the distress costs become greater than the tax benefits, and adding more debt actually reduces the firm's overall value. Does that make sense? Why do you think more debt beyond the optimal point starts to hurt the company's value?
More debt beyond the optimal point hurts because the risks and costs associated with potential financial distress become too high, and they start to outweigh the remaining tax benefits. The negatives overtake the positives. Imagine you're trying to add spicy chili to your favorite dish, like a hot biryani. A little bit adds a wonderful flavor. That's the tax benefit, enhancing value. But if you add too much chili, go beyond the optimal amount, it can completely ruin the dish, making it too spicy to eat. That's like too much debt leading to financial distress. The optimal amount is just right.
A perfect analogy. So, my students, according to the static trade-off theory, what happens to a firm's value if a company takes on too much debt beyond its optimal point? Does the value increase, decrease, or stay the same? The firm's value, my students, would decrease. Beyond the optimal point, the increasing costs of financial distress outweigh the tax benefits, thus eroding the company's value. Now, in practice, my students' managers cannot precisely estimate that exact optimal debt level, D. It's not a single magic number. Instead, they establish a target capital structure or an optimal capital range, for example, aiming for 30% to 50% debt rather than a precise 41.18%. There are several practical reasons why firms' actual capital structure might differ from this target range at any given moment. Firstly, management might exploit short-term financing opportunities. If interest rates are incredibly low, they might issue more debt than planned just to lock in those rates. Makes sense, right? Secondly, the market values of debt and equity are constantly fluctuating. If a company's share price jumps high, its market value of equity increases, making its debt-to-equity ratio look lower, even if debt hasn't changed. Thirdly, transaction costs and minimum deal sizes make constant adjustment impractical. You can't just issue tiny bits of debt every day. Is it always practical for a company to hit its exact target debt level every single day? What do you think?
No, my students, it's usually not practical or even desirable to hit an exact target every day due to market fluctuations, opportunities, and transaction costs. A range makes more sense.
Right. A very important point to remember. While WACC calculations usually use market value proportions, a company's target capital structure is often expressed using book values. Why? There are a few reasons. One, market values fluctuate significantly and don't always reflect underlying borrowing capacity. A high share price might encourage equity issuance. Two, management's primary concern is often the capital invested by the company working capital, projects which aligns more with book values, historical costs. Three, lenders, debt investors, and credit rating agencies often focus more on book value measures for creditworthiness. So, managers manage to those metrics. However, managers still pay close attention to market prices to decide when and how much and what type of capital to raise. They aren't blind to the market. When it comes to estimating target weights for WACC, especially for you as analysts, there are a few practical approaches. 1. Assume the company's current market value weights represent its target. 2. Examine trends or management statements about their policy. 3. Use the average capital structures of comparable companies in the same industry as a proxy.
And here's that handy trick again, converting a debt to equity ratio, DE, into the weight of debt WD you need for WACC, weight of debt WD, 1 plus DE. And then weight of equity, we equal 1 WD. For example, if Gerhardt announces a target DE of 0.7, WD equals 0.7, 1 plus X of 1.7, 1.7, and 0.4118, or 41.12%. We equals 1 of 4, 1198 equals 1.511 T, 1.5882, or 58.82%. These would be the target weights. Does this conversion formula seem useful?
Yes, it's a very useful formula. It helps translate a common ratio into the weights needed for WACC calculations, like quickly figuring out the required run rate in cricket. This simple conversion is a very handy trick, my students. It will save you time and make your analysis smoother.
Indeed. Now, my excellent students, if a company's stock price goes up significantly, but its debt level remains the same, how might its market value debt-to-equity ratio change? Think numerator and denominator. If the stock price goes up, my students, the market value of equity, the denominator, increases. Therefore, the market value debt-to-equity ratio would decrease, assuming debt value is constant. Less debt relative to equity on a market basis. Finally, my students, let's explore 2 other very important theories that provide alternative perspectives. The pecking order theory and agency costs. These consider a very real-world issue, asymmetric information. This means management often has better internal information about the business than outside investors. Investors know this, and they watch management's actions very carefully for signals. The pecking order theory, by Myers and Mage-Luff, suggests companies have a preferred hierarchy, a pecking order, for financing new investments based on the information content or signal sent by each method. The order of preference from most preferred to least preferred is usually 1. Internal financing, using retained earnings or existing cash. First choice, least information content, no negative signals. Shows strength. 2. Private debt, borrowing from a bank or private lenders. Less information content than public debt. 3. Public debt, issuing bonds to the market, more scrutiny. 4. Equity issuance, selling new shares to the public, usually the least preferred last resort. Why is equity least preferred, my students? Because public equity offerings often raise skepticism. Existing owners are less likely to want to share ownership if prospects are strong and the stock seems undervalued. So issuing new equity can be seen as a negative signal. Maybe management thinks the stock is overvalued, or they desperately need capital. On the other hand, issuing debt often signals confidence. Committing to fixed future payments implies management believes they can generate the cash flow. Poorly performing companies usually can't afford this signal, the key implication. There is no single optimal capital structure. A firm's capital structure just reflects its historical financing needs based on this pecking order. Does this idea of sending a signal make sense?
Yes, your financial choice can definitely reveal what you truly think about your own situation or prospects. It's like nonverbal communication in finance. Think of it like this, my students. If you need money for something, say a new smartphone, first you use your own savings, right? Internal financing. If that's not enough, maybe ask close family or trusted friend. Private debt. Only as a last resort would you go publicly asking everyone, right? Because then people might wonder why you need money so badly. Your choice sends a signal.
A perfect real-world illustration. Now, let's briefly touch upon agency costs and the free cash flow hypothesis, championed by Michael Jensen. We mentioned agency costs earlier, conflicts of interest between managers, shareholders, and bondholders. Jensen's free cash flow hypothesis suggests that higher debt levels can actually serve to discipline managers. How? By forcing them to manage efficiently and use cash wisely. When a company has significant debt, it has fixed payments that must be made. This leaves less free cash for managers to potentially spend unwisely on excessive perks or non-value-adding acquisitions. The pressure of debt forces focus on profitability and cash generation. It acts like a strict financial guardian. A great example is CLP AG, a biopharmaceutical company. It was profitable and debt-free. Then, management got promising, confidential clinical trial results, asymmetric information. Before the public announcement, the company strategically increased its credit line with a bank, a signal. Later, the positive announcement was made. Shares rose 35%. The credit line increase signaled management's confidence and need for future funds to scale up production. Why would management increase a credit line before a big announcement like that?
They likely did it, my students, to signal their confidence in the future success and to prepare for the increased funding needs that success would bring. It was a positive signal. It's like having a strict budget for your household. Knowing you have those fixed EMI payments forces you to be very careful with other expenses, doesn't it? You prioritize, you cut back, you become disciplined. Debt, in this sense, can sometimes be a very good disciplinarian for management.
Absolutely. So, my excellent students, which financing method is at the very bottom of the pecking order and why? Which sends the most potentially negative signal? Equity issuance, my students, is at the bottom of the pecking order. It's least preferred because it can be seen as a negative signal by investors, implying management thinks the stock is overvalued or the company desperately needs capital.
Wow, my students, what a truly enlightening deep dive we've had into capital structure today. We've covered a lot of important ground, from the very basic WACC calculation to the fascinating theories of Modigliani-Miller and the practical realities of the pecking order.
Indeed, we have. To briefly recap, my students, please remember these key takeaways. We started by understanding WACC, its components, the after-tax cost of debt, lower due to priority taxes, and the higher cost of equity, residual claim. We explored factors affecting capital structure, business models, capital-intensive light, corporate life cycle, startup growth mature, and issuer-specific risks, sales, operating financial leverage. We delved into Modigliani-Miller. Without taxes, capital structure is irrelevant, VLVU. WACC is constant due to rising equity costs offsetting cheaper debt. But with taxes, showed debt adds value, VLVU plus TD, via the tax shield, decreasing WACC. Then we added costs of financial distress, which limit debt use, leading to the static trade-off theory and an optimal capital structure. D, balancing tax shields and distress costs. Finally, we discussed practical target capital structures, often book value ranges, and the pecking order theory, internal funds first, equity last due to signaling asymmetric info, and how debt can discipline managers, free cash flow hypothesis.
Remember, my dear students, finance isn't just about numbers. It's about understanding the logic, the decisions, and the trade-offs companies face. This knowledge of capital structure is absolutely fundamental for your CFA journey and beyond. Keep practicing those WACC calculations.
And as you continue your learning journey, here's a final provocative thought. We've seen how taxes make debt advantageous and how debt can discipline managers. But consider this. If a company is highly disciplined and debt-laden, perhaps too focused on making payments, what might be the non-financial benefits or drawbacks? What about its long-term innovation, its ability to take strategic risks, or its flexibility to adapt? Something important to ponder.
Thank you for joining us on this very insightful deep dive. Keep learning, keep questioning, and we'll see you next time.
All the very best, my students. Keep up the good work. Hello, everyone, and a very warm welcome back to the Deep Dive. I'm James.
And I'm Jennifer.
We are so happy you've joined us today. This is where we take those, well, sometimes big and complex ideas from finance.
Yes.
And we try our best to break them down into, easy to understand parts.
Absolutely, making it simple.
Today, we're going on what feels like a really foundational journey, especially for those of you who are just starting to explore finance.
Maybe thinking about that CFA certificate.
Exactly. So today, we are going to do a deep dive into something called business models.
Ah, business models. Sounds technical, maybe.
It might sound like a big fancy term, I know, but trust me, by the end of our chat today, you'll start seeing business models, well, everywhere.
That's so true. In every shop, every service, every single company around you.
Definitely.
Think of a business model as the blueprint, or perhaps the secret recipe for how a company really works.
A secret recipe, I like that.
Yes. It's much more than just what the company sells, you see. It explains its entire strategy.
Strategy, okay.
How it operates day to day, who its customers really are, who its important suppliers or partners might be, and, most importantly, how it actually manages to earn money. And also, what kind of challenges it might face down the road.
Right, the challenges too.
Understanding this, it's truly like gaining a superpower.
Yeah.
It gives you this deep insight into why a company's doing well.
Or maybe not so well.
Or, yes, exactly, why it might be struggling.
That makes sense. Let's take a very simple example, something from our everyday lives here in India.
Okay.
Imagine your local kirana shop. That small neighborhood store where you buy your daily things.
Ah, yes, the corner shop. Everyone knows one.
How does that shop actually operate? Who usually buys from it? Your family, your neighbors.
The local community, probably.
And what kind of products does it sell? Is it just, packaged groceries? Or does it also offer snacks, maybe some fresh vegetables?
Sometimes they have a bit of everything, don't they?
They do. And how does the shopkeeper get all those goods? From wholesalers,
Okay.
distributors. The supply side.
And how does he decide the price for, let's say, a packet of biscuits or a kilo of rice?
Good question. Market prices. His costs.
Exactly. All these simple questions, when you answer them carefully, they actually describe the Kirana shop's entire business model.
It's all there, even in the simplest business.
So today, we'll give you a clear framework, a way to understand even the most complex businesses.
From a humble roadside chaiwala
The tea seller.
to a giant global technology company, the principles are the same.
Right. So let's begin with the basics then. What exactly is a business model?
Good place to start.
At its very core, it's simply a description of how a business plans to create value, deliver that value to customers, and then capture some of that value back, usually as profit.
Create, deliver, capture.
It's not just about having a brilliant product or a fantastic service. That's important, of course, but it's only one piece.
So it's bigger than the product itself. Much bigger. It's about the entire system built around that product. It explains how that product or service reaches the right people,
The customers.
how its price is decided, and how the company is structured internally, how it's organized
Operations.
to make it all happen smoothly. This whole picture helps us understand the company's big strategy, its daily work, who its specific target customers are, who its critical partners are, and even the potential opportunities and risks it might face in the future.
Opportunities and risks, yes. Very important for analysis.
Think of it like a cricket team getting ready for a big match.
Okay, cricket analogy. I like it.
The team's business model for the match would include their core strategy, right? Who are their key batsmen? They're like the target customers they want to score runs from.
Huh. Makes sense. Your key run getters.
What kind of shots do these batsmen specialize in? Quick singles, big sixes. That's like their unique products or services.
Their special skills.
Where do they prefer to play? On the front foot, back foot. That's like their channels, how they reach the ball, or how the business reaches customers.
Their method of attack.
And how do they plan to score those runs? Building partnerships, taking risks. That's like their pricing strategy, how they plan to make money.
How they win the game or make profit.
Exactly. And just like a cricket analyst needs to understand this deep strategy, not just listen to what the captain says in the interview.
You need to see the real plan.
A financial analyst needs to understand a company's business model properly, to truly assess its performance and its future potential.
That's a wonderful analogy. Very clear. And, to really get a solid handle on this, a well-described business model should basically answer 4 key questions about any business.
4 key questions. Okay.
We often call these the 4 core pillars of a business model. Makes it
Yeah.
easier to remember.
Pillars. Good. What are they?
First, we have the customers. This answers the who. Simply put, who is this business trying to serve? Who are they aiming to reach?
The who. Seems obvious, but maybe not always simple.
Exactly. It sounds basic, but truly understanding your customer, deeply understanding them, is the starting point for everything else. Because if you don't know who you're serving, how can you create value for them effectively?
Good point. Can't hit the target if you don't know where it is.
Precisely. Second pillar, product service offerings. This covers the what and, very importantly, the why.
What and why? Okay.
What exactly is this business selling? A physical thing, a service, a mix, and crucially, why do customers choose this specific offering over all the other choices out there? What unique need does it fill for them? What problem does it solve?
The why seems really important there.
It is. It gets to the core value. Third, we look at channels. This is the where.
Where, like location.
Sort of, but broader. It describes how the business actually gets its products or services to its customers. How do they make the sale?
How it reaches them.
Yes. Does it sell from a physical shop? Through an online website? Maybe through partner businesses? It's about the entire journey the customer takes to buy and receive the offering.
Okay, the delivery path.
And finally, the fourth pillar is pricing. This answers the how much.
How much? The money part.
The money part, yes. How does the business charge for what it offers? How does it set those prices? And how do those prices compare to its own costs and what competitors are charging?
So who, what, why, where, and how much, the 4 pillars.
Exactly. Now, beyond these 4 fundamental pillars, there are 2 other really critical concepts that are woven into understanding a business model. They often sit within these pillars, but they deserve special mention.
Okay, what are those?
One is the firm's value proposition. This refers to the specific qualities, the benefits, or the problem solved by a product or service that make customers choose it over the competition.
The unique selling point.
Precisely. It's the unique promise a business makes. It's that special something that makes their offering stand out.
Got it. The value proposition. And the second one?
The second one is the value chain. This is about how the firm organizes all its internal systems and processes.
Internal workings.
Yes. Everything from getting raw materials to making the product, delivering it, and even providing service afterwards. It's all the steps inside the company that add value along the way.
Okay, so value proposition is the promise, and value chain is how they deliver that promise internally.
Very well put. And don't worry, we will explore both of these in much more detail a bit later on.
Good.
So, my dear listeners, here's a simple question to get us started, just to check our understanding, okay? Let's go back to our roadside chaiwala, the tea seller.
Okay, the chai example.
Can you try to identify these 4 parts for their simple business? Who are their customers? What do they sell besides tea? Where do they sell it? And how do they price their cup of chai?
Good exercise.
Just take a moment to think about that simple example.
Excellent. That was a great way to apply the basics. Now, let's take a proper deep dive into each of these 4 key parts, because there's actually quite a bit more detail in each one.
Yes, let's unpack them.
We'll start with the who, the customers. A really strong business model, it always begins by clearly identifying its target customers. It's not usually everyone.
No, rarely everyone. You need focus.
Exactly. Are there specific groups or what we call segments of customers that the business serves?
Segmentation, yes, very important.
And we can categorize or segment customers in many, many ways. For example, by their geography, right?
Location.
Are they customers in Mumbai versus Delhi? Or even more specific, like customers in a busy market area versus those in a quiet residential colony. The needs might be different.
Very different, yes.
We also look at demographics. These are, statistical things like age, income level, family size, education,
A
jobs.
standard classification.
Then there's behavior. This is about how customers act. How often do they buy? What specific things do they buy? How loyal are they to one brand? How do they like to interact online, in person?
Their buying habits.
We also consider their preferences. What do they like? What do they value? Maybe their affinity for technology. Are they quick to adopt new gadgets, or do they prefer traditional ways?
Tech savvy or not, yes.
Or even their self-image? What kind of person do they see themselves as or want to be? Sometimes products appeal to that aspiration.
The lifestyle angle.
Another really crucial distinction here is whether the customers are other businesses,
Okay.
which we call a business-to-business or B2B model, like a company making parts for car manufacturers.
Right, selling to other companies.
Or are the customers individual consumers, like you and me buying groceries? That's the business-to-consumer or B2C model.
B2C, like most shops we visit.
Understanding this B2B or B2C difference is fundamental. It changes everything: how you market, how you sell, how you provide support.
Absolutely. The approach is completely different. For instance, think about Tesla. When they first started, their target was very, very specific, wasn't it?
Yes, very niche.
They aimed for affluent early adopters of technology. People with money who loved new tech, could afford those expensive electric sports cars, and probably had a garage to charge it in.
A very small group initially.
Very small. But over time, as their technology got better and they could produce cars more cheaply, their target shifted, didn't it?
It did, towards a broader market.
Exactly, to a more mass market with lower cost models like the Model 3. And, modern companies, they use so much data now.
Data analytics.
Yes, advanced analytics lets them find these specific customer groups down to tiny details, maybe even by postal code. And then they use targeted digital advertising to reach just those people very efficiently.
Very precise marketing.
Let's use an Indian example to really make this customer segmentation clear. Imagine a tailor shop in your neighborhood.
Okay, a local tailor.
One specific segment of their customers might be families getting ready for a big wedding.
Wedding season. Big business.
Huge business. These customers usually have higher budgets, very specific design ideas. They want unique, maybe luxurious fabrics, lots of handwork.
High value, high effort.
And they probably need longer consultations, multiple fittings. Now, another segment could be office goers.
Daily wear alterations.
Exactly. People who need regular alterations for their suits, or maybe simple, well-fitting daily wear like shirts and trousers. What do they prioritize?
Probably speed, affordability, consistency.
Precisely. Speed, affordability, consistent quality for everyday use. The tailor would likely treat these two segments very differently, wouldn't they?
Definitely. Different needs, different service.
Maybe dedicated staff for wedding orders, perhaps a quicker turnaround system for the office alterations. That's segmentation in action.
Makes sense.
So everyone, a simple question for you now. If you were thinking of setting up a small bakery right here in your town,
Fresh cakes.
who would be your primary target customers? Would it be families wanting birthday cakes, students grabbing cheap snacks after college, office workers needing breakfast items, or maybe people looking for those very special custom-designed cakes for big occasions?
Lots of possibilities.
And how might you segment them further, based on what they need or what they like? Give that some thought.
Very good. Thinking about the customer first. Now, let's move on to our second pillar. This is the product or service offering. We called it the what and the why.
Yes, what are you actually selling?
A strong business model has to clearly define what product or service the firm provides. And just as importantly, it needs to explain how that offering is truly different from what competitors are doing.
Ah, the differentiation part.
Exactly. Differentiation. What makes your offering unique? What makes it stand out and appeal to those target customers we just talked about?
Why choose yours?
Precisely. We also ask why customers buy it. What underlying job, what task or problem does the product or service help them accomplish?
The job to be done. Yes, that's a key concept.
Understanding this job is absolutely critical because it helps you see the real need you're filling and who your real competitors are.
Competitors might not be obvious.
Sometimes not. For example, think about a heavy-duty truck versus a long-distance goods train.
Okay, very different vehicles.
On the surface, yes, but they both fulfill the same fundamental customer job, don't they? Transporting large quantities of goods from A to B.
Ah, I see. The job is moving goods.
So, by understanding the why the job, the truck company realizes that the railway is also a competitor, maybe even sea freight or air cargo, not just other truck companies. It broadens your view.
That's a great point. It defines the true competitive landscape. And in any market, there's always a risk
Right.
of imitation.
Imitation. Competitors copying you.
Yes, exactly. Competitors just copy your product or service, making it hard for you to stay unique. And another risk is substitution.
Substitution. Finding an alternative.
Yes. Customers find an entirely different, maybe unexpected way to solve their problem, making your product irrelevant. A classic example of a company evolving its business model dramatically to handle these risks is Netflix.
Ah, Netflix. Everyone knows them.
Right? They started way back in 1997, remember, as a DVD rental by mail service.
Yeah, sending DVDs in red envelopes.
That itself was a challenge to the big rental stores like Blockbuster. Then Netflix innovated again. They introduced a monthly subscription model for DVDs. Flat fee, keep them as long as you want.
That was revolutionary then. No more late fees.
Completely disrupted the paper rental industry. But they didn't stop there, did they?
No, they transformed again.
They saw the future was online. They shifted to a subscription-based online streaming video platform, invested massively in content, in technology.
And that was the end for Blockbuster, pretty much.
Sadly, yes. Netflix kept innovating, kept anticipating the evolving job of how people wanted entertainment delivered. Blockbuster couldn't keep up.
Shows the power of adapting the business model.
Let's use a common Indian example for this job-to-be-done concept. Why do people buy a geyser, a water heater, for their bathroom?
For hot water, obviously. Especially in winter.
Yes, but is it just for hot water? Think deeper. The job it performs is providing a comfortable, hassle-free bath.
Ah, comfort and convenience.
Exactly. It solves the job of quickly getting warm water without the trouble of heating it manually on a stove, which takes time and effort. Similarly, why do people buy an air conditioner?
To cool the room, escape the summer heat.
Beyond just cooling the air, it fulfills the job of providing comfort, allowing for good sleep on hot nights, creating a productive environment when it's scorching outside. The fundamental need, the job, is comfort and relief.
Not just the technical function.
Got it.
So for you, our attentive listeners, think about a common product you use every single day, like your smartphone.
Use it all the time.
What job does it really do for you? Beyond just making phone calls or sending messages, think about all the things you use it for. And how has that job changed over time since mobile phones first appeared? That's a good one. It does so much more now.
It certainly does.
Excellent point. Understanding the job is key. Now let's move to our third pillar. Channels, or the where.
Right. How does the product reach the customer?
Exactly. This describes how a firm actually sells its products or services and gets them into the hands or onto the screens of its customers. It involves the whole channel strategy.
Strategy for reaching them.
Yes, which usually includes things like sales activities, marketing efforts, and the physical distribution or logistics of getting the product there. And businesses always have choices here.
Choices like.
Well, they decide whether to do all these things themselves, in-house with their own teams and resources,
Okay, handle it all internally.
or whether to use strategic partners like distributors, retailers, or agents. For instance, some companies selling complex software don't install it themselves. The customer hires a separate consulting firm for that.
Ah, so they partner for certain functions.
Traditionally, a common channel strategy involved a chain of intermediaries. Like this. Manufacturer sells to a wholesaler,
Who buys in bulk?
who then sells to a retailer,
Like our Kirana shop or a department store.
who finally sells to the end customer. A multi-step process.
The classic distribution chain.
However, many companies today, especially with the internet, use a direct sales strategy. They sell straight to the end customer, cutting out the middlemen.
Going direct, like online brands often do.
Yes, this is quite common for complex products, high-value items, or things that need a lot of explanation. Think about specialized medical devices or luxury goods. And Tesla is a prime example again.
Selling cars online and in their own stores.
Exactly. They use a direct sales strategy mainly through their website and their own limited number of retail showrooms. This is very different from traditional car companies, especially in the US, who rely on thousands of independent franchise dealers.
What's the trade-off there?
Well, direct sales give Tesla a much closer relationship with customers, more control over the brand experience. But it also means they have to bear all the significant fixed costs of building and running that sales infrastructure themselves. Showrooms, service centers, that's expensive.
Control versus cost and reach.
Precisely.
And building on that, many firms today are using what's called an omni-channel strategy.
Omnichannel, meaning?
Meaning they try to blend both digital, online, and physical offline brick-and-mortar channels seamlessly. The goal is a unified, consistent customer experience no matter how the customer interacts.
So online and offline work together.
Exactly. A great example is Adidas. They sell their shoes and apparel through their own retail stores, through franchise stores, through wholesale partners like large sports shops, and very importantly, through their own e-commerce website.
Multiple channels working in sync.
And that website, they say, is their single biggest store in the world now. An omni-channel approach means you might say, browse shoes in their physical store,
Try them on.
but then order your size online later for home delivery. Or maybe you order online and choose to pick it up from a nearby store. Or return an online purchase at a physical shop. It should all feel connected.
Seamless experience. That sounds ideal for the customer.
Is when done well.
Yeah.
Let's think about an indie example for channels. Consider a company selling Mithai, Indian sweets.
Okay, sweet shops.
They might have a direct sales channel, selling straight from their own famous sweet shop, right?
Yes, like the well-known local ones.
Or they might use an indirect channel. They package their sweets and sell them through other small Kirana shops, or maybe even large supermarkets.
Reaching more places that way.
Definitely wider reach. And nowadays, many also use online food delivery apps like Zomato or Swiggy, don't they?
Oh yes, very common now. Order sweets online.
That's another crucial digital channel for them. Each channel choice has its own pros, like reach and cons, maybe lower profit margins through intermediaries, or less control over how the product is presented.
Trade-offs again.
Always trade-offs. So for you, our aspiring entrepreneurs listening in, if you are passionate about selling, say, beautiful handcrafted jewelry that you make yourself,
Ooh, creative.
what different channels could you possibly use to reach your potential customers? Maybe an online shop like Etsy or your own website, selling at local craft fairs or markets, partnering with fashion boutiques.
Many options.
And what do you think would be the pros and cons, the advantages and disadvantages of each of these methods for your small jewelry business? Think about cost, reach, brand image.
Good practical question.
It helps to think through the options.
Fascinating insights on channels. So finally, let's delve into our fourth pillar, pricing, or the how much.
Yes, the money question.
A complete business model must clearly explain how prices for its products or services are set. How do they compare to competitors? And crucially, how do they relate to the company's own costs?
Price, competitors' costs, the key factors.
Now, in markets where you have lots and lots of competitors selling very similar products, almost identical.
Like basic commodities?
Exactly. Companies in those markets are often price takers. They don't really set the price. They just have to accept the going market rate. Think of plain vegetables in a big sabzi mandi.
The vegetable market, yes. Price for potatoes is pretty much set by the market that day.
One seller can't suddenly charge double, they just take the market price. However, companies that have very few competitors or offer highly differentiated, unique products.
Like the handmade bicycle company we might discuss later.
Precisely. Those companies often have pricing power. This means they can set prices significantly above their costs without losing too many customers. Why? Because their product is seen as uniquely valuable, special, or maybe there are no close alternatives. Think of a one-of-a-kind painting by a famous artist.
Scarce and unique, so high price as possible.
Right. Now, companies that find themselves as price takers, those in highly competitive markets with similar products, they often pursue a cost leadership strategy.
Cost leadership, meaning lowest cost.
Yes. Their main goal is to be the most efficient, lowest-cost producer in their industry. This allows them to sell at the competitive market price, or even slightly below, and still make a small profit margin, while higher-cost competitors might struggle.
Survive by being efficient.
Exactly. And remember Tesla. We said they sell premium-priced cars?
Yes, expensive initially.
But their business model also emphasizes a lower total cost of ownership over the car's life. They highlight factors like government subsidies for electric vehicles and the much cheaper cost of electricity compared to petrol.
So the long-term cost is lower, they argue.
Yes. So that initial high purchase price is justified not just by the brand, the cool design, and the performance, but also by these potential long-term savings for the customer.
Interesting framing of the price. Now, this is where it gets really interesting, I think. Let's explore some of the different ways companies actually apply pricing strategies. There are so many variations.
Okay, different pricing tactics. Let's hear them.
First, there's price discrimination. Sounds a bit negative, maybe.
A little bit, yes.
But it simply means charging different prices to different customers for the same or very similar product. The basis is usually their willingness or ability to pay. The goal is to maximize profit from each customer segment.
Charging different folks different amounts.
Okay, a common form of this is tiered pricing. You see this everywhere. Different prices are offered based on the volume purchased or the features included. Think about mobile data plans.
Ah, yes. 1 GB plan, 5 GB plan, unlimited plan, all different prices.
Exactly. You pay different prices for different amounts of data, and often the price per gigabyte goes down as you buy a bigger package. That's tiered pricing.
Got it.
Then there's dynamic pricing. This is where prices are not fixed at all. They change constantly, sometimes minute by minute.
Changing prices. How?
Usually based on real-time supply and demand. The most familiar example here in India is probably Uber or Ola surge pricing, right?
Oh, yes. When it rains heavily or during peak office hours, suddenly the price doubles or triples.
Exactly. Demand for rides shoots up, fewer cabs are available, so the price automatically increases. Hotels do this too. Prices for rooms in popular tourist spots shoot up dramatically during Diwali holidays or the peak season. That's dynamic pricing based on demand.
Market forces setting the price instantly.
Pretty much. Another approach is value-based pricing. Here, the price isn't set based on the cost to make the product, but primarily on the perceived value the customer gets from it.
Value to the customer. How do you measure that?
It can be tricky, but think of this. A groundbreaking new medicine that prevents a patient from needing a very expensive long hospital stay.
Okay. Saves a lot of money and hardship.
Exactly. The pharmaceutical company might price that medicine to reflect a portion of those huge savings and the immense value of better health, even if the pill itself is cheap to manufacture. The price reflects the value delivered, not the cost.
I see. Pricing based on the outcome or benefit?
And then we also see auction and reverse auction models. Prices get set through bidding.
Like bidding online.
Yes. In a regular auction, buyers bid the price up. In a reverse auction, sellers bid the price down, competing for the business. This is common in online advertising companies, bid for ad slots, or when large companies get quotes from suppliers.
Letting the market decide through bids.
Correct.
That's quite a few already. What else?
Oh, there are more. Let's think about products or services that have multiple parts or are used over time. Bundling is very common.
Bundling. Putting things together.
Yes. Combining several different products or services and selling them as a package, usually at a discounted price compared to buying each item separately. Think about your home internet provider.
Ah, yes. They offer packages with internet, maybe cable TV, maybe a phone line.
Exactly. That triple play bundle is often cheaper than getting each service individually. It encourages you to buy more from them.
Makes sense. Lock the customer in.
A really fascinating one, and sometimes controversial, is razor blade pricing.
Razor blade. Like shaving.
Precisely the origin. In this model, the initial durable good, the razor, is sold very cheaply, maybe even below cost.
Sell the main product cheap. Why?
Because the real profit comes from the high margin,
consumable items, the razor blades that customers must buy repeatedly to use the main product.
Ah, like the razor handle is cheap, but the replacement blades are expensive.
Exactly. Or think about some water filters. The filter unit itself might be affordable.
But the replacement cartridges cost a lot.
Yes, or printers.
Hmm.
The printer might seem like a bargain.
Until you have to buy the expensive ink cartridges, and often only their brand works.
Precisely. That's the razor blade model.
Hmm.
Very clever, often very profitable.
Clever indeed. Okay, what's next?
Then there's add-on pricing. Here, the basic product might be reasonably priced, but you pay extra for additional optional services or features.
Extras and upgrades.
Yes. Think about mobile games. The game itself might be free.
But you pay for extra lives, special items, cooler characters.
Exactly. Those are add-ons. Or budget airlines. The basic flight ticket is cheap, right?
Very cheap sometimes.
But then you pay extra for checked baggage, choosing your seat, having a meal on board, all add-ons.
Ah, the hidden extras that add up.
They certainly can. Now, if a company is new and wants to grab market share quickly, they might use penetration pricing.
Penetration, like breaking into the market.
Yes, setting a deliberately low initial price for their product or service. The goal isn't immediate profit, but to attract a large number of customers fast, build a user base, and maybe discourage competitors.
Get lots of users first, worry about profit later.
Sometimes that's the strategy. You might see a new mobile phone brand launching in India with very aggressive discounts on their first models just to get people to try them and switch from established players.
I've seen that happen. Low introductory prices.
And in the digital world, freemium is incredibly popular. You hear this term a lot.
Freemium. Free plus premium.
Exactly. The basic version of a product or service is offered completely free. It might have ads or limited features or usage caps.
Okay, free to get started.
But then users have the option to pay a recurring fee, a subscription, to upgrade to a premium version.
What does premium get you?
Usually more features, no ads, unlimited usage, better support, things like that. Many mobile apps work this way, right?
Yes, lots of apps have a free version and a paid pro version.
Online games, news websites too, read a few articles free, then pay for full access. That's freemium.
A very common model online.
Closely related is hidden revenue. Here, the service might be genuinely free for the primary users.
Completely free. How do they make money?
They generate revenue from other sources, often behind the scenes. The classic example is social media platforms like Facebook or Instagram.
Free for us to use.
But they make billions from selling advertising space to businesses who want to reach all those users. The users are the product, in a way. Or think of online marketplaces. Maybe buyers use it for free, but sellers pay a commission on each sale. The revenue is hidden from one side of the market.
Ah, someone else pays. I see.
And finally, subscription models. These have just exploded everywhere.
Seems like everything is a subscription now.
It does feel that way. This involves delivering products or services for a recurring fee, usually monthly or annually. It provides predictable income for the company.
Like Netflix, Amazon Prime.
Yes, streaming services, software like Microsoft Office 365, music streaming, even things like your monthly electricity bill often include fixed subscription-like charges alongside the amount you actually used.
True, the fixed charges.
Also linked to recurring fees are things like leasing, licensing, and franchising. Leasing is like long-term rental, maybe leasing a car for 3 years instead of buying it, you pay monthly.
Okay.
Licensing is when one company pays another a fee, called a royalty, to use its brand name, or a character, or a technology. Like a t-shirt company paying Disney to put Mickey Mouse on their shirts.
Paying for the rights.
And franchising, which we touched on earlier, it's a very common model. A local business owner, the franchisee, pays fees to the main brand owner, the franchisor, to operate a business using their brand, their system, their recipes.
Like the McDonald's example. Or maybe a local outlet of a big coffee chain.
Exactly. They pay fees for the brand and the proven system.
Wow, that's a lot of different ways to think about pricing.
It really is a fascinating and creative area of business strategy.
So my smart listeners, think about your own mobile phone plan again. Do you notice any examples of bundling in your plan? Maybe talk time, data, and SMS messages packaged together? Or perhaps tiered pricing, different costs for different amounts of data. Can you explain how those strategies are being used for your mobile service?
Good question to connect it back.
Okay, that was a thorough look at pricing. Now let's explore the fifth crucial aspect we mentioned. The how is the firm actually structured and organized to deliver on its promises, its value proposition?
Right, the internal machinery.
Exactly. This involves looking at its resources, Its people, labor, and its equipment.
Yeah.
Capital. It also involves its relationships with vital partners and suppliers, and its intellectual property, things like patents, unique designs, secret formulas.
All the pieces needed to make it work.
And a company's ability to operate well often depends heavily on other companies for critical inputs.
Dependencies. Yes, that can be a risk.
Definitely. These supplier relationships are key parts of the strategy, but they can also be a significant source of vulnerability if something goes wrong with a key supplier.
Like the sweet shop relying on the milk supplier we talked about.
Precisely. Let's consider Netflix again. We know they stream movies and shows.
Yes.
They rely heavily on internet service providers, right, like your broadband company at home, to actually get the stream to your screen.
True, they need the internet pipes.
But even more critically, behind the scenes, they depend massively on digital infrastructure companies. The biggest one is Amazon Web Services, AWS.
Amazon's cloud business. Netflix uses them.
Heavily to store their huge library of content and deliver it smoothly all over the world. Now, what's really fascinating and a bit risky
What's that?
is that Amazon, through its own streaming service, Prime Video, is also a major competitor to Netflix.
Wow. So Netflix relies on its competitors' infrastructure.
Yes. Netflix themselves point this out as a risk in their annual reports. If AWS had a major problem or changed its terms, it could seriously hurt Netflix. It's a very complex relationship.
That is fascinating. A real frenemy situation.
Exactly. Now think about the traditional car industry. It relies on this incredibly vast network of external companies making all the different parts, engines, tires, seats, electronics, thousands of suppliers.
A huge supply chain.
But Tesla, again, takes a different path. Their business model emphasizes vertical integration.
Vertical integration, meaning they do more themselves?
Yes. They develop and produce a lot of their key components like batteries, electric motors, even a lot of the car's software in-house, inside Tesla, rather than just buying everything from outside suppliers.
Why do that? Seems like more work, more investment.
It definitely requires huge capital investment and effort. But the advantage is it gives Tesla much greater control over its own technology, its quality, and its supply chain. They aren't as dependent on others for the really critical innovative parts.
Control over the core technology. Makes sense for them.
Let's bring it back to India with an example for supplier dependency. Remember the popular sweet shop preparing for Diwali?
Yes. Needing milk, sugar, ghee.
They depend so heavily on reliable suppliers for these essential ingredients. Now imagine if their main milk supplier suddenly has a problem, maybe a strike by transport workers or a sudden disease affecting cows.
Oh dear. No milk, no mithai.
Exactly. The whole production of their sweets could be severely affected, right, during their busiest season. So they need to manage these supplier relationships very, very carefully. Maybe have backup suppliers, negotiate long-term contracts.
Plan for disruptions. Very important.
So for all of you thinking like analysts now, consider a shoe manufacturing company. What kind of key suppliers do you think it relies on?
Leather, maybe. Rubber for the soles.
Right.
Laces. Glue.
Good examples. And what kinds of risks could arise for that shoe company if one of those critical suppliers, say the only supplier of a special kind of waterproof leather, suddenly faces problems, like a fire in their factory or they go bankrupt?
The shoe company might not be able to make certain types of shoes. Big problem.
Exactly. It highlights the importance of managing supplier risk.
That's an excellent way to think about dependencies and risk. Now, here's something that often causes confusion, so let's take a moment to clarify it properly. It's the difference between a value chain and a supply chain.
Yes. These terms sound similar.
They do, and people often use them interchangeably, but for an analyst, understanding the difference is quite important.
Okay, let's get this clear. What is a value chain?
A firm's value chain refers specifically to the activities and processes within that single firm that create value for its customers. It's an internal view.
Inside the company. Yeah.
It includes what Michael Porter called primary activities. Things like inbound logistics, how the company receives and stores materials, operations, how it transforms those materials into the finished product, outbound logistics, how it delivers the product, marketing and sales, how it promotes and sells, and service after-sales support.
The core activities of the business.
Yes, and it also includes support activities that enable these primary ones, things like human resource management, hiring, training, technology development, R&D, IT systems, and procurement, the process of buying the inputs. So the value chain is all about how that specific company internally organizes itself to add value at each step.
Okay, internal sequence of value-adding activities. Got it.
Yeah.
So how is the supply chain different?
The supply chain is a much broader concept. It refers to the entire sequence of processes involved in producing and delivering a product or service all the way to the end customer.
The entire sequence, from start to finish.
Yes. And here's the key difference. It doesn't matter whether those steps are performed by one single firm or by multiple different firms. The supply chain includes all the external partners and steps as well.
Ah, so it includes suppliers, distributors, everyone involved.
Exactly. From the very first raw material supplier, maybe the farmer growing cotton, through various manufacturers, maybe transporters, distributors, retailers, all the way until the final product reaches the customer's hands. It's the flow of goods and information across multiple companies.
Okay, so value chain is internal to one firm. Supply chain is the whole network from raw material to end customer.
Precisely. Let's use an Indian example to make this really clear. Imagine that small business we talked about, making beautiful handmade leather bags.
Okay, the bag maker.
The supply chain for this business involves getting the raw leather, maybe from a tannery in Kanpur, getting the buckles and zippers from a supplier in Delhi, getting special threads from a manufacturer in Ludhiana. All these external companies are part of the supply chain feeding into the bag maker.
Right, the inputs from outside.
Now, the value chain is what happens inside the bag maker's own workshop, say in Mumbai. The skilled artisans, cutting the leather carefully, stitching it together, adding the buckles and zippers, polishing the final bag, maybe packaging it nicely, and then selling it directly to customers from their little shop.
The steps they take themselves to create the bag.
Exactly. Those internal processes where they add the value, the design, the craftsmanship, the finishing. So the supply chain is broad, involving many external players. The value chain focuses on the internal value-adding activities of that one specific firm.
That makes the distinction much clearer. Thank you.
Good. So everyone, a quick check for understanding on this. If you order a brand new smartphone online,
Okay.
which part of that whole process is the supply chain? Think about getting the phone from the factory in maybe China or Vietnam through customs to a warehouse, then shipped to your house.
That sounds like the supply chain, multiple steps, multiple locations, maybe multiple companies involved.
Exactly. And which part is the value chain of the online retailer you bought it from? What do they do internally?
Maybe managing their website, processing my order, handling the payment, maybe their customer service, if I have a question.
Perfect. That's their internal value chain. The activities they perform to facilitate the sale and add value for you.
Got it. Value chain, internal, supply chain, external network.
You've got it.
Excellent distinction. Now, ultimately, for any business, no matter what it does, its business model must clearly explain how it expects to make a profit.
Yes, the bottom line.
It needs to show how its prices, combined with the volume of sales it achieves, will not only cover but actually exceed all its costs, both the variable costs
Costs that change with output, like material.
and the fixed costs.
Costs that stay the same regardless of output, like rent.
Right. And it needs to show this profitability not just for today, but how it expects to remain profitable or become even more profitable in the future, especially as the business grows.
Sustainability and scalability of profits.
Exactly. As analysts, we look closely at key financial metrics here. Things like margins. What percentage of the selling price is actually profit? We look at break-even points. How much do they need to sell just to cover all their costs before they start making any profit?
Knowing when you get out of the red and into the black.
Precisely. And we also analyze unit economics. This means looking at revenues and costs expressed on a per-unit basis, like per customer acquired or per item sold or per subscriber.
Profitability at the individual transaction level.
Yes, it helps understand the fundamental health of the business model. For instance, let's go back to Amazon Web Services, AWS, Amazon's cloud computing arm.
The hugely profitable part of Amazon.
Hugely profitable. Its business model relies on a really powerful principle. Its unit costs the cost to provide 1 unit of computing power or storage fall dramatically as its overall volume grows bigger and bigger and as the technology keeps improving.
Economies of scale.
Massive economies of scale. This creates what they call a virtuous cycle. Lower costs allow them to offer lower prices to customers,
Which attracts more customers.
which increases their volume even further.
Which lowers their unit costs again.
Exactly. It's a cycle that feeds itself. This means their profits can keep growing even if they lower prices. And it creates a huge barrier for any new competitor trying to enter because the newcomer just doesn't have that massive scale and low-cost structure.
A very strong competitive advantage built on scale.
Definitely.
Let's take a simpler, more relatable Indian example for unit economics.
Think of that small juice shop again.
Okay, selling fresh juice.
To understand if they are really making money, the owner needs to calculate the unit cost of making just one single glass of, say, fresh orange juice.
What goes into that cost?
Well, the cost of the oranges needed for one glass, a tiny bit of electricity for the mixer, the cost of the disposable glass or cup, and importantly, a small fraction of the shop's daily rent and a fraction of the employee's salary allocated to making that one glass.
Okay, all costs associated with that single glass. Yes. Then they compare this total unit cost to the unit price they sell that glass for. The difference is their profit per glass. That's their unit economics.
Profit on one glass?
Now, if they sell more glasses throughout the day, their overall profit grows. And importantly, it often grows more than linearly because fixed costs like the shop rent are now spread over many more units. Each additional glass sold becomes more profitable.
Because the rent cost per glass goes down as you sell more.
Precisely. Understanding this helps the owner know how many glasses they need to sell each day just to break even and how much profit they make on each extra glass after that.
Very practical application.
So, my future entrepreneurs listening in, why do you think it's so incredibly important for a small business owner, maybe someone selling homemade pickles from their kitchen or beautiful handicrafts online, to really understand their unit economics? Why is knowing the precise cost and profit for one single jar of pickle or one single handicraft item so crucial for their success and survival in the long run?
Makes you think about pricing and costs very carefully.
Absolutely. Unit economics is foundational. Now, moving on. Many of the business models we encounter every day are actually quite common. They've existed maybe in slightly different forms for a very long time.
Nothing radically new, perhaps.
Not always radically new in concept.
Yeah.
These are what we call conventional business models. They really form the backbone of most industries and businesses we see. For companies using these conventional models, success often comes not from inventing a completely new way of doing business,
But from?
but from doing it better than others. Superior execution, maybe building a very strong, trusted brand name, or simply operating on a very large scale efficiently.
Doing the basics really well.
Exactly. Some common types are easy to recognize. A natural resource producer, like an oil company or a mining company. A manufacturer making cars, clothes, electronics. A distributor, the middleman, like a wholesaler supplying goods to lots of shops. A retailer selling directly to us, like a grocery store or a clothing shop. A broker, connecting buyers and sellers and taking a commission, like a real estate agent or a stockbroker. A bank taking deposits, giving loans. A service producer offering skills or advice, like an IT consultant or a lawyer. And of course, a software company.
Standard business types we see everywhere.
Yes, and beyond these broad categories, there are many interesting variations even within these conventional models.
Variations. Like what?
For instance, private label or contract manufacturers. These companies actually produce goods, but for other businesses who then sell those goods under their own brand names.
Making products for other brands.
Yes. Think about Apple again. Apple designs the iPhone, markets it, sells it, but they don't actually manufacture it themselves. They contract with huge, specialized manufacturers in Asia, like Foxconn, to physically build the phones. Apple focuses on the high-value design and brand, while the manufacturer focuses on efficient production.
So the brand on the product isn't necessarily the company that made it.
Often not, especially in electronics or clothing. Then there are value-added resellers, often called VARs. You see this a lot in the IT world.
What do they do?
They don't just sell a product, like computer hardware. They also add value by handling complex installation, maybe customizing the software, integrating it with other systems, or providing ongoing technical support. They offer a complete solution, not just a box.
Okay, selling plus service and expertise.
We also have licensing arrangements. This is where one company pays another company a fee, a royalty, to use its intellectual property.
Like using a brand name.
Exactly. Or a patented technology or a copyrighted character. For example, a toy company might pay Mattel a license fee to make toys based on Barbie, or pay Disney to use a character from a popular movie.
Paying to use someone else's creation or brand.
And a very, very common conventional model, especially visible here in India, is the franchise model.
Franchising, yes. We see many franchise outlets.
It's a highly structured relationship. A local business owner, the franchisee, operates a business under a well-known brand name. They have to follow very specific operational rules, standards, maybe even recipes, set by the main company, the franchisor.
Strict rules for consistency.
Very strict, usually. In return for using the brand and the system, the franchisee pays ongoing fees or a percentage of their sales back to the franchisor.
What's the benefit for the franchise then?
They get to use a proven business model, benefit from the established brand recognition and national advertising, often get training and support. It reduces the risk compared to starting a completely new, unknown business from scratch. McDonald's is the classic global example.
Right. Most McDonald's are run by local owners.
Yes. And many hotel chains like Hilton or Marriott also use franchising extensively to expand quickly.
Okay.
For an Indian example of franchising, think of popular food chains like Haldiram's or maybe Domino's pizza outlets here, or clothing brands like Manyavar.
Ah, yes. Many of our shops seem very consistent everywhere.
Many of those outlets across different cities are likely franchises. Local owners operate the store, following the main brand's guidelines for products, store layout, service standards. They pay fees, but they get the huge benefit of the established brand name, the advertising campaigns run by the main company, and a business system that's already proven to work.
Lower risk for the local owner, faster growth for the main brand.
It's often a win-win when managed well. So everyone, can you think of another well-known restaurant chain or maybe a retail brand like a coffee shop or a clothing store here in India that you suspect operates on a franchise model? And just briefly, what do you think are the main benefits for the big brand owner, the franchisor, and for the local shop owner, the franchisee, in that relationship?
That's a good question, as franchising is so visible around us. Now, while these conventional models are really the bedrock of our economy, a lot of the excitement and discussion about business models today really focuses on innovation.
Yes, the new ways of doing things.
How entirely new models are introduced, or how existing models get cleverly adapted, often because of new technology. This innovation often goes hand in hand with technological progress, especially the impact of digitalization.
Digital tech changing everything.
Absolutely.
Yeah.
Historically, we've seen major business model innovations driven by technology or changing customer needs. Think about the rise of low-cost airlines.
Like Indigo or SpiceJet here.
Exactly. They pioneered a new model focused mainly on leisure travelers, selling tickets directly online, cutting out travel agents, offering a basic no-frills service, and using efficient operations to offer incredibly low fares. That was a huge business model innovation.
Changed air travel completely for many people.
Another massive shift was software as a service, or SaaS. Remember how companies used to buy expensive software licenses, paying a huge amount up front?
Yes, buying a CD-ROM in a box.
Right. Now with SaaS, you typically pay a much smaller recurring monthly or annual subscription fee to use the software, usually accessed over the internet.
Like paying for Microsoft 365 or Adobe Creative Cloud monthly.
Exactly. This made sophisticated software much more affordable and accessible, especially for smaller businesses. A huge change in the business model for software companies.
Subscription killed the one-time purchase model for many.
And digital technology in general, the internet, mobile phones, cloud computing. It has fundamentally changed how businesses operate in almost every field. It has dramatically lowered the cost of communication, sharing information, making payments.
Everything is faster and cheaper to connect.
Which means physical location matters much less now. E-commerce lets you shop from anywhere, sell to anywhere.
Borders are less relevant for many businesses.
It also means outsourcing tasks is much easier. You can hire talent or services from anywhere in the world.
Global collaboration.
Digital marketing has become incredibly powerful and cost-effective. You can reach very specific niche groups of customers wherever they are with targeted ads online.
Hyper-targeting.
And all these digital changes lead us directly to a concept that is incredibly powerful in the modern economy: network effects.
Network effects. This is a really key idea for understanding digital businesses.
It really is. So everyone, just a quick thought before we dive into network effects. How do you think online banking or using digital payment apps like UPI has fundamentally changed the way people manage their money here in India? Especially maybe for people living in smaller towns or villages, compared to how things were with just traditional bank branches maybe 20 or 30 years ago. Think about the convenience, the access.
The reach is incredible now, isn't it?
It truly is.
And that leads perfectly into network effects. This is where things get really, really interesting in the digital age. So what are network effects? The basic idea is that the value of a product or service increases for each user as more users join that network or use that service.
The more people use it, the better it becomes for everyone.
Exactly. Think about a brand new social media app or a new messaging platform like WhatsApp when it first started. If only you and a few friends are on it, it's not very useful, is it?
No. Who would you talk to?
Right.
But as more and more of your friends, family, colleagues, maybe even local businesses join that platform, its value to you increases dramatically, almost exponentially, because you can connect, share, and interact with so many more people.
Ah, the value grows with the number of users.
That's the core idea, and many successful internet-based businesses are built entirely on this powerful principle. Think of messaging apps like WeChat in China, social media platforms, ride-sharing services like Uber and Ola here.
How do ride-sharing apps have network effects?
Think about it. The service is more valuable to riders if there are lots of drivers available nearby, meaning shorter waiting times. And it's more valuable to drivers if there are lots of riders requesting trips, meaning less idle time for them. More riders attract more drivers, which attracts more riders.
Ah, two-sided effect.
Exactly. Even older services, pre-internet ones, work on network effects. Telephone networks. A phone is useless if no one else has one. Credit card systems like Visa or MasterCard. Even stock exchanges, more buyers and sellers make the market better for everyone.
I see it now. The network itself creates the value.
Precisely. And we can broadly categorize these effects. Sometimes we have one-sided network effects. Here, the value comes from having more users of the same type, like a simple payment app, maybe Venmo in the US, or even UPI here to some extent. The more friends you have who use the same app, the easier it is for you to send and receive money directly with them.
Value from more users like me.
Then you have multi-sided networks, which are often more complex and powerful. These platforms connect two or more different types of users who primarily benefit from the presence of the other groups.
Like the ride-sharing example, riders and drivers.
Perfect example. Or the credit card networks. Visa connects merchants, shops, and cardholders, customers. More cardholders make Visa valuable to merchants. More merchants accepting Visa make it valuable to cardholders. It creates this powerful growth loop.
A virtuous cycle again.
Yes. Food delivery apps like Zomato or Swiggy are also multi-sided. They connect restaurants, delivery drivers, and customers. More restaurants attract more customers. More customers attract more drivers. More drivers allow faster delivery, attracting more customers and restaurants. Each side helps the others grow.
Very powerful dynamics.
And this power of network effects is why they often create such strong barriers to entry for new companies. It's incredibly hard for a newcomer to compete against a large, established network. How do you convince users to switch when the existing network is already so much more valuable because of its size?
The first mover with network effects has a huge advantage.
Huge advantage. Another fascinating thing, often seen with network businesses, is crowdsourcing.
Crowdsourcing, getting the crowd to do the work.
In a way, yes. It's where the users themselves directly contribute to or help create the product or service, often for free. Think about social media, who creates all the posts, photos, videos.
The users do.
Exactly. Or Wikipedia, who writes and edits all the articles.
Volunteers, the users.
Or think about customer reviews on Amazon or restaurant reviews on Zomato. Who provides all that valuable feedback?
Other customers, the users again.
Right. The user's contributions directly enhance the value of the platform for everyone else. That's crowdsourcing integrated into the business model.
Letting the network build itself, in a sense.
Let's use an Indian example to really hammer home network effects. Think about how popular digital payment apps like Google Pay or PhonePe became.
Yes, everyone seems to use them now.
When they first launched, maybe only a few tech-savvy people or certain shops used them. Was it very useful then?
Not really. You couldn't pay everywhere, and your friends might not have had the app.
Exactly. But then, as more and more shops started putting up those QR codes, and more of your friends and family started using the apps to send money to each other,
Suddenly it became much more useful.
its value to you increased dramatically, right? It became the easiest way to pay in many places, the simplest way to split a bill with friends. That massive adoption was driven by strong network effects.
Once it reached a tipping point, everyone joined.
Pretty much. So, my diligent listeners, here's a question building on that. Why do you think a brand new ride-sharing app, even if it launched today offering slightly cheaper fares, would find it incredibly difficult to compete seriously with established players like Uber or Ola in a big city like Bangalore or Mumbai? What gives those existing apps such a stronghold?
It's that network effect again, isn't it? Hard to match their existing base of drivers and riders.
Exactly. It's a powerful moat. Now, let's look at how business models can evolve over time within a whole industry. Let's take the hotel and travel industry as a case study.
Okay, hotels and travel. We all use them.
Historically, hotels were often just single independent properties, your local lodge or hotel.
Standalone businesses.
Then, as people started traveling more, especially for business,
large global hotel chains emerged. They focused on scale. Brands like Intercontinental, Marriott, Taj Hotels here in India, they offered consistency, reliability, loyalty programs.
Predictable quality wherever you went.
Along with scale, we saw specialization. Hotels started catering to specific needs, luxury resorts, casinos, budget hotels, extended stay hotels for longer trips.
Different types for different travelers.
And critically, franchising became a huge part of the model, as we discussed. Most Hilton or Marriott branded hotels, for example, are actually owned and operated by independent franchisees, not by the main company. This allowed brands to expand very rapidly without needing huge amounts of their own capital.
Using other people's money to grow the brand footprint.
We also saw functional separation. Specialized companies emerged just to handle certain parts. Some focused only on branding and marketing. Others, like real estate investment trusts, REITs, focused only on owning the hotel properties but didn't manage them. Others specialized purely in hotel management operations.
Breaking the business down into specialized pieces.
And then came the digital transformation. This completely reshaped the industry with new business models.
The internet effect on travel.
Massively. Firstly, online travel agencies, OTAs, arrived. Companies like Booking.com, Expedia, Make My Trip here in India.
Yes, use them all the time to book flights and hotels.
They revolutionized travel planning. They made it so much easier to search, compare prices, and book hotels and flights from thousands of options, all on one website or app. They are classic, multi-sided networks, connecting millions of travelers with hundreds of thousands of hotels and airlines globally.
Aggregating all the options.
Secondly, crowdsourcing platforms like TripAdvisor.com became hugely influential. Suddenly, travelers weren't just relying on the hotel's own description. They could read detailed reviews and see ratings from hundreds of other travelers like themselves.
User reviews became critical. Transparency.
Huge impact on trust and decision-making. And thirdly, entirely new models emerged like home sharing or short-term rental services. The biggest example is Airbnb.
Renting rooms or apartments from regular homeowners?
Exactly. This directly challenged traditional hotels by offering unique, often cheaper, accommodation options provided by individuals. It created a whole new category and appealed to travelers seeking more local or authentic experiences or just lower prices.
A major disruption to the hotel industry.
Absolutely. Now, notice something interesting. Even today, there are far fewer major global OTA companies like Booking.com or Expedia compared to the vast number of hotel companies worldwide. Why do you think that is?
Is it network effects again?
Bingo. OTAs benefit hugely from network effects. A big OTA is valuable to travelers because it offers a massive selection of hotels worldwide. And it's valuable to hotels because it brings them millions of potential customers. This creates incredibly strong competitive advantages for the established players. It's very hard for a new OTA to build up that critical mass on both sides, travelers and hotels, to compete effectively.
The big ones get bigger and stronger.
Often, yes. It's a classic two-sided market dynamic driven by network effects.
So everyone, think about booking a train ticket here in India. How might you do it now, perhaps using the IRCTC website or app? Compare that to how your parents or grandparents might have done it years ago, maybe standing in long queues at the railway station. What kinds of business model innovations, especially driven by digital technology, do you see in how train travel is booked and managed today?
That's a great local example of transformation.
Okay, this has been fascinating, seeing how models evolve. Now, let's try to really put on our analyst hats. Let's apply these concepts by comparing two fictional bicycle companies, Winston Bikes and Carbon Dash.
Okay, fictional case study time. This is good practice.
This will help us see how different choices in building the business model lead to very different strengths, weaknesses, and risks.
Let's describe them first. Tell us about Winston Bikes.
Okay, Winston Bikes. They make inexpensive, mass-market bicycles, standard bikes for everyday use. Their manufacturing is highly automated, using lots of robotic technology. Importantly, they lease this equipment. They don't own it all.
Leasing gives them flexibility, maybe?
Exactly. Flexibility is key for them. They use simple, straightforward designs and widely available standard materials. Nothing too fancy or specialized. For selling, they use an omni-channel strategy, selling through lots of physical retail stores, big chains maybe, and also online through their own website. Goal reach lots of customers, sell high volumes.
Okay. Mass market, volume focus, flexible operations. Got it.
Now, Carbon Dash.
Carbon Dash is the complete opposite. They produce premium, very high-quality, complex bicycles.
Each one is made carefully by hand.
Handmade. Wow.
Yes, they employ highly trained technicians, skilled artisans really, who are probably on long-term contracts. This ensures quality but means higher labor costs and less flexibility.
Skilled labor, less flexible.
Their designs are unconventional, maybe even radical, requiring very precise work. And here's a critical point. They use a special, proprietary carbon fiber material that is available from only one mine in the entire world.
Only one source for their key material. That sounds risky.
Very risky. We'll come back to that. How do they sell? Directly to customers, no retailers. They have a few very expensive, prestigious physical showrooms in maybe major global cities.
High-end direct sales.
And their customer base is small, but incredibly loyal. These customers are not sensitive to price. They value the craftsmanship, the exclusivity, the performance above all else. Niche market, loyal customers, differentiation focus. Okay, two very different models.
Very different. Now let's analyze them based on some challenges. First, how would each company handle sudden changes in market demand? Say, demand for bikes suddenly drops or surges.
Okay, Winston first. They lease robots, use standard parts.
So they should be much better at handling changes, right? If demand drops, they can reduce their leased equipment relatively easily, scale down production, control costs. If demand surges, they can lease more robots, ramp up quickly using standard materials, more agile.
Makes sense. What about Carbon Dash? Handmade skilled labor on long contracts.
They would struggle much more. It's hard to quickly hire and train new artisans with those specialized skills if demand surges. And if demand drops, it's difficult and costly to reduce staff who are on long-term contracts. They are much less flexible, much less responsive to market swings.
Okay, Winston more flexible, Carbon Dash less so. Now, what about the risks of supplier disruption? That single-source carbon fiber for Carbon Dash sounds worrying.
Exactly. Carbon Dash faces significantly higher supplier risk. Their entire production relies on that one mine for their unique carbon fiber. If anything happens to that mine, a strike, a flood, a political issue, Carbon Dash might not be able to produce bikes at all. Plus, their proprietary designs depend on this specific material.
Huge dependency. What about Winston?
Winston is much safer here. They use simple designs, widely available standard materials, and likely have many different suppliers for tubes, tires, gears, etc. If one supplier has a problem, they can probably switch to another one relatively easily. Much lower supplier risk due to diversification.
Diversification helps Winston. Okay, interesting twist now. What about the risks of increases in material costs? You might think Carbon Dash is riskier because their material is rare, but is that the whole story?
Not quite. Winston Bikes actually faces higher risk from cost increases, even if the materials are common. Why? Because they compete on price.
Thin margins.
Exactly. They operate with thin profit margins in a competitive mass market. They are price takers. They can't easily raise their selling prices if their material costs go up because customers will just buy a cheaper bike from a competitor. So rising costs directly squeeze their already small profits.
They have little room to absorb cost increases. What about Carbon Dash?
Carbon Dash relies on differentiation. Their customers are loyal and price insensitive. They have much higher profit margins and significant pricing power. If the cost of their special carbon fiber increases, they have more options. They could absorb some of the cost increase within their higher margins, or they could raise their prices somewhat without losing many customers because their buyers value the uniqueness and quality above the price tag.
So higher margins give Carbon Dash a buffer against cost increases. Interesting.
Now, final predictions based on their models. Which company will likely be larger in terms of the number of bicycles sold?
That has to be Winston Bikes, surely. Their model is all about high volume, mass market, wide distribution. Carbon Dash is niche, low volume.
Correct. Which will have higher prices per bicycle.
Carbon Dash, definitely. Premium product, differentiation, price-insensitive customers. Winston competes on low price.
Right again. And which will likely have higher costs per bicycle to produce and sell.
Carbon Dash again. All that handmade labor by skilled technicians, the expensive direct sales showrooms, that must add up to high cost per bike.
Precisely. Winston uses robots and external retailers, partly to keep their costs per unit low.
So the models lead to very different scale, pricing, and cost structures.
Exactly. So, my creative listeners, imagine you decide to start a small business selling traditional Indian pottery, maybe unique, beautifully handcrafted pieces. Would your business model lean more towards being like Winston Bikes, mass market, maybe lower price, wider reach, or more like Carbon Dash, niche, premium, maybe direct sales? And importantly, can you explain why you'd choose that approach for your pottery business, thinking about customers, product, channels, and pricing?
That's a wonderful thought experiment, applying the framework. Now let's dive into two more specific, interesting cases from the material we looked at. Healthy Pet, a pet medical insurer, and Diacera, an insulin pump maker.
Okay, real-world type examples with unique twists.
Yes, they highlight some key analytical points. First, let's unpack Healthy Pet's business model. Who are they targeting?
Their customers are quite specific. High-income, young, urban, busy professionals who own pets. And interestingly, they specifically welcome owners of multiple pets and even exotic pets, things like reptiles or rare birds, which traditional insurers often shy away from.
Okay, a niche, affluent segment, including unusual pets. What's their product?
It's pet insurance, but with a key difference in how it works. Healthy Pet pays the veterinarian directly after treatment.
Not reimbursing the owner later.
Correct. Most traditional plans make the owner pay the vet first, then submit claims for reimbursement, which can be slow and involve paperwork. Healthy Pet's direct pay model aims for simplicity and peace of mind. They also seem to have a preferred network of vets.
Convenience and simplicity is the value proposition. How do they reach customers? Their channels.
They focus on veterinarian referrals, vets recommending them, and partnerships with upscale boutique pet stores. They also have an online presence, but they deliberately avoid mass retail channels or big advertising campaigns to maintain that premium, exclusive image.
Aligning channels with the target customer and brand image. And pricing.
It's a premium pricing strategy. Customers pay monthly premiums, and the price is higher than basic insurance, justified by the direct pay feature, the peace of mind, the coverage for exotic pets, and the overall premium feel of the service.
Okay, premium price for a differentiated service targeting a niche market.
Now, if we put on our analyst hats, what are the key risks, opportunities, and questions for Healthy Pet?
Risks. Well, insurance needs scale, right? Can they get enough customers in that niche market to properly diversify their risk pool? Especially if they attract owners of expensive-to-treat exotic pets, that's called adverse selection, where the highest-risk customers are the most likely to buy. Their claims could become too high.
Good point. What else?
Also, their main differentiator, the direct pay model, seems like something a larger, established insurance company could copy if Healthy Pet proves it works. Imitation risk is high.
True. What about opportunities?
Well, they could build a very loyal customer base among those affluent owners who really value the convenience and specialized coverage. And building strong relationships with vets through direct payments could be a powerful referral engine. The prestige factor might really appeal to their target market.
Loyalty and strong partnerships. And key questions an analyst would ask.
How hard is it for competitors to copy the direct pay system? What are the real costs and complexities? How will they build and manage that vet network effectively? And crucially, will those boutique channels and referrals generate enough customers for scale, or will they eventually need expensive mass marketing that could hurt their brand image?
Lots of important questions there about sustainability and scalability.
Definitely. Now let's look at Diacera's business model, the insulin pump manufacturer. Who are their customers?
They serve diabetics needing insulin. Currently, maybe mostly type 1 diabetics. But their big strategic push is to expand into the much, much larger market of type 2 diabetics who currently rely on multiple daily injections.
The existing market plus a huge expansion target. What's their product?
They offer an insulin pump that they claim is differentiated, maybe smaller, looks better, easier to use as a single device compared to competitors. But a huge part of their offering is the substantial 24/7 customer service provided by highly trained nurses, included at no extra cost.
Wow, 2047 nurse support for free. It sounds expensive, but very valuable for patients.
Extremely valuable and likely very expensive to provide. How do they sell? Channels.
They use direct sales to customers, shipping the product to homes. They also market heavily to both patients and critically to physicians, because you need a doctor's prescription to get an insulin pump. Doctors are key gatekeepers here.
Direct to consumer, but with physician involvement. And their pricing strategy.
They price their pump at a small premium compared to competitors. However, the management strongly believes their manufacturing unit costs will fall significantly as they grow their customer base due to economies of scale. They expect margins to improve over time.
Banking on future scale to justify current pricing and high service levels.
Seems like it. Now let's analyze Diacera's key risks, opportunities, and questions.
Okay, risks. That expensive 24/7 nurse support stands out, doesn't it? There seems to be a potential mismatch between offering that very high level of costly service for free while only charging a small price premium. If customer growth is slower than they expect, those high service costs could really hurt their profitability.
The unit economics might not work if scale doesn't materialize quickly.
Exactly. Also, targeting type 2 diabetics is a big leap. This group hasn't traditionally used insulin pumps. They are used to injections. Convincing them and their doctors to switch to a more complex and initially more expensive pump therapy is a major challenge. Adoption might be slow.
Overcoming inertia and existing treatment patterns, what about opportunities?
Huge opportunities. If their pump truly is superior, they could gain significant market share in the existing type 1 market. And if they do successfully penetrate the vast type 2 market, the growth potential is enormous. It could completely transform the company.
High risk, but potentially very high reward. And the key questions for an analyst.
What are the real unit costs of manufacturing at different volumes? How confident are we in those projected economies of scale? How experienced is their manufacturing team? How many nurses are actually needed per customer to provide that 24/7 support? And what's the true cost? And most importantly, what are realistic expectations for adoption rates in the type 2 market? How will they effectively educate and convince both patients and doctors?
Really digging into the assumptions behind the model. Crucial. So, my thinking listeners, here's a challenge for you. If you were an investor looking at these two companies, Healthy Pet and Diacera, based only on our discussion of their business models, their risks and opportunities, which one would you be more inclined to invest your money in? And more importantly, can you explain why? What makes one model seem stronger or more promising to you than the other?
That's a tough choice. Both have interesting potential and significant risks.
They do indeed. So, everyone, we have certainly covered a lot of ground today, haven't we?
We really have. It's been a deep dive.
We've seen how understanding a company's business model is like understanding its unique identity, its core DNA. It clearly defines the who its customers, the what its product and value proposition, the where its channels, the how much its pricing, and the how its internal setup, its resources, its capabilities.
It's not just about the product, it's the whole system.
Exactly. The entire intricate system built around delivering value. And understanding these components is absolutely essential for analyzing any business, whether it's your tiny local mythi shop or a huge global company like Google or Reliance. It gives you that framework to see beyond just the surface level.
Precisely. This framework is so powerful because it lets you look past just the numbers sometimes and truly grasp how value is created by the business, how it's delivered effectively to the customer, and how the business manages to capture some of that value back as profit.
Understanding the how and why behind the numbers.
Yes. It helps you understand a company's real strengths, its hidden vulnerabilities, and its genuine potential for growth and long-term success. This skill dissecting and understanding business models, it's truly foundational for anyone serious about finance. Whether you want to be an investor, work in strategy, or even just improve your own business someday.
A fundamental tool in your analytical toolkit.
Definitely. So what does all this mean for you as you go about your day after listening to us? Here's a little challenge, a provocative thought maybe.
Ooh, a final thought.
Next time you interact with any business or service, maybe you're paying your electricity bill using an online app. Maybe you're ordering food through Zomato or Swiggy. Maybe you're just watching a show on Netflix or Hotstar. Don't just be a passive consumer.
Be an analyst.
Yes. Try to put on your analyst hat for just a moment. Ask yourself, who are really the customers for this service? What is the core value, the job it's doing for me? How did it reach me? How does it make money from me directly or from someone else? And based on what you observe, what do you think are its biggest strengths? And what might be its weaknesses or risks?
Look for the business model in everything.
You might just discover something really interesting, something hidden in plain sight. And you'll start seeing the business world around you with brand new, much more analytical eyes.
Keep exploring. Keep asking questions. Keep learning. This deep dive into business models is just one important step on your exciting financial journey. All the very best to all of you. Keep up the great work.
Goodbye for now, everyone.